incentives there. But you want to hold a commodity then, right? Because it doesn't infringe on any of the 1940 Act, and you won't get reclassified if you hold more than 40% of your balance sheet in securities. Like you want to hold commodities, and then you think, well, I could hold gold, I could hold real estate, but that comes with other headaches and other problems due to their physicality. And then you land on Bitcoin, right? And so I think it'll be really reasonable for really every CFO and corporate treasurer to eventually come to the sailor's conclusion, but I think it's going to take time. I think it's going to take, there's still a lot of education that needs to happen. There is still work to be done on the regulatory front. Like we've seen like a whipsaw over the last couple of years where they used to fight against it. Now there's clear accounting rules. But there is still barriers there that need to get brought down before a lot of these companies can feel comfortable allocating to it. So time is the biggest teacher, and debasement will continue to wither away the value of all these other Treasury reserve assets. And then education on Bitcoin and Bitcoin just building a stronger track record will do more than anything to get people to finally allocate to it.
I want you curious to hear your thoughts on again, because you offer such a unique perspective. You're really helping these companies expand their operations or bring liquidity to maybe some of the assets that they hold on the balance sheet. Curious to hear your thoughts on next steps for institutions in Bitcoin.
Yeah, I think it's important to differentiate public and private institutions. I think if you're public, you typically operate on a quarter by quarter basis, and you have real risks in having a negative quarter, right? Especially if you have that like uh, two negative quarters in a row, you may have a strong operating business, but if the Bitcoin is going down, which it has in the past two quarters, you're going to have a lot of questions, and your management like credibility will be in like put into question. There's a lot of risk for a business that is public, with a significant number of public shareholders to go on the Bitcoin standard. So I think we'll see a larger number of companies over the next few years maybe allocate a small percentage to Bitcoin. But I think it takes a lot of time before we see a lot of companies operate significantly on the Bitcoin standard. However, on the private side, companies are a lot more nimble and often founder-led, where they can actually make that decision. And we actually have a much larger number of private companies that borrow from us than public. Obviously, there are a much larger number of private companies that hold Bitcoin. It's easier for them to allocate to Bitcoin if they are in an industry that isn't as regulated as, say, banking. They can allocate much more easily. I was speaking to a chief digital officer at a very large fund that everyone's heard of, and he's been there for 3.5 years. All they've done in the last 3.5 years is set up the infrastructure to be able to hold Bitcoin. They haven't even bought any yet. Just set up the infrastructure
Wow.
to be able to hold Bitcoin. So the speed that we think about with smaller companies, with companies that maybe have chosen to go on the Bitcoin side publicly and have set up the operations like Sam has for that specifically, is very different from a company that has a very different operating business in the traditional world and has shareholders that are frankly focused on something completely different, right? So I think it'll get there. And as we see more monetary debasement, as we see the dollar continue to, I think, or as we see people get clear on the fact that you are losing money to inflation and debasement every year, we'll probably see more, but it's not going to be, I think it's going to be a lot of nothing and a lot of small steps until we get to like a true inflection point. We're still very early, and we'll continue to see small steps along the way as people get there. And I think as we have more utility on the Bitcoin, it's much easier for people to actually operate on that
Mm.
standard. Um, like today, if you're allocating to Bitcoin, you have to have your own strategy that's unique to you. There isn't something off the shelf that you can pick up, and you have to do a lot of work. And like someone like Sam has to operate in every single company to be their Bitcoin strategy officer, right? But I think long term, we'll see more off the shelf solutions for people to actually do more with their Bitcoin. Today, you can borrow against it. There's some places where you can get yield against it, but you have to have someone decide the quality of the tools they're using. And there's
Yeah.
not that many options in the market today still. We have some good options, but I think the market will continue to benefit from more varied options in the market.
You know, when it comes to institutions, I think, there's a lot of fair and unfair skepticism, especially some of the treasury companies. Look at like what's happening with Stretch and Seda. Big question out there whether, are they going to get back to par? Is this just a temporary moment, or is this where these products land? The exit of Jack Mallers from 21. It definitely feels like bear market vibes right now. And I know there's a strong sentiment in among Bitcoiners, and I see it out there on X, that there shouldn't be Bitcoin companies. Companies shouldn't be holding it on the balance sheet. I'm curious, Sam, I want to hear from you first. What would you say to the skeptic of some of these, or some of the critics of the Bitcoin companies, that say like Bitcoin is just meant for me and you. It's not meant for the institutions.
Um, I've never really understood it because when I thought about what Bitcoin adoption would look like, uh, Bitcoin being adopted as a new digital money, everyone is going to hold Bitcoin. Every single institution, every single person, every single household needs sound money.
Yeah.
So it's going to get adopted at every single level. And so to me, to say like, oh, these companies are acquiring too much Bitcoin or they're adopting, they shouldn't be adopting Bitcoin. It's quite silly to me. I don't understand it. I don't know. It's like screaming at a river that represents Bitcoin adoption, and they're saying it's moving the wrong way or something. This is just nature. This is how Bitcoin's being adopted. You can scream and say it's not right, or you could try to highlight some of the risks, and that's fair. But to me, this is how naturally it was always going to happen. And Bitcoin companies that have their KPIs based on Bitcoin and they pay their salaries in Bitcoin, they're really thinking on a Bitcoin standard and they're using the traditional debt-based system to accumulate more Bitcoin at favorable terms because as a public company with a large balance sheet, you can get more favorable debt terms that, say, an individual couldn't. And that allows you to basically put on this short fiat, long Bitcoin position in an intelligent way that results in more Bitcoin exposure for your shareholders per share. So, this is, you can also, as a public company, you can build out Bitcoin operational businesses. There's a optionality between how you use the Bitcoin on the balance sheet. There's been different strategies taken by different management teams to make that Bitcoin productive and put that Bitcoin to use to ultimately drive Bitcoin adoption. It also improves investor access. I mean, even Orange BTC, we just launched our ADR last month. I mean, if you're a US investor and you're bullish on Bitcoin, but you're also bullish on Brazil or Latin America or emerging markets more broadly, if you think about the currency dynamics or you're just bullish on that region, it's been one of the most outperforming sectors over the last couple of years. Now you have a way to get exposure to Bitcoin and a public company in Brazil by buying potentially our ADR if that's of interest to you as an investor. And so it's just about building exposure and improving investor access across the world to Bitcoin-backed securities. And I see it as a bridge, as there's large pools of capital that can't buy spot Bitcoin today. There's restrictions that exist in Brazil, for instance. Um, it's about meeting investors where they are. Bitcoin is still volatile today. That volatility is declining over time. But when you have, as an individual, you have your long duration savings and then you just put that away. And I'd recommend Bitcoin in cold storage, remove any kind of counterparty risk. But as a short duration needs, in terms of, hey, I'm saving for my kids' college and I need this money in 3 months to pay the tuition, you really can't afford to do like put it into Bitcoin and have what it did the last 3 months. It would be pretty catastrophic. And you say your kid, like, no, sorry, you can't go to college anymore because Bitcoin's volatile, but it's still the best money, She's gonna be like, what are you talking about? Like,
Yeah.
and so you got to try to find solutions, and that's what Stretch and SATA and these different preferred products are trying to deliver, but backed by Bitcoin or supported by their Bitcoin balance sheets. And we can go into their recent price action and why I think they'll return to par, but I'll stop there to let him share his thoughts over here before I continue with that. But that's kind of how I see the Bitcoin corporate adoption and the critics around it.
Yeah, Himanshu, I'd like to hear from you as well before because I do want to jump into digital credit here in a sec. But yeah, Himanshu, I want to just hear your thoughts on the critics of the overall like Bitcoin operating business, Bitcoin treasury space. Um, any thoughts?
I think a lot of the critics today are speaking to the fact that a lot of treasury companies haven't had a plan of what they're going to do after they go on the Bitcoin standard. And I think that's fair. I think very few treasury companies have made the efforts to actually do stuff beyond it. I think digital credit is one very interesting approach there. And I think most treasury companies are seeing the value of that. So we're seeing a few of the European treasuries um, also operate like with similar models, but it's private like Apple B or something more public like the Smarter Web is looking to do as well now. Um, I think so. It's very clear from even if you speak to Sailor, it's very clear that he has always expected that we will have to sell, or he would have to sell Bitcoin at some point, and I think the market overreacted to that, and that culminated with Bitcoin also like sliding quite significantly at that time. So it did have a bit of a depeg. It's not quite a depeg because it's not a hard $100 mechanism. It's a target. It's not a requirement. Um, SATA on the other hand is a little different. It does a daily yield. It also buys stretch under the hood, so it has some buffer there. It's not just Bitcoin backed. Um, and it's almost back at par. I think we're at 98 something on SATA right now. For Stretch, it's definitely come back from its bottom. I think we're at 88 something on Stretch right now. And I do think Stretch comes back, but I think people have to be very clear on understanding that MicroStrategy is going to have to sell Bitcoin at times. I think I had dinner with Taylor recently, and he was explaining the mechanism. I think it was something around if the Bitcoin growth rate is less than 10%, um, then they're going to sell Bitcoin. If it's over 10%, they're going to sell stock. So it's something along those lines. I'm probably butchering it a little bit, but basically the idea is that it's a mechanism where they have enough for both to sell, and it's a choice on which does get sold. I think the market has to understand that Bitcoin will get sold at some points in the cycle, and that shouldn't affect Bitcoin negatively or stretch or strategy stock itself. Um, yeah, and I think a lot more treasuries are going to issue these perpetual preferreds, and we'll probably see more utility in the market with these. I think there will be a point, much like the treasury company stocks, where there's probably too many that are similar. So there'll have to be differentiation on them as well, whether that's a securitized layer on top, which smooths out the volatility. So if you have a securitized or like a senior secured structure that you're selling that operates on top of Stretch, and that gets rated better because it's smoothing out all the volatility, that can then be sold to bond markets, for example.
Hmm.
Are much, much larger than the markets that are being than traditional public markets, right? So if you can access those, I think we'll see a lot more liquidity and a lot more investor access because investors at the end of the day are looking for yield that's rated and that's rated at least double A and above, right? So if you can get that, you can access much, much larger insurance markets and such.
You called out something, which makes me think about the total addressable market of digital credit, and I want to get to that, but I want to backtrack a little bit. Sam, can you just take us through what happened with these digital credit products? It seemed like they're printing money every day. We're at par every day. Sailor and or Mike Strategy and Stata, they're buying all the Bitcoin, and all of a sudden it seemed like we have this big unwind. From
Yeah.
Can you explain to us what happened? And
Yeah. I could do my best.
yeah,
I look, I think the first thing you have to understand is that these are very, very young instruments and innovative instruments that the market's still trying to wrap their head around. Like Stretch just turned one, I think, or is just about to turn one. And in the financial world, that's it, they're babies. They're also innovative. There's nothing that's existed like them. Having a perpetual preferred equity instrument that's backed by Bitcoin or supported by Bitcoin balance sheets. It's a very new type of instrument, so the market's still wrapping its head around it. And I think what we learned was that strategy when they paid down some of their convertible debt by using the USD reserve, that the market had viewed that as specifically earmarked to service the dividends, even though that wasn't the case. That's obviously how the market viewed that. So when it got drained down to pay the convertible debt down, the market kind of freaked out a little bit, and that's when Stretch started to trade at a discount to par. And it was interesting because I think that's actually a good move for them. Maybe they should have tapped the ATM of MSTR to pay down the convert, but it's actually a good thing for the MSTR common shareholders as well as the preferred
Yeah.
shareholders to remove some of that senior obligation. That's a hard cash obligation. And if you actually look at the put dates of some of these converts over the next 2 years or so, if the stock price doesn't improve materially and it doesn't get into the money for these converts, they could demand their money back. And so that's actually like a real risk for strategy over the next couple of years to remove some of that convertible debt. But the way they did that by draining the USD reserve at that time, and then right after Bitcoin puked, it just wasn't really lucky timing for the whole
Yeah.
thing. And so now that when it dropped, and then I think at the same time, we learned that there was a lot of leverage being taken on top of Stretch as it kind of, the volatility started to decline. People started to leverage up, people started to carry, they didn't manage risk well. And so you saw the initial drop from this drain of the USD reserve, but then you hit these liquidation thresholds all at the same time. And that's what caused the real spike down to 74. Once it got to like 90 and then it just kind of like trapdoored, that's usually where there's a deleveraging event that happened. But since then, I think strategy has done all the right moves. They've shown that they want to prioritize their preferred equity shareholders by raising the USD reserve. They're almost back to 2 years of USD coverage.
Yep.
They earmarked their Bitcoin and the USD reserve specifically for the dividends. They announced a stretch buyback program, which is also, I think, a good move. And so they're really showing to the market, and then selling the Bitcoin, I think was completely the right move. They're an operating company with a large liquid asset on their balance sheet. They can do whatever they want. They have complete optionality to do whatever they want to if they feel like that action increases shareholder value. And if selling some Bitcoin to raise some cash or to pay back or to buy back a preferred, if any of it is accretive to their shareholders on a Bitcoin per share basis, or puts them in a stronger position and puts their capital structure in a more durable position to be in a position down the road to increase Bitcoin per share at a greater rate for their shareholders, they're thinking long term, then they're going to do that move. And so they bought 90,000, almost 90,000 Bitcoin in Q1. They bought a little over 80,000 in Q2. And now people are freaking out because they sell a few thousand Bitcoin. Like, you really got to zoom out and look at the big picture of what they're trying to accomplish here. They're trying to build a Bitcoin accumulation machine for the long term. And the best way that they found to raise capital is through these preferred equity products in an accretive way, because it doesn't have a maturity wall. It doesn't have refinancing risk. It doesn't have all these things that, say, a traditional debt instrument has. And so, I think since Stretch has broken down, they've made all the right moves. I think now the market's just trying to, the stress test is trying to work its way back towards par. But as a Stretch
Yeah.
shareholder, the only thing you should care about is, will they service the dividend? And if it gets back to par, will I have the liquidity to get out of my position? It's still trading, $400 million, I think today. Oh, that's MSTR. Hold on, let me go to Stretch. No, it's trading $270 million over the last 30 days. So it has the liquidity for the preferreds. And then they're going to continue servicing the dividends. So they just serviced they now have serviced over $1 billion of preferred dividends strategy. And now SETA has just hit their 30, I think, daily dividend. And so it just takes time to build a track record. But really, that's all you should care about is like, will they service the dividend as a stretch holder? And the answer, I think, is definitely yes over the next at least several years because they have the reserves built up to do that. And then will it get back to par? And I think that's just a matter of the market absorbing it, market learning more about it, building a track record of servicing the dividends. It all comes with it. And once it gets back to par, I think the liquidity is there where if an investor does want to get out, they will be able to, especially when you compare it to other preferreds liquidity in the market. I mean, it's night and day. So I think they're young products. They'll recover. They've done all the right moves that they've had to do since the stress test. And I think, probably over the next couple months or so, it'll get back to par.
Are you trying to say that the random anonymous Twitter troll doesn't know financial engineering better than Michael Saylor and Fong Li? Is that what you're
I
inferring?
mean, there's some times though where I do think to myself, I'm like, because I've had dinner with Sailor, and he really is truly like a special brain. The guy is not a he what you see on screen is what he's like in person too. He never stops. He's always thinking about Bitcoin. Always, it's just amazing talking to him. And I always just think of the critics. I'm like, is this guy smarter than Sailor? It's like no, like not a chance. And so I think it's important to question. It's important to debate. Sailor and strategy, I think they should get a lot of credit for building a brand new business model in public, learning in public, pivoting in public, being extremely transparent. They're not never gonna make mistakes, but it's important that they learn from those mistakes and pivot. And so I think that's what you've been seeing over the last year or two as they build out this new digital credit, financing franchise that they're developing here. And so they should get a lot of credit for that. But a lot of these critics, you really go through it and like, have you run the numbers? Have you actually read the
Yeah.
filings? Have you done the deep dive? It's okay to have reservations and to point out risks and trade-offs and to question some things, but you really want to at least do the basic homework and run the numbers yourselves before you open your mouth publicly about a subject.
Yeah, I stopped tweeting my criticism of Saylor on my Anon account a while ago. Okay. Uh, One more question, just kind of about the larger Bitcoin company space. The exit of Jack Mallers from 21. I'm really curious. I don't want to speculate, as to like what happened. We're gonna, what they say is what happened. But I really want to hear what this means for the larger space. Is it a signal of like a trend that we're going to see, or is this just Jack going back to Strike to focus on his baby?
I can speak to this a little bit. I think it's the latter. A lot of the 21 initial approach was centered around like the star team and the capital behind it. They didn't do much with it, but the expectation always was that they'll roll up into Strike and then that'll be one big company. And also with Electron. Um, Again, it's all speculation. I haven't spoken to Jack about this, but Strike has been doing a lot on their side as well. They're our competitor, they do a lot as well, and it's a very demanding business to run, I'm sure. I think rolling down to 21 with him leading both would probably have not been the right approach for 21 or for Strike, especially given a lot of Strike's marketing and go-to-market efforts are centered around Jack. With 21, in the announcement for his exit, they said that they're going to uh, go on with their approach on adding lending, etc. So it looks like they're going to be competitive with Strike now, which probably means that it wasn't like a very happy exit. However, it remains to be seen whether they have the operational capabilities to build those things. Now they will obviously join up with Electron, it looks like, so it might be a two-way merger. They do have a strong Bitcoin balance sheet. So it remains to be seen what approach they take. They haven't done anything with their Bitcoin yet. Um, so I think it's still very early. I wouldn't call this a trend of in any capacity. There hasn't been another merger like this where there's been a strong or like there's been a large Bitcoin treasury looking to acquire a financial business underneath. So I think we will probably see uh, more consolidation in the treasury space, looking with companies looking to acquire operating businesses. We're seeing treasuries specifically launch to acquire operating businesses as well. There's a few new treasuries coming out over the next few months and years that are going to do that. So I think it's not a trend. It's just a very unique circumstance. The timing is certainly very interesting. Why now versus a few months ago? But it's all speculation on why now versus
Yeah. No, I agree. I think you will probably see some more consolidation, some more acquisitions of operating companies, and you have treasury companies that are trading at significant discounts, which
Yeah.
could be attractive for another treasury company to come in and acquire some of the assets at a discount. But in terms of the specific news, I'm a big fan of Jax. He's been a great Bitcoin advocate entrepreneur for many, many years, and I think he's a good person. And so I hope everything works out. He's just going to keep building Strike and do great things for Bitcoin from here. I just think in general, like three-party mergers, the odds of this actually happening were low from the very get-go. I mean, it's
Mm.
very difficult when you have an energy business, mining business, Electron Energy, you have 21 Capital, and you have Strike. You know, how do you value, you have to agree on how do you value each of the companies, who has control and the governance. You have different business models. It's very, very complicated. Even you saw even Nakamoto, they were doing a merger and even, they had the same owners in the companies and it took almost a year to even get that across the finish line. Now we're talking about three companies trying to merge. It's just complicated. So these things fall apart all the time. And so I don't think there was any kind of like drama necessarily. I think in general, maybe negotiations just kind of broke down. Maybe Jack just wanted to focus on strikes, simplify his life a little bit. It's also there's real um, demand on an individual when they're running a public company, right? In terms of what you can and can't say publicly. Jack's always been a really authentic guy, likes to say exactly what's on his mind all the time.
Yeah.
Maybe that factored in a little bit. Like I think from the video you saw, he kind of spoke a little bit about that and like I just want the Jack Mahlers that feels happy and driving Bitcoin adoption and education and building Bitcoin financial services. So happy that he's just going to still focus on Strike and keep building. But I also have a lot of confidence in Hafa Seguri, who's taken over as CEO of 21. Electron Energy is they run about 5% of Bitcoin's hash rate. I think you might see it turn into more of like a public Bitcoin mining company, and they'll probably
Mm.
develop other Bitcoin strategies. They have a giant Bitcoin balance sheet there.
Yeah.
A lot of question marks about, what's going to develop from there, but I think you're going to hear a lot from them over the coming, few quarters here. So I'm excited. I'm excited to see what Strike builds from here. I think everything's going to work out. I don't think it's like some big sign of, bear market or something fall apart. I think these deals fall apart all the time, but there was just a lot of spotlight on it just because of the names involved and the companies involved and everything like that.
I think one argument to be also to be made here is I think if you ask someone a year ago, do you need to be acquired by a public company to have the capital markets expertise or the capital markets access to be able to serve a large number of clients and a large amount of lending activity? And in the past, maybe the answer was yes. Today, I don't think that's true anymore because capital markets in the last few months have evolved quite significantly where you can actually access a ton of debt as a private company. So you could have said that, hey, you need to be part of a public company to get to the next billion or the next 5 billion, but you don't really anymore. Strike did raise a $2 billion line with with Tether. A number of other companies, including us, have very large lines with different capital partners as well, in different structures. So maybe you don't need to be, from Strike's perspective, like they didn't need to be part of 21 to do what they need to do. And I think other companies will probably make similar decisions or will be in a position to make similar decisions. Whether that's yes or no for them is very unique to each structure. But it is something to note that I think capital markets in Bitcoin lending has evolved quite significantly. It evolves on like a monthly basis at this point. So what was true when this was proposed, which I'm sure was 6 months ago before it was, before it was ever public, is probably not true anymore.
Good points.
Oh, go ahead, Sam.
No, no, I was just saying good points.
Yeah, I'm excited for Jack. I'm a listener every once in a while of the Jack Maurer show. Enjoy him. A happy and authentic Jack is the best one. Okay, we got a few minutes left. Want to kind of wrap it here. Himanshu, you mentioned, I think it was you mentioned how much Bitcoin 21 holds on the balance sheet. So for these companies that want to make Bitcoin productive, that want to make that balance sheet productive, obviously we've seen products on the market like digital credit. I'm curious, with digital credit, the advent of digital credit, I'm curious what you guys think what's the total addressable market here? I mean, this attacks like banking, fixed income. There's a lot of different places you can park your money. I'm curious what the future of digital credit looks like. Sam, you said we're only a year into this.
Yeah, I think it's very early in who we're addressing. So with Stretch and SATA, 80% of Stretch holders today are retail. So it's not even gone to the bigger institutions and such. But it's also not an instrument that's rated in a place like at least double A or above where any serious institution is going to buy it. So it's still very early in how it's wrapped. Now, Sailor's always said, I'm going to create the tools. People are going to build on top of that. So we have two products called Apex and SATA that are basically like a smoothing layer on top of Stretch. We're going to see people build securitized products on top, which use Stretch, but have a smoothed out, non-volatile product that actually does work as fixed income. So you're just getting a yield. It's not something where you're targeting a yield. And I think that will probably be something that yields a couple points lower, but does get rated very favorably and can then be sold to bond markets and such. M- Bond markets are the largest credit markets in the world. They're orders of magnitude bigger than um, like traditional public like stock markets, right? So that market has not been touched yet. We will certainly see someone build. I think we'll see many approaches to build there. We only just saw the Bitcoin-backed lending markets hit the bond markets, right? Very recently. Ledin did their securitization of their book. We have a book that's been on-chain securitized. So it's still very early in those approaches as well. This is something that's so new. Like it took 7, 8 years of Bitcoin-backed lending to exist before we did that. We're only a year into digital credit, or maybe a couple years if you count the earlier products that Stretch had. Um, so I think we'll see approaches in that where institutional investors, with all the other tailwinds with Bitcoin, finally who understand what Bitcoin is, but want to offer a fixed income product, will offer something that is more agreeable with large institutional investors.
Yeah. Sam, curious to hear your thoughts.
I mean, I just agree. I mean, I do think we're early. I think a lot of the moves that strategy has made uh, has been revolved around some of the feedback it's gotten from the credit rating agencies, right? S&P Global said that they'd increase their rating or upgrade them if they did a few things, if they improved their USD liquidity, which they have, if they demonstrate that they have strong access to capital markets in challenging conditions. They've raised billions of dollars over the last several quarters at a time when Bitcoin corrected 50%. I think they've demonstrated that pretty well. And the last thing is reduce some of the convertible debt. And so they did do that. The market kind of puked a little bit because Bitcoin fell right after they did that. But in general, these are all steps they're making. This is when I say think long term. They're thinking long term. They're trying to, improve the credit rating to bring in more capital, to bring in more institutions to feel comfortable allocating to these new instruments. And so each move can't be viewed in a silo and not just short term. It's all made to achieve greater goals, to bring in more demand for these instruments. And that's just how the traditional financial system works. You need a better rating to unlock
Yeah.
access to these larger pools of capital. So, I think this is early days. I think this is a stress test that when you look in hindsight, it's actually, they're going to point to this as say, we were able to bring this back to par, by continuing to service the dividend, continuing to build a track record, continuing to be disciplined. And I think that's what they're going to continue to do. And so it's the market, time does a lot of things, like I said earlier. And so the more that they can demonstrate a good track record, the more the larger institutions will feel comfortable allocating to the instruments.
I think that's a good place to put a bow on it. Sam, where can our listeners today, where can they find you if they want to hear more?
You can find on X at Sam Kalla, SamCallah. You can also find more about the company, OrangeBTC. That's spelled with a J for the orange. That's orangebtc.com, or follow us at OrangeBTC on X, where we share company updates.
Himanshu?
You can find us on X at Arch Lending. Our website is also very simple, archlending.com. I'm not as active on X as I should be, so just follow the company. We do have a newsletter that goes out with market news every Wednesday. So it just went out this morning. That's on our website. You can go sign up very easily. We have a ton of people who follow that just for a 3-minute read of what's going on in the market. Yeah, if you have any questions on lending, on borrowing against your Bitcoin, on how you can activate your stack in a very safe, creative manner. We do serve both individuals and businesses, so 2 different product lines for both. But yeah, happy to answer questions for anyone at any time. Our team always takes calls from people all over the world.
Awesome. Well, gentlemen, thank you for joining me today. If you're listening live, both of these guys have spoken at our symposiums. Our next symposium is coming up in Hong Kong on August 27th. If you can join us, we would love to have you there. Gentlemen, thanks for being on today.
Thanks, Jake.
Thank you. Have a good day.
You too.
All right, welcome back. Checking on shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up Strategy's finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Peng Li. Thank you so much for joining us, Peng, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here at the 52-week range than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
Yeah, look, I think Bitcoin is going through a bear cycle right now, and some of that is external macroeconomic. I think there's a major funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty with wars around the world, and there's uncertainty with governmental legislation. We, as a company, went through this in 2020 right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance, the reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that'll start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need the SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real-world assets, to allow stable coins to be implemented. What will happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Following our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really were our Bitcoin purchases accretive to our common shareholders and our Bitcoin per share, and they always have been. We're selling Bitcoin from time to time, and we've shown that our Bitcoin sales are not really a major portion of what occurs in the market, but sometimes it makes sense to sell Bitcoin to add to our U.S. dollar reserves. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns? Now, of course, your shares are down by half. What is the shareholder value you're creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done in the last couple of weeks to pay dividends. We've done in the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet, but Michael Saylor on X said, when I say never sell your Bitcoin, I speak as no one saver to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it has disclosed it may buy or sell Bitcoin and manage capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that'll ever be mined. We're the largest institutional holder of Bitcoin. Last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me, is irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Feng, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Fong, just how much, and I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC, by the CFTC, Treasury Secretary Besson. There are rules ready to go, and they're either going to go with clarity, with the legislature behind them, or they're going to go without clarity, with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Fong, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Fong Li, CEO of Strategy.
Our financial markets and our financial system, which is built on American rails, so to speak, and which has preserved America's role as being the reserve currency, the currency of settlement, we want to protect that from China or other countries trying to dominate that. And China indeed is trying to do so. And we don't want to be under a system where the Chinese Communist Party determines who can access it. They can avoid sanctions. They can avoid supervision. So we're at this moment now where it passed by nearly 300 votes a year ago. It passed in May out of committee with bipartisan support, and we're on the cusp of this. And of course, the ethics piece is part of this. It's just a small piece of a 600-plus page bill. Look, my view is ethics provisions were put in there. Ethics are incredibly important, of course, with all government officials. But this is too important for the leadership of our country, for where we stand going forward. If we're going to dominate and lead in this technology and preserving our financial networks, our economic strength, is we got to get this bill done. And this upcoming week may be the last opportunity to do so before we lose this moment for another year or two.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. I am so giga bullish on Bitcoin, you guys don't even know, because I've been crunching some numbers today, running some analysis, and I have found myself a very, very bullish case for Bitcoin. And then because I'm bullish on Bitcoin, I also have to be bullish on amplified Bitcoin, which is represented in the ticker known as MSTR. Yes, the common stock equity of Strategy Inc. So basically, I've been formulating my Bitcoin bull case for the next year or two, and I'm finding some very bullish findings when I start crunching the numbers. Right now, I see Bitcoin sitting above the 4-year moving average of the asset, but only about 3% above that 4-year moving average. And then on top of that, I found something very, very interesting. The 200-day moving average and the 200-week moving average are about to cross. Now, I'm not a big technical analysis person, but regardless, this is definitely taking statistics from history, looking at things empirically without bias and just running numbers. So I'm not drawing any lines on charts or any of that astrology for men nonsense, but I definitely am looking to history and seeing what happens whenever these other events occur, because I want to look at prior regimes to try to map them onto today. And basically, I'm finding some very bullish statistics, and good heavens, the findings are very bullish for Bitcoin, but they're even more bullish for MSTR. If you guys are hanging through this Bitcoin bear market with me, please do me a favor. Hit the like button on YouTube below. Yes, press the thumbs up button right now. I'm not asking you, I'm telling you. It really helps the channel, and if you're not subscribed, hit the subscribe button too, because hey, I'm spreading the orange gospel of Bitcoin to the masses every single day of my life. I am a warrior on the front lines for the network, and I need your help. Like the video, subscribe, let's get into it. You guys are gonna love the content today. None of this is financial advice, this is financial entertainment, but hey, we all think that Bitcoin is going up, and we all want to retire our bloodlines. Now look, kids, if you're already listening to the Bitcoin chicken wizard, lizard, gizzard, you're probably bullish on Bitcoin and MSTR. And basically, if you think Bitcoin is cheap right now, then that means maybe now is the time that's the best generational buying opportunity that you will see for the rest of your life. What if you could get more than half of that upside of Bitcoin or MSTR with your principal protected? That is exactly what my friends at Sovana are building. Every single dollar of your investment is protected by a title-insured recorded lien on U.S. real estate. And you split the upside with the property owner whose home equity is backing the investment. If you've been waiting for a way to buy Bitcoin or MSTR that allows you to sleep at night, this, my friends, is it. And honestly, what better time to lock in a 5-year position than when Bitcoin and MSTR are sitting at these levels? If you are an accredited investor, scan that QR code right now. Click the link in the description below. That way you can get in line to invest at sovana.io/capital. And also, if you have not secured your own strategic Bitcoin reserve, what are you doing with your life? My dearest friends at the Bitcoin Way will train you to become a sovereign Bitcoiner. Did you know that you can literally be your own bank? You don't need permission from anybody. The Bitcoin Way will train you how. Using only the best open source tools, you can run your own node, be your own bank. You can go to thebitcoinway.com/Adam or scan this QR code right here to book a free introductory call, and they will train you how to become a sovereign Bitcoiner. I'm not asking you, I'm telling you, do it right now or I will never ever forgive you. All right, so the bull case for Bitcoin is a convergence of factors, okay? I'm not giving you one indicator here. Remember, valuation, trend compression, these things measure different market conditions, which makes their simultaneous appearance more meaningful, obviously. It's essentially more evidence for building a case. Signal one here is valuation. Bitcoin sits only 3.62% above its trailing 1460-day average. And signal number two is the structure of the trend, okay? The 200-day average is collapsing toward that 200-week moving average. So the distinction here is the 4-year average of Bitcoin. It's really asking how stretched the price is versus Bitcoin's own cycle memory, okay? The cross that's happening here with indicator number two, this is really talking about how compressed the median term trend is versus the long-term trend. That's what we're talking about here. And this convergence matters because different measurements are pointing to the same exact zone. So the case is stronger than some single oscillator on some chart. Right now, sentiment in Bitcoin is terrible. What does that mean? It's a reflection of everybody's mood. Now, the market is focused on the recent damage of Bitcoin. That's why sentiment is awful, because people can't divorce their petty little emotions to understand the bull case in front of them. So basically, we are going to look at a window that can open before sentiment recognizes the turn, okay? We are going to frame this asymmetry today. So my dearest captains, you want to know how rare variable number one is, this 3.62% above that 1460-day simple moving average. This print is in the lowest 8.9% of all usable daily observations. So that's a pretty rare Bitcoin price print. And you got to really think about what this average is telling you. It's really compressing 4 full years of Bitcoin adoption, the issuance of Bitcoin, liquidity, and the cycle history into one moving reference level that goes up and to the right over time. Now, it is above the average, not below it. Now, the rarity is being this close to it still. Obviously, you could time the bottom perfectly if you wanted to, if you actually wanted to try to do that. But we know that this is not a trading signal YouTube channel. I'm not doing that. These people trying to sit around and wait to snipe the first percentile in price, these people are nonsense. These people are nonsensical. We want to be right the vast majority of the time here. Now, when we look at this one valuation zone as it relates to this deviation from that 1460-day simple moving average, the median 12-month return of Bitcoin, 120.9%. The median 24-month return is 319.9%. Now, these are all of the path-weighted medians here on this chart on the right. 3 months, 23.2%, 6 months, 50%, 12 months, 120, 18 months, 224. You can just see as time continues to progress, when you look throughout history, we are in a zone where Bitcoin always goes up with these time increments. Will history repeat itself? Obviously, nobody knows for sure. The robots could take over and everybody could get nuked and we all could die. But I don't believe that's going to happen. And all I got to say is I don't have a crystal ball. All we can do is look to history to try to be empirical about things. So why am I using the median returns? The answer is very simple, because Bitcoin's return distributions obviously are very heavily skewed, but the median, it resists domination by one explosive cycle. These are the median returns here, not the averages. That is even more bullish. So I want to make this point very carefully, that history says the upside is asymmetric from this zone. It does not say necessarily that the next path must match the median or arrive in a smooth manner. It's probably going to be volatile. I'm just saying the upside from here has always been pretty damn groovy, kids. Now, obviously, Bitcoin is still a relatively small asset class that's still monetizing in real time. It's only 16 years old or so, so basically, we have a very small sample size here when we look at those prior cycle returns. So the signal that I'm talking about today, there are basically 4 entry episodes throughout history and only 360 qualifying days in this zone, but every single cycle was positive ever since every single time we do hit this zone, but every single time is definitely explosive. So small sample size of data, but you cannot argue with those results there. Pretty killer, 198%, 807%, 1020% back in 2015, and even earlier in 2015, January 2015, 311%. So that's signal 1, but I want to talk about signal 2 today, because remember, this is talking about the 200-day moving average versus the 200-week moving average. The 200-week moving average of Bitcoin is still compounding considerably north of more than a 20% CAGR year over year since 2020. People talk about Bitcoin's diminishing returns a lot, as if that's something that's happening. Now, they are happening mathematically. That's 100% true. Obviously, it takes a lot more capital. In terms of absolute dollar terms, that's not diminishing. But regardless, that 200-week moving average line, this slow compounding trend line of Bitcoin going up and to the right over time, since 2020, still compounding north of 20% every single year. Now, the 200-day moving average is more of a shrunken down timeline. And whenever it goes down and crosses that 200-week line, that is when you get a death cross, kids. And that happened on November 7th of 2022. You remember those good old days? Was that the FTX collapse month? I think it might have been. Now, basically, the reason why I wanted to look at this indicator today is because if you look at the chart, essentially it looks like we are heading there right now. And don't worry, kids, Daddy went ahead and made a graph for you to show you what I'm talking about. So the colors are inversed on this one, but the purple line is the 200-day simple moving average, and then the yellow is the 200-week. But starting in 2015, you can see that it didn't even cross 10.5 years ago, and then there was a divergence that lasted a number of years. Now, that was until November of 2022 when there was a crossing. Now, if we zoom in, obviously we saw a recovery, and if you would have bought Bitcoin at this day right here, you would have got a 255% return in 492 days. So this was previously an amazing entry if you wanted to buy Bitcoin, obviously. But we know that Bitcoin did drop even further. It went to 16K. You know, it took a while to recover, but ever since then, the 200-day moving average considerably outperformed that 200-week moving average. But we are very close to witnessing another death cross, children. Now, I'm not saying that we will cross it. Definitely not. That's not what I'm saying here. But if we assume that Bitcoin trades flat from here on out, the question is, when would that cross actually happen? I'm not saying that it will, kids. Definitely not saying that it will happen. But if it does, you want to know what date it's actually going to cross if Bitcoin trades flat? It's actually November 2nd of 2026. So, you know, a little over 3 months from now. So basically, if there is a death cross and the 4-year cycle bros are correct, who knows exactly what's going to happen? I know that a lot of people are saying that Bitcoin has to bottom in September or October. I don't know exactly what's going to happen. I'm not making any short-term price predictions. I'm just saying if Bitcoin is flat from today, that death cross happens in early November. This is what it's going to look like, kids. It is very, very possible that we see a crossing around that first week of November if the trend continues what we've been seeing lately. So basically what I wanted to do was kind of project out a 1.5 years of a forward return whenever we have hit that same cross level in Bitcoin's price history. So there was a little bit of a peak in Bitcoin's price in March of 2024 before it ran up further, you know, around the election time that year, obviously. But I didn't want to do a 2-year forward return. I really wanted to calculate a 1.5 years because maybe I'm running out of patience a little bit. But regardless, November 7th, 2022, that was when the return clock started. 492 days after that, that was a 255% Bitcoin return in that time frame before even running even higher before the end of 2024. Now, this is interesting because remember, that cross happened in November of 2022. Now, it might happen again in November of 2026, exactly 4 years apart. So if we apply that same clock fairly, well, that 492-day analog signal, that lands around March of 2028. Less than 2 years from now, March of 2028, okay? So we need to start the return calculation from that point in time here. So what would the cross analog actually imply here? That would imply, you know, just a $226,000 Bitcoin price. And that result is actually below the historical 22-month median. Remember earlier in the video, the path-weighted median return was plus 295%, and that would take us to over $250,000 Bitcoin. So we have a distribution right here of all of these results from the 25th percentile up to the 75th. They're between 200K Bitcoin and over $276,000 Bitcoin. So this crossing that happens, if we start the clock, the same return happens this cycle. You know, I'm not saying that it will, but it might. Remember, this isn't crystal ball stuff. I'm not predicting this to happen. I'm literally looking at the past and then projecting it onto the future. But this return would actually be in the 40th percentile of all of the qualifying days returns here when we look throughout Bitcoin's price history. So, you know, I am comfortable with this distribution of results, 200K to 276K Bitcoin, I will take that. So there you go. That's the bullish Bitcoin case right here. Two different signals leading to some pretty significant returns over the next 1.5 to 2 years here. Now, this was really interesting because I ran these numbers on Bitcoin earlier today, and of course I asked the question, what does this mean for MSTR? Because MSTR is down around 80% from the peak. MSTR is literally amplified Bitcoin because it has these return engines, these two different return engines that are actually bolted onto MSTR. Because obviously, if you're holding MSTR, you get that Bitcoin repricing. Obviously, you get that. But on top of that, if they issue the preferred stock, you get that too. And then potentially you do get MNAV expansions. So there are different gears to the MSTR return engine here, and you have to be wary of those things. You know, if I want to invest today, should I buy Bitcoin or MSTR? You know, I love Bitcoin. I've been buying a lot of Bitcoin over the last year, but I do want to articulate why I think MSTR is deep, deep value, because even when I put in some bearish inputs, with just this Bitcoin price move, the results are ridiculous. And you know what's bullish? Let's take that ending $226,000 Bitcoin price, okay? We're not going to go for the median, which is a little bit higher. We're not going to go for the 276,000 Bitcoin price. Not at all. This model here is very, very simple, kids. I think maybe it's safe to assume that because we just saw the MNAV of MSTR go up to a 1.25x literally 2 months ago when Bitcoin only went to 83,000, I think it's fair to assume that maybe, I'm not promising this, I think it's possible that we do see a 1.5x MNAV if Bitcoin goes to almost $250,000 per coin. So I do have a 1.5x MNAV on top of that Bitcoin move. On top of that, I also have this stretch issuance machine getting turned back on again for their same year one pace. Now, if that happens, they would end up with under 1 million Bitcoin because this model assumes 0 common stock sales to buy Bitcoin, but they do sell the common stock to pay the dividends on the preferred stock. But right here, the amplification would lift your common equity Bitcoin exposure sats per share to 206,000 sats, and the senior claim ratio would be cut pretty much in half. With all of these scenarios, this would be $700 MSTR. MNAV only going up to a 1.5, them issuing 0 MSTR over the next couple years to buy Bitcoin, and then they service those dividends with MSTR sales. A 254% Bitcoin return would be a 627% return for MSTR in this scenario. Does it happen? I don't know exactly. I think it's totally possible. This is my humble, not financial advice opinion. This is the return decomposition because we're starting at $96 MSTR today. Obviously, Bitcoin and the claims would juice the returns. Now, that added stretch issuance, it actually doesn't add a lot to the return. In my opinion, that's not a sizable chunk. That's only adding about $33 to the ending stock price right there. That's why everybody getting their panties in a bunch about stretch getting back up to par. I just see this and I'm like, well, all of the returns are so latent sitting there with Bitcoin and the embedded amplification just sitting there waiting to go up anyway. I'm not too concerned about stretch getting back up to par ASAP. I know that that might be controversial. I think it will get back up to par, but whether or not that happens next month or 3 months from now, I don't really care. And so basically just this bearish scenario, even if there is no MNAV expansion, that gets you close to the all-time high. That gets you close to a 5x return with no MNAV expansion. And if we do get a 1.5, there you go, $700 MSTR. Now, what is interesting is that, remember, that historical median return, that actually points higher than a $700 MSTR. Depending on the time horizon, obviously, depending on the Bitcoin return, you can go ahead and take a screenshot if you wish. This is my return table at a variety of MNAVs here, at a variety of Bitcoin targets. But if we do get the median Bitcoin return from that historical sample scenario, that gets us over $250,000 a coin. At a 1.5 MNAV, there you go, $792 MSTR. And that would be the 22-month time horizon, but 2 years would bring us to an $847 MSTR. At that MNAV, $560 MSTR with an actual MNAV contraction down to a 1. I think it was like 1.04, 1.03 today. So slight MNAV contraction. If you actually think the MNAV will go down, even if we get a move to $250,000 Bitcoin, that result is still over the intraday all-time high for MSTR. So we're getting all of these crazy juiced returns just based on the embedded amplification. No MNAV expansion necessary, even though that would be nice. Anyway, I think that we are in a very rare setup for Bitcoin that has historically happened every single 4 years or so. Obviously, the cross analog Bitcoin price there throughout history, $226 if we look at the cross scenario, but the deviation from the average, the historical median returns, it's actually a little bit higher than that. And all my conditions are pretty explicit, so I'm actually not giving advice. I'm not even giving a prediction. I'm just giving a projection. I'm trying to be empirical, being very blatant with my assumptions. None of this is moonboy nonsense. 226K Bitcoin, that's not even a 4x from today. So I don't think this is pie in the sky. I think that Bitcoin's growth is still tremendous. Remember that long-term growth trend, that 4-year moving average, still compounding very heavily this decade. So if we continue to see that trend, but Bitcoin's volatility continuing to stay elevated, I do think that you could see some upswings that are going to be violent in the next couple years. Basically, we're just expecting for Bitcoin to keep being Bitcoin. And anyway, bullish Bitcoin returns, bullish MSTR returns. I'm not trying to be a moon boy, I promise you. I'm just looking at history, plugging in some blatant assumptions, and this is why I'm doing the work. This is my conviction and why I can't be anything but bullish on Bitcoin and MSTR. My name is Adam Livingston. I am the Bitcoin Wizard. I hope you guys like this video. If you did, please like the video and subscribe to the channel. It helps a ton. I hope you all have a very terrific day. Do not party too hard, my dearest little rascal goblin captains. Class dismissed. This video is sponsored by Solana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Solana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Solana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Solana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to solana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
The 1% make 4 times more money than you while holding the exact same assets. You see, most people think building wealth is about finding the right assets, getting lucky, right? But the 1% know it's about the structure, right? Even if you get lucky and you pick the right winner and you hold it in the wrong structure, you'll still be behind people who bought something worse than you did
but held it in the right way. Now there's 4 components to that structure, 4 components that can take you from an underperforming asset and turn it into the biggest winner on your balance sheet. So in this video, I'm gonna break it all down for you so you can steal it. We're gonna compare assets to assets. Then we'll look at the structure that you put them in, and then that same structure across every asset that you own so you can run it on your own. You ready? Let's go. All right, this is gonna be a fun one. I'm gonna show you how it's not about the right asset, it's about the right structure that you hold them. And we're gonna use this article from Bloomberg magazine. I'm gonna call them out, it's gonna be fun for me. And the most important thing is, like, you have to be so careful who you let speak into your life, who you let speak into your kids' lives, your family lives, but you have to be careful who you take advice from. And I typically ask, like, if I take your advice, will I end up like you? And so here's Bloomberg, like a trusted financial source, and this article, we'll go through that, okay? But I wanna break this down, and then I'm gonna show you the right way to do this so you can steal this and you can juice up the returns on all your assets. You don't have to pick the right winners. Okay, so the first thing is, this article came out here, and they're talking about homes no longer being the best place for your money. Okay, this came out July 15th of 2026, so just recently, written by Allison Schrager. Shout out to her. Go ahead and tag her in this video so she can learn something here. Now, she writes this column on Bloomberg, like an authority on financial topics, apparently. She's a senior fellow at the Manhattan Institute. Senior fellow, Manhattan Institute. Serious credentials. Author, multiple times author. An economist walks into a brothel. I don't know what that means. Other unexpected place to understand risk. Okay, understand risk, whatever. Okay, a senior fellow, Manhattan Institute, writes for Bloomberg, all these different things. And you would think you could trust the information, but let's just go through this for a second. So she's making a claim that houses are not the best place for money. So first of all, I would say that owning your own personal residence is not a very good financial decision. There's a million reasons why you buy your own personal home. It's not the best financial decision, so I might sort of agree with her on there, but she's dead wrong. I'll break it down why. But let's just talk about owning homes, owning real estate in general. Okay, so what she got wrong here is she talked about comparing home returns versus the stock market. Okay, so this is an excerpt from the article here. She's using, and I'm gonna use her own article, the median home price in Nantucket, Massachusetts. This is not like the median home in the United States. This is a very elite, what I would call trophy asset location, Nantucket, Massachusetts. And she said that the median home price in Nantucket is nearly $4 million today, nearly $4 million for the median, and it was $500,000 in 1995, 30 years ago, right? This sounds like a stunning increase in one of the hottest and least accessible real estate markets in the world, so one of the hottest markets in the world as she's talking about. So it sounds like a stunning increase from 500,000 to 4 million in 30 years. Amazing, right? Well, maybe, maybe not, because she goes on. In the article, she goes on to say that, well, it's not that good, because while that sounds like a stunning increase, maybe it's not, because what's even more stunning, she says, is the stock market. The stock market's way better, apparently. If you had invested the same amount of money, the same $500,000 into the S&P 500 index, just put it into the index, not real estate, in the same time period in 1995, you'd have more than 8.2 million today, even more if you had reinvested the dividends that you had earned. Okay, so what she's doing is she's saying, hey, look, homes are not a good investment. They're not the investment they used to be. They're probably not the best place for you to invest your money, because look, if you put it in the same $500,000 to put into real estate in Nantucket would be 4 million, and the same $500,000 in stocks would be in the S&P 500 would be 8.2 million, about double in stocks. So she seems to be arguing what I'm making the claim in this. It's not the asset, it's the structure. But this is where she gets it exactly wrong. So while her math is correct, she has the complete wrong assumptions. Now, you would think as a senior fellow, someone who writes for Bloomberg, they would understand this, but there's a wrong assumption here, and that wrong assumption is cash. Let me break this down for you. Okay, so the case that I'm making for you is it's all about the structure. It's always about the structure and not the assets themselves. Let me show you what I'm talking about. So what she's doing is she's comparing assets. And you know, I'm a Bitcoin guy. So in the Bitcoin space, you hear this all the time. Bitcoin is better than real estate. No, real estate's better than Bitcoin. But it's doing the same thing. It's comparing assets to assets, but it's ignoring the key piece of the structure. So she went ahead and threw this chart up here. And again, the math is correct. So it's a compelling argument. The American dream is stocks now, she said. The American dream used to be homes. She says it's now stocks. Property ownership is no longer the main way to build wealth because apparently, again, to the case she's making, it's in stocks. And she says the people interviewed, and again, be careful who you let speak into your life, because the people interviewed for a recent Bloomberg News story on building wealth said that the stock market is a better bet. Whose information are you going to take? I'm just going to take some random people's opinion that talked to Bloomberg magazine. So they said it's a better bet. And this chart shows you the blue being real estate and the black being stock market. So you can see it had a lower entry price here and it ended up higher here. So it outperformed, right? From, what is this, 2011 through 2026. Okay, sounds pretty good, but that's only part of the story. Now, I love this part. I have to bring it up. What she says here, because she mentions the key piece, but then she completely disregards it. What does she say here? She says the U.S., so granted, if you're in Canada or Australia or Europe, it's not as good. You still have this as an option, so don't turn the video off yet. But in the U.S. encourages families to buy, and so they do that by putting policies into place, incentives. The policies include mortgage interest tax deduction. So I talk a lot about how taxes are not punishment, taxes are incentives for us to do things. So if you buy a piece of real estate, you get incentivized with mortgage interest tax deduction and other subsidies. So like the government sort of owns a lot of the mortgage companies, they'll push the rates down, things like that. That make up here's what she says, financial abomination of a 30-year fixed rate mortgage, and a financial abomination. Now, if you're in Australia or Canada or in Europe or whatever, do you wish you could get a 30-year fixed low interest rate mortgage? If so, drop that in the comments down below. She calls it abomination. My guess is the whole world wishes they could get it. And what she says here is stock returns trounced those from housings, trounced, did double, right? 100% better. Okay, so again, the error in her ways, financial analyst, a senior fellow, her error is that she compared assets to assets. But again, it's the structure in which we buy them. Here's what we mean by that. So for example, if I have $500K that I'm investing, yes, I can put that into a home, or I could put that into stocks. So I have 500,000 of each, and the home went up to 4 million and the stocks went up to 8 million. Okay, but that's not how you buy, because to the point that she's making, the abomination of a 30-year mortgage. And what that allows me to do is it allows me to take my 500K and get a 30-year mortgage, which means I could put 10% down. I could put 20% down, sometimes even less, sometimes 5% down. Let's use 20% as a number. Now my $500,000 would allow me to buy $2.5 million of real estate, or it would allow me to buy five $500,000 homes. However you want to look at that. So I'm not buying one for one. I'm going to buy 5 homes or one $2.5 million home. Okay, makes sense. So now what does that do to our numbers? If I could buy a $2.5 million home or five $500,000 homes. Well, let's just take a look real quick. I'll readjust the math so it's a real apples to apples using her 30-year abomination, of course, the mortgage. So if we had equal capital from 1995 to 2006, same time frame, we're going to do the same amount of money, the same $500,000, 31 years, and we're going to use the exact same market. We're going to stick in Nantucket. Okay, here's what we're talking about. So we deploy it in the S&P 500, 500,000, or real estate. But again, I'm using leverage, so I have $500,000 down payments. The mortgage on the S&P 500 is none, obviously, because I paid cash. Over here, I have $400,000 of debt. On the value of 2026 only, I have about 8.2 million. So 8.2 million, that's what the stocks are worth 31 years later. The real estate, though, because of the leverage, is worth $20 million. So you can see how it starts being different. Now, the value of 2026 total return would be about $12 million. If I had reinvested all the stock dividends, and on the real estate, I'm still at about $20 million. So what you can see is a big difference. After tax returns, well, then the stocks, in order to get the liquidity, I'm selling it. So now I have tax owed on exit, $2.6 million on tax. So after tax returns are 8.9, or let's call it $9 million. Where over here, I have reinvested net cash flow because it's a rental property. I'm reinvesting the income that comes into it. I'm not going to exit it because with real estate, I can 1031 my tax into another property, which means I have 21 million after tax. So instead of 9, I have 21. It's a pretty big difference. And it's just as simple as looking at I'm using the abomination of the 30-year mortgage as she called out. Again, I don't know how our senior fellow Bloomberg writer misses this, but again, be very careful who you get your advice from. Okay, let's take a look at why this works and how you can steal this, okay? Because it's not just about real estate. So there's 4 components of the structure in that deal. the difference of the real estate deal versus the stocks. Okay, so number one, we got the leverage. So the leverage is the abomination, the 30-year mortgage. The leverage is the debt, the margin that allows me to control more assets with a little bit. So with $100,000, I can control a $500,000 property. With $500,000, I control a $2.5 million property. So number one, leverage. Okay, now the beauty of the leverage, especially the 30-year abomination mortgage, is I get fixed debt for 30 years. So I locked in some loans that were around 3% a few years ago. Today, they're about 6%. But even at 6%, we have the cost of living going up at 10% a year. But imagine over 10, 20 years, what that payment becomes over time. So I get the benefit of inflation-destroyed debt. So the leverage partially gets wiped out by inflation, which is, of course, why the government wants so much of it. Okay, second, I get income. What does that mean? The tenants of my real estate property provide income, and they're the ones paying down the debt for me. So yes, I took on debt. I used leverage to do that so I control more asset, but someone else pays it for me. When I bought the stocks, I just bought them. I owned 100% of them, but there was no leverage and there was no one giving me additional money for that. Number three, I get depreciation. And depreciation, what happens with that is back to those tax incentives that she talks about, how terrible those are. The tax incentives allow me to now write off part of my income, keeping more of my hard-earned money. Now, if I take some of that hard-earned money that I would typically give to the IRS at the end of the year, and I get to keep it, and I get to reinvest that over the 30-year loan, then that really increases my returns. Then I get appreciation. That means the property goes up in value over time. The median U.S. appreciation number is about 5% right now. Obviously, a trophy property like Nantucket is going to do much better, but it's market by market. The U.S. is about 5%. Okay, and again, that's Nantucket. So that's four components: the leverage, the income, the depreciation, the appreciation. 4 buckets. But the question is, if that's the structure, and that's what makes real estate so much better than stocks, again, when we compare them apples to apples, the stocks perform better. Compare them to apples, Bitcoin did better. But if I can use the right structure with the real estate, it outperforms by a long shot, more than 4 times, about 5 times better. So the question is then, how do you use a similar structure for other assets? How would I use that for the S&P 500? How would I use it for my Bitcoin? And things like that. Well, as I said, it was never the asset, it was always the structure. Now, the thing with real estate is that real estate has it baked in. It's built in, right? Most people already know this, especially for the United States. Most people know this. You don't think about paying cash for the home. You're going to get a loan. Most people think the way to build wealth is with rental properties. You don't think you have to save all the money to buy the rental property cash. You're going to use a loan. And the baked in part, the government abomination mortgage, but the tax depreciation incentives, right? The income that comes from the tenants, all those things, it's all baked in. If we want to apply to other assets, we have to think about pushing it forward, have to build it on our own. Hey, by the way, real quick, if you want to know more about how we structure an entire portfolio to outperform traditional buy and hold assets, I am having a live workshop, and I'll put a link down below. It's a free workshop. I'll go through all the charts. I'll explain to you exactly how you can do this across all the assets, and most importantly, I'll go into a live Q&A so I can answer all your questions live, because I know you'll have about 1,000 after this. So there's a link down below. I'd love it if you come hang out with me. It's going to be super fun. Check it out down below. But if you want to understand more about the structure, again, because the government pre-installed it on real estate, how do we build this out for ourselves? Okay, so here's how we do it. We'd use the same 4 components. Again, we have the leverage, the income, and the depreciation, and of course, the 1031 exchange, or the never sell, never pay taxes. Okay, so again, in real estate, it's baked in, but let's say that I wanted to apply it. We'll just jump to Bitcoin, my favorite asset, and let's talk about how we could do it there. Now, what most people think is that, oh, well, what Mark is saying is I should get leverage on my Bitcoin and I should buy more Bitcoin. That sounds really risky because it's super volatile. And what if the market... That's not what I'm saying. The beauty of using leverage on real estate is I get a 30-year fixed loan. There's no volatility, there's no margin calls. I have 30 years. And sure, home prices go up and down, but over 30 years, most likely that home will go up. That's the beauty of that. Also, the interest on that is tax deductible. So what we'd want to do is we'd want to use leverage on one asset like real estate, a 30-year fixed loan, non-callable, and I could use that leverage over onto Bitcoin. Okay, so now we are using debt, but not on the volatile asset that can swing 30, 40% at a time. We're using it on a traditional asset like real estate that most people feel comfortable doing it. Okay, then what? Well, then what about income? Yeah, but Mark, the problem with Bitcoin is there's no income. It's just an asset. It's like gold. Now, certainly you could like loan it out and earn some yield on it. I highly recommend do not doing that. But again, if I use the real estate with my Bitcoin and I leverage the real estate, which gave me the 30-year fixed loan, the real estate is also producing income. So the income from the real estate property is now paying off the debt that I have over here on the Bitcoin. Same thing. It's the income. I'm importing it. I'm importing the income from one asset to another. What about the depreciation? Because you certainly can't write off Bitcoin. Bitcoin is just an asset. Well, I can get the depreciation from the real estate property for sure, but what I can also do is I can buy Bitcoin mining equipment. Mining. And the Bitcoin mining equipment is equipment. It's computers. And I can use 100% bonus depreciation on that and use that depreciation to cancel out my taxable income. And then finally, the last one, the 1031. So with real estate, I don't have to pay tax. Unlike the stocks, I have to pay tax when I sell them. But with the real estate, 1031 allows me to roll the capital gains over so I don't have to pay tax. Well, the original 1031 is you just don't sell. So over here, we don't sell, buy, borrow, die, and we access liquidity against the asset without having to sell it. So this is the benefit of using structure together with multiple assets. And then I could walk you through with stocks, I could walk you through with gold or any other asset that you want. We don't have time for that. But you understand there's 4 parts to structure, but the key piece here is it's not all within one single asset. It's how do I get all of the different assets that I have in my portfolio to work together in one structured way so they can all benefit. This way, I don't have to be watching Twitter and Reddit all day. I don't have to be on YouTube videos chasing crypto pump and dumps and penny stocks. I don't have to be option trading till 3 in the morning at night. You can just buy regular traditional assets, put them into the correct structured, and you can get outsized returns like I've seen. Okay, and really where this comes in is something you hear me talk about quite often, is most people, when I say most, I mean almost everybody, except for the 1%, let's call it the 99%, what they do is they invest horizontally. So they have their $100 and they're gonna put their, 30% into stocks, and they're gonna put their 40% into bonds, and they're gonna keep 20% of cash, and then maybe they'll take 5% of their portfolio and they'll do some moonshots. So I'm gonna get into the SpaceX IPO, which by the way is down like 50%, but I'm gonna get into some of these moonshots right here. But even if those hit, even if you double this, it only increased this tiny little piece of your portfolio. And when you average out those returns, it barely moves your portfolio forward. The structure that we're talking about is different, where what we're doing is we're investing vertically. So now $1 is being deployed over and over and over. So instead of averaging out, I get the benefit of multiplication. And so that's why it's not the asset, it's the structure in which you hold them. Just like real estate, break it down into the 4 parts and think about how you can apply it to every other asset you own, because this is one of those things like once you see it, you can't unsee it. Now, if you want me to break it down in more detail, because there's only one of 3 engines that make up what I call a wealth operating system, so you can stop living off income and live off assets instead, into this wealth flywheel that just builds assets faster and faster and faster forever, you probably want to come to my free workshop. I'll put a link to it down below. It's going to be super fun. It's all live. I'll break all this down. I got all kinds of charts and graphs. And the best part, we hang out, answer all your questions live to make sure you get this and you can apply it. Again, grab the link down below. Limited spots. I can't have everybody in the world on there, but I'd love to see you. So check that out and think about that structure. How can you steal it? As I always say, to your success. I'm out.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today we're going to be talking about strategy yet again. I know, I'm very sorry. It's pretty much all what I've been talking about lately. But I ran some analysis on the channel. I literally plugged in all of my YouTube history into AI, and I found that I get like 35% more views when I talk about strategy. But at the end of the day, I am the Bitcoin Wizard. I love Bitcoin too. You know, I cannot ignore that fact. You guys let me know what you want to hear. You are my audience. I want to take your own feedback. What do you want to listen to? What are your content ideas that I can take and make into content for you? Let me know down in the comments below, please. Also, please do me a favor, hit the thumbs up button, the like button on YouTube. That really helps the channel. And if you are not subscribed, please hit the subscribe button. It really helps the channel. So today we're going to be talking about the path to $1,000 MSTR because still, I am giga bullish on this company. In fact, I do believe it will be the most valuable company in the entire world. That is because I am giga bullish on Bitcoin. Therefore, the company with the most amount of Bitcoin, they should do pretty well. And I know that $1,000 MSTR really seems like pie in the sky for a lot of people, as well as even $500 MSTR. That seems pie in the sky for a lot of people too. Obviously, depending on what your cost basis is for MSTR, you know, that is kind of your emotional anchor. But I do believe that right now the stock has been massively de-risked. The premium is pretty much close to being all gone. But right now the company is an absolute fortress and they are doing incredibly well. And I know some of you might say, Adam, the stock is down 80%. There's no way that they're doing well. I disagree entirely, so let me tell you about the position that they're actually in. I went ahead and typed up my thoughts earlier today, but I said strategy will be the most valuable company in the world. They owe $4.8 million per day in their dividend obligations and the interest on their convertible debt. Now, that is per calendar day, not business day. But this is the cool part. They have raised $121.69 million per trading day in 2026 so far. So not even counting their Bitcoin stack they have now or their USD reserve that they have now, we need to factor in their access to the capital markets during Bitcoin price stress. And what do we see? We see them outpacing their calendar day dividend obligation by more than 25 times. Yeah. It's literally a 25x. That's what happens when you do that fun division right here. Now, on top of that, we do need to remember that they currently have $53.7 billion of Bitcoin right now. It's about $35 billion in net Bitcoin after the senior claim Bitcoin. But total gross Bitcoin, that's $53.7 billion. And right now, Bitcoin is trading above 3.4% its 4-year moving average. So when I say de-risked, what do I mean? The premium over the common stock residual is almost entirely gone. And then on top of that, when we look at Bitcoin itself, it's barely trading above its 4-year moving average trend line. Now, historically, whenever Bitcoin has been around this valuation level, the median forward returns have been, when you look throughout all of Bitcoin's price history, 1 year, the median return was about 145%, and 2 years, it gets crazy, plus 324.7%. Now, if you would apply that to their current Bitcoin stack, if the median return happens, not saying that it will, but it's the median, not the average. Who knows what will happen? But I would imagine that if you're buying MSTR, you're probably bullish on Bitcoin because it's amplified Bitcoin. But the 1-year value of that median return after that return happens, that would be a gain of $78.3 billion, and their Bitcoin stack would be worth $132 billion. Now, if you translate that 2-year median return forward, that would mean that strategy would have $228.1 billion of Bitcoin, $228 billion of the most liquid transferable asset in the entire world. And remember, this is assuming that they buy 0 Bitcoin. This is just the Bitcoin appreciation on their current stack. So when you crunch the math, the median 1-year return of Bitcoin, applying that to their stack today, that would cover about 45 years of dividend obligations, and the 2-year scenario would be a century of dividend coverage. A century. So they're raising raising capital 25 times faster than their obligations. They're sitting on $53.7 billion of Bitcoin, near one of the deepest long-term valuation zones. And so it's pretty tough to deny that they are in a huge position of strength right now. They have a $35 billion net cushion of common stock Bitcoin still sitting there when Bitcoin is this cheap. So knowing that they are starting from this position of strength as we get back into a bull market upswing for Bitcoin, what does this mean for the MSTR stock price? And how could we expect the MSTR price to be $500 or $1,000? That's what we're going to get into today. I'm going to be breaking down the math with a bunch of different scenarios about what will actually have to happen for $500, $1,000 MSTR. Personally, I love the entry today. That's why I love buying MSTR when it's this cheap. Bitcoin too, I've been buying a lot of Bitcoin. This is my humble opinion and why I love the volatility. When Bitcoin went from 126,000 to 60,000, I literally thought, well, that's cool. I can just keep buying Bitcoin. And then by the time it goes back up to the all-time high, I will have a lot more wealth than I did when it hit the all-time high at the first time. And I don't think any differently with strategy. This is super long-term for me. I want to hold this company for at least a decade of my life. So I'm just going to keep buying because the math we're going over today is killer. So that is where they're starting from. Awesome, unassailable position as far as I'm concerned because I'm a Bitcoin bull. Now let's get into the math. And look, if you've been listening to the Bitcoin chicken, gizzard, lizard, wizard, I'm going to go out on a limb and guess that you already think Bitcoin or MSTR has the chance to be one of the best performing assets over the next 5 years. What if you could get more than half of that upside with your principal protected? That's exactly what my friends at Sovana are building. Every single dollar of your investment is secured by a title-insured recorded lien on U.S. real estate. And then you split the upside with the property owner whose home equity backs your own investment. If you've been waiting for an opportunity to buy Bitcoin or MSTR with also the ability to sleep at night, this could be it. And honestly, what better time to lock in a 5-year position when Bitcoin and MSTR are sitting in the bear market? If you are an accredited investor, please scan the QR code or go to the link in the description to learn more. You can get in line to invest at sovana.io/capital. Also, I want to thank my dearest friends at the Bitcoin Way. If you are interested in becoming a sovereign Bitcoiner, which you should be, because you gotta have Bitcoin as savings. You have to be your own bank, and guess what? The Bitcoin Way can train you how to be your very own bank, where you take 100% self-custody of your wealth to secure your family's financial future. This is a 100% free introductory call. The Bitcoin Way can help you become a sovereign Bitcoiner using only the best open source tools. Scan the QR code or go to the link in the description below. Become a sovereign Bitcoiner with the Bitcoin Way today. So the framework is pretty easy. You guys probably get it by now, but the MSTR return, the MSTR multiple, it's a multiplication question. You take the move in the Bitcoin appreciation, then you take the common equity Bitcoin exposure accretion that happens to you because remember, they're issuing preferred stock and taking out debt to amplify your Bitcoin exposure. So therefore, when Bitcoin goes up, so does your common equity Bitcoin exposure. If you're buying MSTR with this amplification already there, Bitcoin has to go up, this goes up, and also this goes up. So one input, Bitcoin going up, makes 2 gears turn. And that is why you do not need a change in the MNAV to outperform Bitcoin. But obviously the third gear there, the MNAV change, that could obviously help you depending on your entry. If you bought MSTR at a 1 MNAV and it goes up to 2, well, that would be an extra multiplier on top of your entry. It's that simple. Gotta love the math, and we can crunch everything today with a starting point of $95 MSTR when I just looked at the stock price, $63,139 Bitcoin, and the MNAV already back up to a 1.04, which is hilarious because if strategy wanted to, they could just go sell more MSTR shares, raise another few $100 million, and it would be accretive for the MSTR shareholders, whether or not it was Bitcoin or cash. So this is just proving that the model continues to work. The market continues to give the common stock residual a premium. We dipped below 1 a little bit by the end of last week, but they retired that stretch claim. Now the MNAV is back up to a 4% premium, so that's hilarious. And then when we look at the common equity Bitcoin exposure snapshot after accounting for all the senior claims, we can see that you are exposed to 144,374 sats per share. That is the residual in a snapshot. And then from here, we got to take the starting point and what actually gets us to $500 or $1,000 MSTR. We need changes in these inputs here to get our $500 output. Now, I like to include various scenarios for you guys because you can judge what is more realistic to you in your opinion. You know, how much of a Bitcoin bull are you? To me, at this valuation, you guys saw the median 1 year, 2 year returns. So I'm pretty bullish on Bitcoin from here over the next couple years. So basically what I did, I modeled a bunch of 2-year scenarios. So think July of 2028. Now, this scenario, path number 1 to get to $500 MSTR, this is what it will take. Personally, I didn't buy MSTR at $500, but if I did and I did see this math, I would still be buying. My investing thesis is, hey, if you're bullish at the top, you better be bullish on the bottom, otherwise you're just buying high, selling low, which is, not good. So the Bitcoin price goes to 250K. That's what I have as my number 1 input. My second input, they don't issue any more stretch. The stretch ATM never gets turned back on over the next 2 years. Do you think that's realistic? And then the terminal MNAV is a 1.04. So what does that mean? That is the today's premium. Now, funnily enough, what does this do? This actually gets you $500 MSTR. You can see the breakdown right here, the Bitcoin appreciation, that gets you plus $282. And then with the amplification, your common equity Bitcoin exposure goes up, you get that accretion, an increased residual claim of the balance sheet, and then that means that adds $125. And then I do have a minus $2 and a very slight MNAV change because we did have a third decimal place there of the MNAV looking at it today. There you go, $500 MSTR. Strategy does pretty much nothing, and then Bitcoin goes up to $250,000 and your investment more than 5x's from here, which is pretty cool because a 5x in Bitcoin would be over 300K. Strategy does nothing. With that embedded amplification, you already outperform Bitcoin considerably on the way back up. Strategy is sitting on their hands, no new capital, they don't have to do anything. Also, this is them selling 0 MSTR shares to buy Bitcoin, except they do sell MSTR shares to pay for the outstanding dividend obligations. So that is baked into every single projection today. They are selling MSTR to pay for the dividends. I went ahead and kept that consistent. They're not selling Bitcoin. So the basic shares go up, but as you can see, your common equity Bitcoin exposure accretion, it really outweighs the dilution cost of servicing those senior claims. It works out, provided the fact that Bitcoin goes up, of course. Now, this is a bit more balanced. Path number 2, this is another way to get $500 MSTR. Let's say that Bitcoin doesn't go to $250,000. Let's say it only goes to 200,000. So it's a bit more bearish on the median return over 2 years, but I am assuming that they did get the preferred stock issuance turned back on, and I only put them at issuing $6 billion of STRC. To me, this is still pretty bearish because Bitcoin is going up in this scenario. And remember, 2025 was a down year for Bitcoin when Stretch was in its infancy, and 2026, obviously you guys know, also a down year for Bitcoin, Stretch in its infancy. I think Stretch might be 1 year old as of today. I think it might be Stretch's birthday, but they issued about $10.5 billion of it in year 1. This scenario would be them issuing $6 billion of it in 2 years. So a dramatic slowdown in the pace of STRC issuance. And remember, still not issuing any common stock to buy Bitcoin. In this scenario, they would actually only buy 52,000 Bitcoin over 2 years, which is a huge slowdown from this year. And I do have the MNAV going up to a 1.3 because I think probably that might be a good guess if Bitcoin actually went up to 200K. Who knows what happens with the terminal MNAV? There's no such thing as the terminal MNAV actually, because it will always oscillate. Who knows what it will be at that exact point in the future when Bitcoin is 200K. But this is the breakdown of the $500 MSTR. Maybe you think this is a more realistic scenario. Bitcoin's appreciation going up to $206, $99 for the CEBE accretion, and $100 for the MNAV change. Now, I actually think this MNAV might be conservative. Maybe, I don't know. It's tough to know, obviously. But 2 months ago, we had Bitcoin at 83K. Remember that literally 60 days ago when Bitcoin went up to 83, 84K and the MNAV of MSTR went up to 1.25? This is 200K Bitcoin. So who knows what happens, all I'm going to say, but this is yet another hurdle to reach $500 MSTR, really with all 3 engines working together. This requires the lowest Bitcoin price hurdle. And then this is a bit of a more bullish scenario for the Bitcoin price, but I did want to include a premium risk scenario to talk about the risk profile. Because anybody who bought MSTR in the $300, $400 range, you guys know that you probably paid a hefty premium for the stock at that point in time. But this is a situation that proves that if you let the amplified compounding work for you long enough with Bitcoin going up and to the right, it can outweigh the premium compression. This is just the math. In this scenario, Bitcoin goes to 300K. So you might think that's super bullish, unrealistic, but just to account for that, I went back to strategy buying 0 Bitcoin for the next 2 years. I don't think that's realistic at all. $0 of preferred issuance, and the MNAV goes from a 1.04 today to a 0.853. So that's very interesting. This scenario still gets you $500 MSTR despite the change in the MNAV. So in the unlikely scenario where Bitcoin goes to 300K and somehow the MNAV compresses below 1, there's a 15% discount there, and they don't buy any Bitcoin on the way to 300K Bitcoin, that sounds totally ridiculous, but that's what the math tells you. That is also $500 MSTR. So now you can kind of see, wow, when Bitcoin goes to 300K, we are going to get some pretty crazy returns just based on the balance sheet that they already have. So if you are interested in the $1,000 MSTR scenarios, well, let's look into them. What would be the Bitcoin price hurdle required for $1,000 MSTR? Well, let's look at it right here. We have a Bitcoin-led scenario with staying constant at that 1.04 like it is today, them issuing 0 MSTR and 0 stretch at all. So this scenario, I'm just taking away 2 of the variables that lead to the stock price performance. Just the Bitcoin move with the static balance sheet today, we need 478K Bitcoin. To get to $1,000 MSTR, your CEBE would go up from that 144K sats per share today to about 201K. That would make up for $283 of the stock price performance, and then Bitcoin's appreciation would be $626 of the return decomposition of MSTR's return. So if you're super bullish on Bitcoin, you think Bitcoin might go to $1 million over the next 8 to 10 years, and you're wondering, okay, if 2 of the variables here got shut off, what would just the Bitcoin move take to get to $1,000 MSTR? That's your answer right there. 478K Bitcoin, so that's interesting. Now this here to me is still a bit bearish, but this is the balanced path. We see Bitcoin going to 372K, the preferred issuance getting turned back onto that $6 billion over 2 years. Super bearish in my opinion, because this is them acquiring less than 52,000 Bitcoin. And then remember, we are boosting that MNAV back up to a 1.3. And there you go. That gets you $1,000 MSTR right there. So, in this scenario, I think it's bearish because I think they're going to issue more preferred stock. I think they're probably going to issue MSTR to buy Bitcoin. I don't have that factored in. And if I really thought that Bitcoin was going to 372K over the next couple years, I would assume that we would see MNAV expansion beyond the 1.3, considering we saw 1.25 2 months ago when Bitcoin was $300,000 cheaper than this. But anyway, that would be the breakdown. You would get a $200 change in the stock price from the MNAV alone, 238 from that embedded amplification, 467 from the Bitcoin appreciation. Now, if you want to talk about the Bitcoin bulldozer, where we do account for the premium risk, they sit on their hands, they don't buy any Bitcoin at all, the Bitcoin hurdle price would be $577,353 right here. In that scenario, you get $1,000 MSTR, which is more than a 10x from today, with them doing pretty much nothing and the premium collapsing. And then what's really cool is that you would still outperform Bitcoin in this scenario, which is a beautiful thing. And then honestly, I thought about ending the video, but let's just do a bullish scenario because that should be fun. Let's go ahead and load MSTR into the terminal and let's go ahead and crunch some numbers. Let's do one bull scenario for fun, okay? Let's do a 4-year scenario by 2030. They're paying 12% on the dividends and their blended debt interest rate is 0.55. Let's say that Bitcoin goes to 500K in the next 4 years. That would be pretty rad. And then they replicate their year 1 stretch issuance pace of $10.5 billion per year. Now, obviously, that would mean that we'd have to do some math to get the monthly issuance pace, $875 million a month. So let's just assume, hey, stretch gets turned back on. That'll be fun. And they're paying 12, not 13% on that. They're selling common stock to pay for the dividends. And you know what? Let's say the MNAV goes to a 1.5 from today. There you go, a $1,680 MSTR 4 years from now, given those inputs. And still, they're not even issuing any common stock to buy Bitcoin. So that's pretty cool. And they'd only end end up with 1.04 million Bitcoin in 4 years. I think they're going to have that a year from now. So, this is still kind of bearish in a way because, this isn't them matching their 2025 or their 2026 capital raising pace. I'm just saying, this is why I love today's entry because there's hardly any premium. They have $35 billion of net Bitcoin, after the senior claim Bitcoin. And even in this scenario right here, they're outperforming Bitcoin considerably, 17.58x over Bitcoin's not even an 8x. So all I got to say is I love MSTR. I love the entry. Could not be more bullish on the company. My name is Adam Livingston. If you guys enjoyed this content, please do me a favor, like the video, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a terrific day, everybody. Do not party too hard. Class dismissed. This video is sponsored by Sovana, and if you are interested in gaining Bitcoin upside while keeping your principal protected, Sovana may have built the most aggressively bullish product available for people who still enjoy sleeping at night. Yes, you as an investor can receive 50% or more of Bitcoin's appreciation with uncapped upside, while the structure is backed by the Bitcoin position itself and a lien on U.S. investment real estate. Basically, Sovana is putting Bitcoin in body armor. You still get the moon math while your principal has a rental property standing behind it with a baseball bat. If you are interested, scan the QR code or use the link below. Sovana will help you every single step of the way. They will answer your questions and explain exactly how the structure works. Requesting information carries zero obligation or commitment. Go to sovana.io/capital to buy Bitcoin and MSTR with full principal protection. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own, Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Many of the RAs we've spoken to were often struggling to understand the use case of Bitcoin itself or the underlying asset, but the concept of yield is very familiar to them. That shortens the education gap, which is really one of the biggest issues.
I got the first question, and this is for all to debate a little bit. You've got three very different aspects or angles on the same thing. An ETF, an industrial company with BTC Treasury, and an AI platform for wealth. In one sentence each, please. Where does Bitcoin fit in what you do? It is a product, the balance sheet, or the infrastructure? David?
So for us, Bitcoin is one of the assets you can invest in on our platform. And we have 67 digital assets so far listed on the platform. But what we found is in 21 different market regimes of Bitcoin. In 19 of them, buy and hold outperforms most strategies, but in 2 other strategies or 2 other market regimes, we found hundreds of strategies that actually outperform Bitcoin. So it's an asset class for us.
For us, Bitcoin is a separate but aligned flywheel. So our core operating business and our Bitcoin side are both flywheels operating, pushing each other, that are allowing us to have exponential growth and continue the opportunity to grow year over year more and more through operating together in an aligned path.
I'd say for us also an asset class, a store of value. We actually think Bitcoin specifically has characteristics much more aligned with gold than the rest of the cryptocurrency space. And I think, especially in this world, especially in the volatility you see, the geopolitical risks, what that's doing to commodity prices, it can never be just one thing. And so we actually take like a diversified approach against currency debasement, Bitcoin being one of the stalwarts, but we're big believers in gold and anything else that can actually like hold its value and has a constraint on its supply.
Yeah, I understand. Being at Roxham is kind of similar mentality. Since you're talking about that, David, you built BDGD on the bet that Bitcoin and gold behave differently from traditional equities, right? What did you see in the correlation data that justified putting them together in a single wrap? And does that thesis still hold today with BTC increasingly correlated to the Nasdaq in risk of?
Yeah, over a 10-year period, Bitcoin and gold have pretty much a zero correlation now. Ironically, at the moment when you wanted to depend on it the most in the last 8 to 10 weeks, or even longer, I guess since the start of the war, they've been more correlated. And I think that's been a little bit of a random example than the new norm, right? I think gold specifically, the reason why gold sold off during a lot of these geopolitical events was because the economies that have adopted gold the most on their central balance sheets oftentimes were oil importers. So they did the diligent thing and they trimmed the asset that's now a third of their balance sheet that outperformed everything else, and they used it to cover a shortfall. So I actually think what's most ironic is in the last 6 weeks, we've seen stocks and Bitcoin correlation actually drop, which is actually something that should be celebrated. I'm a big believer that, obviously interest rates and oil were affected from geopolitical conflicts. And then the other side of it is we had the biggest productivity growth quarter probably in the history of markets, right, of expectations of forward guidance that's coming from AI. And so you have productivity assets and interest-bearing assets. Productivity assets are getting a lot more productive. Interest-bearing assets were paying more interest. It was kind of the perfect storm against the store of value asset, which is why I think it aligns for a bullish future on both.
Thanks. True as well. David, Mangrove joined Bitcoin for Corporations talking about the move toward digital credit. For a Treasury and wealth audience, what does digital credit concretely mean today? And what infrastructure is still missing for an RIA or a corporation to use it without turning into a crypto company?
Yeah, from my perspective, at least, Bitcoin, these products today are Bitcoin-backed yield instruments. They're typically in the preferred equities or perpetual preferred equities structure, or other structured instruments coming from Treasury companies. And I won't go too much into the technical side of things because we've had some panels just wholly on digital credit today. But the sort of biggest macro implication I see from the issuance of these is you're broadening the potential user base through essentially like an awareness campaign of instruments that those that may have not been following digital assets closely are hearing about, especially with STRC and sort of the growth of that. And as an example, we were at the Crypto Convergence Conference in Dallas 2 weeks ago. There were about 200 RIAs in the audience, and we polled how many RIAs had heard of digital credit before. Very few, but after we hosted several nights worth of dinners, I would say 75% of the RIAs at the end of each dinner were interested in exploring it for their clients. So it's another broader use case structure to help grow the pie around Bitcoin.
And why do you think digital credit specifically is what the RIAs are now putting? I mean, why they were ignoring it before is a question.
I think many of the RIAs we've spoken to, we're often struggling to understand the direct use case of Bitcoin itself or the underlying asset, but the concept of yield is very familiar to them, and that shortens the education gap, which is really one of the biggest issues.
Thank you. Curtis, Giga is maybe the clearest case here, a real traditional business that decided to become a top 5 Bitcoin holder. How is that decision made at the board level? Bitcoin as a benchmark for capital allocation versus simply a treasury reserve, and how do you explain it to a building market client who has nothing to do with crypto?
Yeah, so that's a great question. And we've heard today, and we were just talking about education is a big part of it. But when you talk about it from a corporation standpoint, it starts with personal conviction. At some point, all of us in this room had that feeling of what we wanted to get into Bitcoin for. But when you start talking about it with a corporate level, it becomes a little bit more difficult because you have a board, you have executives, you have a company, numbers of employees. How do you orange pill everybody? And then everybody's going to be orange pilled to a different level if they are, if they're not. And then what is your path? What is your approach? And that's where alignment becomes key. Communication is very important. You need to be aligned as a board. You need to be aligned as executives and have that messaging ready to go. And that also then leads into the second part, which is the governance side, because you need to be aligned on the governance side. You need to know what are your rules, what are your guiding lights, when will you buy, when will you hold, if you're doing other areas, when will you sell, when will you use it to back your loans, what is your approach, what are you looking to do? Because as we've heard today, there's so many different tools and resources out there that you could easily get blinded by the next shiny thing. And so as a company, specifically at the board level, you need to be on the same page, and that alignment is key, and that comes from open communication and aligning that to the direction that your business wants to go in. Do you want to be a pure treasury play? In our case, do you want to have a core operating business? If so, how are they going to interact? Are they going to be separate? Are they going to be combined? What tools, what resources? That is key from day one, and it all comes from open communication.
And out of curiosity here, when you are on a traditional corporation like this and you say, hey, let's bet in Bitcoin, what is the average that a corporation would say, yeah, okay, go and do it, 10%, 20%, do 100%, or what was your experience on that?
So I would say at the traditional level, we're talking an infinitesimal percent, but that's why Bitcoin is not traditional. So with us, we were very fortunate that those of us in the executive team did have the personal conviction coming in, and we were all aligned on the personal side and said, well, this makes sense. Why don't we just do this as a company? So for us, we're definitely non-traditional in our approach on the core business side, on the Bitcoin side, and that's where we're seeing the companies that are coming up now, like everybody in this room, we're non-traditional. We're taking that next step because of the education we have and the belief we have, and we're finding how we can work together to make that possible. So for us, it was different.
An easy call. All, again, debates. Boom. If you had to give one piece of advice to a CFO or a treasurer watching this from the outside, which I think they are live streaming now, thinking this isn't for my industry, what's the first real non-ideological step to integrate Bitcoin without breaking the business that already works?
I mean, we're a little bit biased, but I would say a store of value on a corporate balance sheet is, in our opinion, just never going to be just one thing, right? Like it's the input commodities into your business. It's Bitcoin and gold. I think the evolution of corporate balance sheets beyond the dollar is just in its infancy stages, right? It's ironic you're seeing companies do it with Bitcoin and central banks do it with gold and a little bit of Bitcoin, but it's truly going to be a basket, and thinking about it in a percentage sense and allows you to unemotionally take advantage of those divergences. But there's no store of value without volatility in this world. It's certainly not your savings account. So.
Anything, David?
I think from a CFO perspective, realizing more broadly, this is a step change in like technology adoption, and we're coming from a technology background, and it's something that you need to start learning or leaning into now, whether you have a little bit of education, no education, or a lot of education around it, because it's as big of a step change as going from snail mail to email. And if you are not operating with the email technology when that's around, it's going to be very hard to compete with other companies that are. And it's a similar state in terms of looking at Nokia as the iPhone 3 is arriving, where there's just sort of core fundamental differences in terms of the transparency, the distributed ledger, and the proof of work concept that it's very hard to replicate in other formats. So I would just encourage that this is an inevitable wave that's coming, and we're still very early. So the sooner you start trying any of the products in and around Bitcoin and or the underlying asset, just the better off you're going to be in the coming years.
Curtis. Well, you mentioned already, but
yeah, I think one of the big things is, and the panel before the break talked about this too, is showing also to the financial side as well, how your Bitcoin can work for you. So it's not just so much what is Bitcoin, but what can it do for you? And utilizing that is going to be key, because we would all love to hodl, and we do, but as they mentioned in the previous panel, the battery and holding that energy source and never using it is worthless. So when you're talking to your CFO, you're talking to your finance team, and you're getting them on board, it's what can it do for the company and how can you use it? That's a big factor.
Thank you. And last question again for debating a little bit. On this stage, I mean, everyone on this stage has a commercial reason to be bullish on Bitcoin, right? I guess we all want Bitcoin to go up, otherwise please leave the room. So play the devil's advocate against your own business for a second. What's the strongest argument a skeptical CFO could make against what you are each selling, and why are they wrong?
To start, I would think many CFOs we've spoken to are less familiar with the product, just don't understand the use case. It's a sort of very fundamental mismatch of understanding. And as some panelists spoke earlier, you have the cross-border payments, you have the sort of sovereign and currency protections, you have the transparency, and the evolution of more of these digital credit instruments or other Bitcoin-related products will just open up the potential first use case for CFOs or and portfolio managers. And so I think realizing there's not just one first way to get exposure to the asset class. There's a small but growing number of options. And so don't write off the entire asset class because the first one or form factor that it takes when you're presented with it doesn't make sense with your current business operating model or investment mandate.
I think another part to that is where your company is at in your growth cycle. Are you a young company? Are you growing? Are you stable? Are you a startup that needs cash or needs some sort of basis? That's going to be a lot different. You're going to be looking at different resources and assets and different ways to get into it. Are you a company that is more stable, that is looking to park some money to grow longer term, that you want to hodl? Well, okay, now you're going to be looking at different resources and tools. So a lot of it also comes down to where is your company at in its growth cycle and where do you want to go to? Because as we've heard, there's something for everybody out there, and there's new things coming up every day as we hear. And it's not about jumping into the deep end and just going out, buying and self-custodying your own Bitcoin. There's different tools to dip your feet in, to get them wet, and then depending on what level of volatility you're comfortable with or you can as a company be comfortable, that's going to drive you in that direction. And I think that's often where some folks might be a little bit blind to it because there's too much, they're too scared, and they're not familiar with it.
Obviously, our clients are more in the financial advisor and retail space, but I think it's a similar problem of like, what is your risk-off allocation, right? It used to be a broad bond index. That's not it. We all can feel cash in our savings account losing value every single year. And so I think finding the right mix of assets that will protect your revenue streams that will come with some volatility, right? And I think, as you said, your board has to be aligned on that. But whether you're an individual investor, an institution, or a corporation, just recognizing that the one thing that's certainly losing money is that one thing that's not moving in your account, which is cash, and just really expanding your mindset beyond that.
Good. Thank you, the three of you. We have planned some questions. We are done with the questions. So for the last 3 minutes, I'm going to ask you to give your last sentence on, especially knowing where we are standing in in the market at this moment. What is your view, not price related obviously, but what is your view for the next 6 to 12 months on Bitcoin? What should happen or what will happen for you?
I imagine I won't make any price predictions, but the continued structural level adoption from institutions will keep taking place. The publications from these firms, the distribution through their wealth advisory channels will start to bring Bitcoin more into the mainstream. And really doing these surveys at that RIA conference was just very eye-opening in terms of how far we have to go to keep spreading the word about Bitcoin as an underlying asset or these products around it. And I would suspect that trend will continue to rip out to the sort of next concentric circle out of clients over the next 12 months.
One thing I would say is, and this is just one piece of experience from our side, because we've been through a couple of different cycles as well, it's to not let it become a distraction. Whether you're just formulating your approach, whether you're further into it, whether you're much further into it than others and you felt some of these cycles, is not to let it be a distraction. Yeah, we all have that tendency to pull out our phones every few minutes and take a look and see, is it popping yet? But I do see that we're going to still have some volatility, but I think those of us who've been in a little bit longer know it's okay, it's coming, we're going to get back to it. I think the biggest part, especially for the corporate level, is to not let it be a distraction. Hold strong, hold steady. We're going to rebound. We're going to be jumping back up. I'm not going to give a price prediction, but we're definitely going to be better off than we previously were. We just can't let that blind us from the path that we need to go through.
Yeah, I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. These are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so okay, I'm a Morgan Stanley advisor, we just launched our own Bitcoin ETF, there's going to be a wave of slow adoption. But I think you're going to really have to that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated. And it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Great, time is over. So thank you, David, Curtis, and David, and thank you all for being listening here. And yeah, you can contact them everywhere. And thank you.
The European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income is very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network, a true extension of the internet? AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats in the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold, a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
But we're excited to integrate Bitcoin into the traditional market and open up more choice for asset owners, for Bitcoin holders, and for the broader market in general.
Great, so Ishan, let's get right into it. What is an ADR? Let's level set here with the audience.
Yeah, so maybe before getting into what an ADR is, I'll just give some historical context on the idea of a receipt. So the idea of a receipt has been around for hundreds of years, going back to the 1600s when goldsmiths would hold gold on behalf of customers and give them a receipt that gave them a claim to that gold and allowed them to basically feel comfortable kind of holding that gold, which then eventually opened up trading and kind of like founded the modern banking system. 100 years ago, so a little bit more recently, but still quite in the past, an ADR was the first kind of receipt that basically connected equities across markets. And the idea was basically letting US investors own foreign stock in a US brokerage account without having to worry about setting up a brokerage account in a foreign country, without having to worry about regulations in a new country, or worrying about mandate restrictions. And that product has blossomed, and it continues to be a product that's used today to connect markets and bridge markets. So with that context, we had the idea that the ADR should be innovated to the next evolution of the product, which is to bridge an asset like Bitcoin that, whose time has come, which needs to be integrated into traditional finance, which needs to have the ability to be used in the traditional finance system through this wrapper, which is the ADR. And so that's what we've done. We've effectively wrapped Bitcoin directly into an ADR, which connects the two markets, which lets asset owners that own Bitcoin hold it as a stock at a brokerage account while continuing to own the underlying asset. And so while they own Bitcoin and they hold it as a stock, they can leverage it for all the utility that a stock gives them. But they also have the choice to go back to the underlying. So it's not like they're giving up ownership of the underlying. This also opens up the asset to the traditional market to a lot of investors who don't have the ability to hold Bitcoin directly, and we'll be talking a lot about that. But we're excited to integrate Bitcoin into the traditional market and open up more choice for asset owners, for Bitcoin holders, and for the broader market in general. So that's effectively what the ADR is and what it's done for Bitcoin.
And maybe to expand on that, Ishan, the number one question that I receive when we talk about this with people is, what's the difference between the ADR and an ETF? Like, can you explain why the benefits of a DR versus, say, just owning the ETF in your brokerage account?
Yeah, absolutely. I think when you think about an ETF, which is a fund that helps investors get exposure to the underlying, it's obviously been a very effective product at bringing investors the ability to get exposure to Bitcoin without having to deal with being on chain, if that's difficult for them or if that's a challenge for them. But I guess the difference here is with an ADR, when you buy an ADR, you have a direct claim on the underlying Bitcoin. You're not buying equity in a fund. You're not relying on a trust. You're not relying on a third party to manage your Bitcoin for you. It's still your Bitcoin. It's just being held in a more convenient wrapper for you to use it in the stock market. It's also a product that you can redeem directly into the underlying Bitcoin for. So it's not limited to authorized participants or certain banks or brokers who have the ability to access the underlying or have the ability to touch both sides. It's open to everybody. So any asset owner that owns Bitcoin can deposit that Bitcoin with a custodian. We would issue them an ADR in their brokerage account. They still have claim on the underlying asset. It's still their Bitcoin. No one else can control it or touch it. And then they can use it as they'd like. They now have the choice. They can hold it as a stock. They can redeem back for the underlying. It's completely open. And that's kind of what we want to bring to the market: more choice, more optionality. The Bitcoin always stays in custody. There's no movement of Bitcoin. Nothing is being sold to cover expenses like you would in a fund. The idea is that your ADR is a direct claim on specific units of Bitcoin that stays fixed regardless of the price action on Bitcoin or on the ADR. So it's a product that allows you to continue to own the underlying, to access the stock market, but also have the choice to come back whenever you want. And so that's kind of where it differentiates from, say, a fund or an ETF.
Yep, no, appreciate that. Dave, can you talk a little bit about the prime brokerage benefits perspective on a potential Bitcoin DR?
Yeah, sure. I think there's a couple of key use cases that come out with this. Number one, that I would say, kind of going into the DR structure versus ETF, there's definitely room for both, but they allow for different things. And I think one of the most interesting unlocks that we have been talking to clients about with the depository receipt is that funds like an actively managed ETF or a mutual fund fall under the Investment Act of 1940. And one of the rules, which is 12D1, limits the amount of other funds these vehicles can own. And so if you take something like an ETF, the 1940 Act rule says, well, you can only have up to 5% of your underlying exposure in another investment vehicle. And you're limited to 10% overall within your fund of owning other fund vehicles. And so if you take a look at like a ETF versus a depository receipt, this depository receipt doesn't fit within that investment vehicle framework because, to Ishan's point, it's a physical representation of the underlying asset. And so we see and have been talking to a lot of customers and prospects about the ability for actively managed ETFs, mutual funds, even passive ones, to be able to own more Bitcoin through a depository receipt framework. And so that, I think, has been like an overall theme that we have seen. Outside of that, also, there's been a lot of customers as ClearStreet continues to build out the digital offering. We have a lot of customers that have been calling and saying, I want to be able to hold my crypto at ClearStreet. And it gets an interesting conversation around rules of what you can hold in a broker-dealer versus a non-regulated entity. But one of the more interesting things that comes out about it is that owning crypto in the traditional rails allows for better margining, cheaper financing potentially, securities that end up being eligible for repo markets. And then also, like on some assets, you get paid to hold them at your prime if you make them eligible for SEC lending. And so there's a handful of key use cases. And I view the depository receipt, like one of the key themes. I've been in crypto for 11 years. One of the key themes that everybody talks about is interoperability, right? And I feel like this is a great structure of interoperability between the crypto world and the traditional world, because as more and more traditional firms want to get in, there's space to hold the underlying spot, but this allows it to seamlessly integrate with the traditional financial rails and provide a number of different benefits and unlock new use cases.
And progress is already being made. David, if you can talk a little bit about the announcement that ClearStreet came out with today between all three of our organizations.
Yeah, we're really excited to do it. And kind of going back in history, Ishan and I have been working on this for the better part of the last 3 years. And so very excited to come out with the press release this week on executing the first DR transaction in combination with UTXO and GTS securities. And you know, what I would say overall is it's generated a lot of inbound. ClearStreet's clients are primarily traditional institutions. And a lot of people are coming to us asking us, how do we hold this asset? What is it? What are the benefits? What are the underlying use cases? And I think it's been really interesting across support, both from people internally that are asking questions, like folks on our risk team about how could we effectively margin this security? How do we provide more benefit to our underlying customers? What does the liquidity profile look like, right? Because they're going to look at it from a risk perspective. Clients are asking us particularly about the 1940 Act rule. Does this unlock us to be able to get more exposure to Bitcoin if the market is telling us that that is what we want to do? And so I think the amount of inbound, obviously, particularly with everything that's going on in New York City this week, has been awesome. And there's a lot of questions, but people are looking at it, particularly those that are coming into crypto now as a potential solution to solve a lot of their underlying issues with holding crypto in the more traditional sense and worrying about all the underlying wallet infrastructure and security. This gives them direct access to something, and they can hold it in a prime broker or broker-dealer account like at ClearStreet.
Anything to add to that, Ishan?
No, I think just at a higher level, the product so far and what we've been talking about in terms of what's out there is so far has been restricted to being kind of institutional only, limited to accredited investors and up. And that's just the nature of the fact that we're innovating something. And so, you know, the regulatory setup wasn't really there to go beyond that. But what's exciting is, you know, we now have a path to expand this product so that everybody can access this. And so we're in the process of registering and listing this product on a stock exchange, opening it up to the broader market, letting every Bitcoin holder and future Bitcoin holder through the ADR get this access. So that's what's exciting. All these use cases that are being opened up really help a broader market coming into the space and helping the Bitcoin sort of ecosystem grow, because at the end of the day, the idea is not just to give people exposure, but to actually own the underlying, which is really in line with the ethos of Bitcoin. So that's what's really exciting about this.
Yeah, and I think one more thing to add, like particularly when talking to more of the folks that have been in the digital space for a while, you know, I think BitGo came out with WBTC a long time ago to make Bitcoin be able to be utilized in Ethereum-based DeFi applications. And so when having conversations with a lot of customers or folks that are in the crypto community, a lot of those folks are now looking to also get exposure to publicly listed equities that are related to the crypto space, or AI, data centers, miners, et cetera. It all kind of goes together with emerging a frontier technology. And this opens up use case for Bitcoin to be utilized as collateral. But going back into like the WBTC or CBBTC scenario, that effectively took Bitcoin and put it on an EVM compatible chain. This is effectively putting it on the quote unquote TradFi DTCC chain to make it compatible with the traditional ecosystem.
Yeah, we're going the opposite direction. We're taking the best, in my opinion, crypto asset, digital asset, moving it from a digitally native on-chain to now within TradFi rails, where you can access potentially traditional margin options, all the other benefits you have for having a security in a brokerage platform. And yeah, we were really excited to work with both RDC and ClearStreet on this transaction. I mean, effectively what we did is UTXO had Bitcoin, we did a create through RDC, and then that DR was with ClearStreet in our prime brokerage account, and then did a trade through the DR. And so the proof of concept worked very, very well. And the first of hopefully many more steps and progress along the way of this journey. I want to circle back and just level set a little bit more on, obviously to your point, Ishan, that the ADR has been around for 100 years plus. Why is Bitcoin uniquely, in terms of its value prop, kind of a glove fit for using the DR wrapper? Like why could this potentially be a big idea versus other foreign stocks or gold or other commodities in the past?
Yeah, that's a great question. So I think it goes back to something I said earlier. Bitcoin's ethos is about ownership. It's about choice. It's about people having the freedom to decide what they want to do with their assets. The idea of an ADR is to enable that ownership, is to open up a bridge that lets you continue to own what you own, but gives you choice to use that asset as you'd like without losing that ownership claim. And that's fundamental to what the ADR enables, and that's fundamental to what Bitcoin is. It sort of fits in perfectly in terms of how, you know, the product looks at the underlying asset. And so that's what's really exciting. You also have a lot of holders of Bitcoin today, right, that don't want to give up their Bitcoin no matter what, which is their right and which is something they should be able to do. But they also should be able to monetize what they've earned. And that what they've earned is the appreciation that Bitcoin has given them over a long time. And so the opportunity to be able to convert that Bitcoin into a stock, access traditional margin, traditional funding rails, a consistent source of funding, no risk of insolvency on the lender because you're talking about banks, brokers that are very well regulated, and access to stable funding and access to utility with the ability to go back to the underlying whenever you'd like is something that's fundamental and something that should be available to everybody, which is what continues to get us excited and why we think Bitcoin's the perfect asset for this kind of a wrapper, and this wrapper is here to enable that option for everybody. So that's how we feel about this this fit.
Yeah, and I mean, a couple of things to add. You know, when I was in traditional finance the first time around, a long time ago, I ran an emerging market portfolio. And it was a hedge fund. There's a lot of clients that came in that were asking for separately managed accounts. And when you're running an emerging market portfolio, you're trading in a lot of emerging markets, and it gets quite expensive to set up all the brokerage relationships on the back end to allow for people to have all of this underlying access to all these markets. And so back in the ADR firm, I used to trade a lot of ADRs back then, and we'd go to Thailand and Indonesia, and we'd buy the ordinary shares, and we'd work with Citi or Bank of New York to do the conversion. And that enabled accessibility for a new swath of customers. And we were really one of the first people back then to embrace full portfolios of unsponsored ADRs, and which enabled us basically to buy anything that we wanted and use this depository receipt framework to bring it in and give clients unique access to something that they weren't able to do. And so when I heard about the depository receipt idea a few years ago on Bitcoin, my mind went to the same place. It is enabling people to get access and get more utility out of an underlying asset. And I think particularly right now in the state of the market that we're in, it's really interesting to see all of the progress that has been made over the past couple of years. There's an accelerant of traditional finance coming into crypto. Everybody is talking about how do we tokenize everything and bring it on chain. While that is also going on, and we want to be very, very supportive of that, it's going to take a long time to get to that end state point. And this is really where something like the depository receipt comes in, because you need to be able to seamlessly go from the crypto world into the traditional world and then have it seamlessly move back. And because it is a in-kind create or redeem as an option, people are able to do that and seamlessly move. And whether it's a market maker or a venture fund or an asset manager, that unlocks new utility and seamless integration between the worlds.
Those are all really good points. And even just from our perspective at UTXO and Nakamoto in general, is the fact that you can now educate on the tenets of self-custody and holding the Bitcoin yourself, kind of going in the reverse way, right? If you're a person who is investing in Bitcoin or buying Bitcoin for the first time and you feel more comfortable doing it on your brokerage account, you can first get comfortable seeing how it interacts, how the price moves. But when you're ready, now you have an option to where you can do your own redeem, hold the Bitcoin yourself, and learn about self-sovereignty and learn about all the tenets that we all are here for Bitcoin. And so it's a way, I view it, we view it as a way to orange pill more people into the Bitcoin ecosystem and economy, which is very, very exciting. And so we have about a minute left, but Ishan, David, any last thoughts or comments before we wrap up?
Yeah, just, one way to think about what we're doing here is, as we've been saying, expanding option, expanding choice. And what's great is, there's already so many good products out there that have solved different needs to allow people to get access, exposure to Bitcoin, whether it's the ETFs, the Treasury companies, et cetera. And that's going to continue to serve various investors. And we're excited to have the ADR as now a part of that option set so that people can decide, what's the best path for them. And we're excited to make this a way for this asset to be more mature, a way for this asset to be integrated into traditional finance. And so that's really exciting. This opportunity is great, regardless of what's happening in the market from a price perspective. The long-term thesis is the adoption continues and the ecosystem broadens. And that's what's really exciting, and really excited to be here and talk about this today.
Yeah, and I would just say kind of 2 quick points. Number one, I think adoption, right, is the key factor, right? And we've continued to see more and more and more adoption of Bitcoin in further utility, right? And this is a option to provide different fungibility and use cases within the framework of what BTC represents, as Lauren mentioned. I think the other thing for us as a prime broker, we get really excited about being able to be this bridge between the digital world and the TradFi world and seamlessly integrate back and forth. And this is a unlocking mechanism for a lot of folks, particularly that are managing other investment vehicles or folks that want to use it as collateral and get margin or use it in repo. And so there's a nice unlock mechanism that just happened in a very short period of time that is coming to market. And people are building on-chain. We need to be building on-chain. We also need to be figuring out how to make these two worlds coexist together.
Great way to wrap it up. Well, please join me in thanking our panelists today.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and the work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature screen, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%, despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. You know, these are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so okay, I'm a Morgan Stanley advisor, we just launched our own Bitcoin ETF, there's gonna be a wave of slow adoption. But I think you're going to really have to see that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated. And it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretched dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
You know, I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity, or only to credit, or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion, where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Anytime that you launch a new product into the market is going to stress test you. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now.
Zach, I want to start with you because, Bitcoin is kind of like dog years, where it's like 10 years pass in like 1 year or whatever. But the ETF is kind of like the first OG wrapper launched in 2024. That was like 2.5 years ago, which is crazy. I think that's crazy. But that really kind of brought Bitcoin into Wall Street light, add a lot of validity to the asset class. Why don't you just kind of take us through where we're at now, how you see us moving forward, and just kind of like some of the history of the ETF wrapper?
Yeah, absolutely. So the first filings for Bitcoin ETFs were in 2013, and they didn't come to market until 2024. So 11 years later, a long battle with regulators. Grayscale took the step during that period to sue the SEC. We won that lawsuit. That's why these products came to market. So as the movie title goes, kind of crypto policy and crypto regulatory topics are one battle after another. So we've been through a lot of those battles, and there are more to come. But fortunately, over the hump on the ETFs. We thought that these products would be extremely popular with investors, and I think that has proven to be the case. And the reason is just they're the easy button for Bitcoin investing. There are lots of ways to buy and hold Bitcoin, and there's no wrong way to do that in my view. But if you buy Bitcoin somewhere else, you need to decide, where am I getting that liquidity and what kind of price am I getting the Bitcoin for? How am I holding that? Is that on an exchange? Is it in self-custody? How am I going to do my taxes? How am I going to do the rights of survival? If something happens to me, my family inherits the assets in an effective way. Can I borrow against those assets? In the context of proof of stake networks, how do I stake these assets? So there's lots of things that an investor in digital assets and Bitcoin needs to sort out for themselves. essentially the ETFs package all those solutions into a single instrument, and they just make it extremely convenient for investors. Institutional liquidity, custody, and all the normal uses of your brokerage accounts or your tax advantage accounts that you have with other securities, you have this with the ETF. So they're not doing anything complicated. Of course, there's lots of interesting things that Strive and others are doing that go well beyond this concept, but the ETFs are designed just to give you efficient, effective, safe, marginable, et cetera, all these things, Bitcoin exposure. They're a very simple instrument, and they've been very popular for that reason. Bringing us to the present, of course, the Bitcoin ETFs have come a long way. On the Bitcoin side, we've seen an expansion of other types of instruments, things like covered call strategies that build onto this concept. And then, of course, many other altcoins. The SEC now uses something called generic listing standards for crypto ETFs. We don't have to go through the lawsuit and the 11-year process to get other products to market. We have a set of generic standards. And so Grayscale and other issuers are broadening our platform beyond Bitcoin to Ethereum and Solana, et cetera, et cetera, et cetera, long list of other things. So that sort of brings us to the present. I think wildly successful products, a long time coming. I think an excellent way for any investor to build Bitcoin exposure into a portfolio.
Yeah, well, thank you for your service and fighting the good fight on behalf of the community there, suing the feds. Much respect. Yeah, so I mean, it's really interesting, right? So, like you mentioned, the success of that launch, kind of what it did for Bitcoin as an asset class, getting more exposure. People can get more exposure to Bitcoin. Kristen, you guys have a very interesting perspective, and we talked about how some emerging markets are for the first time launching their domestic ETF products. Walk us through kind of what you guys are seeing kind of outside the US, if that's going to maybe kickstart a little price action here, more demand for these kind of products worldwide.
Yeah, I'm really happy to share with you guys that as an index provider, we're working with everyone globally, and we're seeing more demand from emerging markets than we ever have before for simple Bitcoin ETFs. And this is just regulatory, right? They've been all wanting to do what the US has been doing, but now their regulatory regimes are opening up. But one of the things that I think is interesting that we were chatting about when you think about Bitcoin, there's no what is the price of Bitcoin? It's more like, what did you exchange Bitcoin for, or what rate did you get? And as an index provider, I have hundreds of Bitcoin indices already up and running. And you're like, why so many? Isn't there just one? But they, of course, have different closing hours, the model that you use to fix it, the data inputs. So I'm hearing from a lot of these emerging market asset managers that they want a domestic Bitcoin index. And what that means is they only want us to use data inputs from their region. And they only want data pairs that might be like, if it's Japan, it would be Bitcoin Yen, Bitcoin USDC, and Bitcoin USDT, and that's it. They don't want any other currency pairs to go into that aggregated price. So we're very busy doing these indices right now, but I think that's a strong signal that the rest of the market is coming, and we'll see more pressure or demand on Bitcoin in general.
Yeah, and it's super interesting. I think that's very encouraging. So we kind of have like the basic ETF wrappers. I'm a big believer, keep it simple, stupid. Like I'm a big cold storage guy myself, but arguably the most exciting developments in Bitcoin and finance have been the preferreds, and obviously a hot topic of conversation now. And Ben, you guys at Strive are clearly on the forefront of this, and I kind of want you to help us peer into your guys' thought process of the financial engineering that goes on at Strive. And I don't use that in like a negative context, but I think you guys have really elevated the wrapper game. And maybe you can kind of just touch on how Bitcoin supercharges your balance sheet, the capital structure, the flexibility you guys have over traditional balance sheet or capital structures.
Yeah, what an interesting week to be having this conversation, huh? Anytime that you launch a new product into the market, you know that there's going to be a point in time where the market is going to stress test you, right? They're going to test the limits of the product. They're going to test the faith of investors. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now. So this is a part of this growth process. It's a little interesting because I've never truly considered either of our products through the common equity or through the preferred to be an actual wrapper of Bitcoin. To me, it's a way that we can bring different types of exposures and different type of investment characteristics to investors. So for instance, if you think about the fact that we've got a Bitcoin balance sheet that's got nearly 20,000 Bitcoin on it today, and we've got the amplified exposure, that means that our common equity is going to be highly sensitive to the moves in Bitcoin. So I view it mostly as an enhanced volatility product. That's really attractive to a lot of people that want to take directional bets one way or the other. And what we want is to create the best vehicles for people to express those trades in. So that's what we've done with our common equity. On the other side, there's an acknowledgement that, one, not everybody's found Bitcoin yet. You know, you walk around the streets of New York, you can have the conversation. Most people won't even be able to tell you the issue with the money in their pocket. They've never had the time to stop and think about it. But what we know is that there's always a consistent demand for cash flow. It's a central part of individuals' lives. It's a central part of running a corporation. And so for us to be able to carve off part of the volatility profile of Bitcoin and part of the excess return of Bitcoin and be able to deliver that back to investors in an attractive yield product, you know, I view that as us taking Bitcoin and moving it one step closer to investors where they are today, right? Instead of waiting for them to come to Bitcoin to find out all of the benefits of an asset that you can self-custody, that you can hold, that you can transact with no intermediary in the process, we all know how powerful that is. Most people haven't started the journey. So if we can bring an attractive product out to the masses that provides them day-to-day utility in their life that's made possible by Bitcoin, to me, that is going to help us bring Bitcoin one step closer to them and help them on that journey, to accelerate that journey. Because if the product's good enough for us to issue a product like this into the market, it's probably something that they themselves should want to hold. So that's how we actually see this playing out there in the market, is we have a realization of you have to find the investors where they're at, and that means paying very close attention to what they want. And kind of the trio, if you could really hit the home run in any one of these products, is price stability, right, which is what's being tested right now in the market, high yielding, low volatility, right? Like that's what you're trying to accomplish, and deep liquidity. And when you're trying to do all three, right, that's where the market's got to stress test each one of those. And liquidity right now is the one you're seeing. There's deep liquidity in these products. There has been for a long time. And we think they're just a really unique value proposition that we can make available because we decided to take the step to capitalize our company on Bitcoin, because we can manage the risk as a corporation, right? We can now offer attractive characteristics into the market that it really hasn't seen before.
Well, that's beautifully put. And it's my understanding that, SATA's a daily dividend, first ever daily dividend in U.S. security history. Yeah, well, that's pretty cool. How does that play into like these three legs of the bar stool?
So that was a really big unlock. That's one that we're very proud of. And the reason being, if you think about dividend paying corporations that are out there, only 2% today even pay monthly dividends. You would think in 2026, people would be moving up the frequencies on these because the quarterly dividend really came into play back in 1885. So we still are following a standard practice that was established in the 1800s, which seems crazy. And so being able to unlock daily has a real material impact on how you would expect the security to trade. So if you've got a security that pays one monthly dividend, that means that during that month, there's one date where it's truly economically required to hold the security to get the benefit of the dividend. When we changed over to daily, it means that literally every day that market is open, you've got that day as a record date, that day is a next dividend date, and that date is a payment date. So now it becomes economically beneficial to hold that security every single day and not use it to trade in and out of, right? It could become a landing place for capital. Some people may just find the yields attractive enough that they just want to park, moderate duration capital in there and collect those daily dividends. But you're seeing those dividends hit your account every day, and there's something with investors where that's very comforting, and it's something they've also never seen before. Money markets started getting into that. They had the daily accrual, right? And these are not money market products, but the concept of daily really came out there. It was a daily accrual, but it was still paid monthly. And so this is really the first time where you're seeing that benefit in your account every single day. And we think that's a really big unlock. And it's one in capital markets history that was made possible by a Bitcoin company. And I think that's a really cool thing that we can put that feather in our cap, that this is just one more way Bitcoin has changed the financial services industry.
Yeah, no, huge tip of the cap to you and the Strive team. And I did tell you guys pioneers here. So that's amazing. And, Kristen, one of the things I want to really get your perspective on is just, working the indices business. How are you guys thinking about Bitcoin exposure, and what do your clients actually want when push comes to shove?
In terms of how we calculate it or the wrappers?
Both. So I know we talked about, being wrapper agnostic. So it's like, okay, what do they want to see, and how are you guys helping them see that?
Yeah. Well, I actually just want to say options, a lot of ETFs, mutual funds, like all kinds of wrappers working together. So you have different instruments to hedge with. So I think it's great that we're seeing DATCO companies and ETF companies, perpetuals, futures, all of that on Bitcoin. And then from the indexer's perspective, like I said, it's really interesting that something as simple as Bitcoin, you could be calculating different rates for Bitcoin depending on the wrapper. I'm going to get really technical and boring for 1 second, but for our derivatives clients, they want us to do a time-weighted model. So as you get closer to 4 o'clock or whenever they're rolling, you want the pricing information to mean more. So we do a 15-minute time-weighted look back. For the ETFs, we use a 1-hour simple average look back. So the market makers can make the market between 3 o'clock and 4 o'clock and have a little bit of room to make some money on their own as well. So I just think it's interesting that this one instrument can demand so many different indices or calculations for all the different wrappers, but they work really well in concert together.
Yeah, and it's just a great logical point and explanation, because we're definitely going to get slandered on Twitter because of this title, but it just goes to show, like in real life, people need different sorts of exposure, and that's not a bad thing. And Zach, you kind of alluded this to the beginning, but derivative products, very important, crucial underlying plumbing to financial markets, and we're really kind of seeing a big developments of derivatives within Bitcoin. So you spent the better part of 2 decades in macroeconomics. How are you seeing the derivatives market in Bitcoin developing, and what does that mean in terms of deepening Bitcoin capital markets and maybe some opportunities that's going to unlock in the future?
Yeah, I'll offer a couple things. Maybe I'll just address the thing about the panel or the wrappers being controversial in some ways. I'd just like to remind people that central banks hold physical gold as a kind of national store of value asset for worst case scenarios. And most of those central banks keep it in the basement of the New York Fed in downtown Manhattan. So, the wrapper...
Theoretically.
In theory. I've been down there and looked at it myself. So we know that it is there. So, the institutions like a Grayscale or anybody else is just there to, help people meet their needs. And the wrapper helps people meet their needs, just like the gold in the basement of the New York Fed. And if you want to take your Bitcoin out of the ETF, or take your gold out of the basement of the New York Fed, you're okay to do that, as if the service is not something that you need. The derivatives markets are increasingly very rich. There's been a lot of things going on this front. Of course, I would say the things that are front of mind for me are perpetual futures and the rise of platforms like Hyperliquid, Bitcoin trading on those types of venues, both in perps and spots. All the things that are happening in options market. You have a very kind of strange shape in options market because so many companies are selling calls, covered calls, and a lot of investors are buying puts for protection. So you have a very skewed options market, but just shows the use of these derivatives for all types of different users. And then maybe I'd add prediction markets, or what Hyperliquid would call outcome markets. I think that these will be very popular for retail speculators, in particular on Bitcoin and other things. So a very rich, to Christian's point, very rich ecosystem of derivatives. It just speaks to how far Bitcoin has come. And going back to the macroeconomics briefly, I mean, this is why I remain so confident about Bitcoin, even in down markets, even here at 58,000, 59,000. The thing that still goes up and to the right all the time is government debt and deficits, and these are the things that drive demand for these assets in the first place. So I just sort of, whenever we're at a down market, I just remind myself the core reason that we're all here, which is that we're taking huge risks with our fiat currency systems, and we need these other assets like Bitcoin to provide a ballast to portfolios. And whether they're buying in an ETF or through a variable rate preferred or through a derivative product, they're all good ways to get access to Bitcoin.
No, certainly here. And guys, in our last minute here, I just kind of want to do a rapid fire down the line, starting with you, Ben. Share with the audience one, future, maybe hole in the market that you've seen, financial product or opportunity you're excited about in Bitcoin land.
What I've actually had a lot of discussion around is real estate developers or real estate investors that are finding a lot of value in Bitcoin. And, it fits a lot of the principles that they have in their portfolios today. And as they're watching the real estate market inflate, they're looking for a new home for that capital if they have to rotate it into something else, right? When you see the price of real estate rising and you see the affordability of it going down, right, there's a fundamental disconnect out there. And so I've had a significant amount of conversations with fairly large real estate investors that are looking for a place to park that capital if they sell out of a real estate investment. And a lot of them are finding Bitcoin is the place that they want to put it. So I find that very encouraging.
That is neat. I've actually had a couple of conversations like that too. That was a good call out. Kristen, how about yourself?
We're also building a lot of indices that are Bitcoin, precious metals, also any of the rare earth commodities all pulled together. So I think that's great because it's saying everyone feels like Bitcoin's a core part of some sort of portfolio. It might be an investment as a store of value, or it might be people are starting to think about it like these other precious metals and rare commodities, and they want it all together. So I think that's also a very positive sign.
Zach?
Maybe I'll close by saying I think truly the institutional adoption of Bitcoin ETFs is only right now getting started. When you think of classic institutional investors, pensions, endowments, insurance, sovereign wealth, there's been a couple that have dipped their toe in, but actually it's a still very narrow list. And we interface with all these types of investors, and those discussions, those allocations are all kind of going through that process now, and they see market prices today as a huge opportunity. These types of allocators, the last thing that they want to do is make a foray into crypto and then 50% bottom falls out. They see the drawdown, they see the structural adoption trends and the need for these types of assets and portfolios, and so now you're going to see those allocations, I think, over the course of the next 6 to 9 months or so.
Well, thank you guys for sharing your expertise. Let's give them a big round of applause.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
I think what they do is they wake up every day saying, how can I make my Bitcoin more productive while preserving the underlying properties as to why I bought it in the first place?
So I think the core thesis of this panel is going to be around how to
generate value from Bitcoin on the balance sheet without exposing yourself to some kind of existential risk, right? And the main sources of risk historically have been sort of smart contract, bridging risk, deploying assets on chain, as well as the sort of rehypothecation risk that a lot of firms encountered last cycle with sort of the lending chains that existed in the market structure. So maybe just to start with Hunter, thinking about CFOs and how they approach drawdowns, right? Obviously, CFOs are very risk averse, but they still want to access working capital, and they want to avoid triggering capital gains. They want to avoid, having an event where they have to sell the Bitcoin at the lows. So what is the best way for them to think about modeling kind of the volatility risk, what LTV ratios and things like that? And I know that your company is focused on advising and helping firms access that working capital. So,
yeah, I mean, I think the first thing I'd touch on is really for all of us in the ecosystem, it's important to build the utility of Bitcoin to help attract more capital into the ecosystem. And so I think providers of, all sort of across the spectrum are important. And I was giving a talk in the UK recently and did a little bit of research, and I think it just exemplifies some of the power that I think Bitcoin can have even at a suppressed price. And that pre-pandemic in the UK, businesses, small businesses and medium-sized, were getting approved for loans at around a 70 to 80% rate. Post-pandemic, it's now down to a 30 to 40% rate. So as a business, if you can't even get capital off your revenues, off the strength of your business, how are you going to be resilient? How are you going to grow? And I think Bitcoin on the balance sheet creates that opportunity as an asset class that provides greater flexibility. And so we lend against it and do help sort of, provide advice in a credit partnership to how to think about it. So it can be a yield generator, it can be a liquidity provider. And then Joshua, to get back to your question, in terms of how do you think about protecting it, I think about it as a framework. I think LTV is your friend. And so you can start at a lower LTV, get comfortable with it, understand how it behaves, how you would manage it. Second tier for me is really, what are your reserves? What is the other assets you could bring to bear to sort of protect your position, and how would you manage it? And that would go along with a proactive strategy about when you would do that and how much you would do. And the third is what are you looking for in terms of terms and conditions related to the loan agreement? Because I think lenders like Arch and Salt and others have very different terms than what are on chain. Many of them are very advantageous, no rehypothecation, very clear in terms of what they're going to do with the collateral, and then also look for other downside protection. How can you take some of the risk out of the volatility of the loan that you might have?
That's great. And Himanshu, at Arch Lending, we know that you have a sensitivity to kind of rehypothecation. And you've taken a different approach to a lot of lenders in the previous cycle, which relied very heavily on rehypothecation. How do you think about the product set that you offer companies in the space?
For sure. I think rehypothecation as a concept really died out after the last cycle, and most lenders today are very comfortable going out to market with non-rehypothecating products. Really, the risk is the counterparty risk there. If you are rehypothecating and you have counterparty risk or duration risk in the Bitcoin that's being lent out or being used to generate yield, when your borrower wants to get the loan done, they want to prepay it or they want to close it out, that Bitcoin may not be there. And I'm not even going to speak about the counterparty risk that introduces, that's introduced by introducing the concept. So we've taken a staunch approach to not do it. However, I think there are opportunities now with structured products, with options to introduce some of the benefits of what people would perceive from rehypothecation, which is frankly a lower rate. We've done that. So we have structured products that we work with different treasuries on, where you can do either a collar or a put protected option or a yield enhancement, which does kind of mimic those structures, but doesn't introduce external counterparty risk and protects you as a borrower, where you don't have liquidation, there are margin calls, and your rate gets significantly discounted as a result. I think back then when people were lending out at 14, 15%, rehypothecation was attractive. I think today, if you're a treasury borrowing, you're going to be in the single digits and you're going to be quite comfortable with the rate. So even with no reapplication, there's a very attractive rate to be had. But if you do want some structured products, we can have a discussion on what that means to you, how involved do you want to be, are you a financial end user or not, and then we can see how that goes moving forward.
Hunter, do you have anything to add?
No, I think the fact that there's a lot more traditional capital understanding Bitcoin as an asset class, as Hemant just said, the rates are coming down. I think that's going to allow lenders to provide more options and innovative products, one, that are both simpler, and two, provide solve the problems that businesses have.
Yeah, I think one big difference between that the last cycle and now is how capital markets have evolved. In the past, it was retail capital from deposits being lent out, all duration mismatched, and if you had a bank run situation, you'd be in big trouble. Today, there's a number of different structures. Most lenders today have capital facilities at scale. We did our first tokenized CLO earlier this year, which basically was an on-chain securitization of a facility. And I think like we've seen other lenders do that as well, where we actually have duration matched capital at scale at decent rates and accessing traditional finance to fund those facilities, which lets us grow in a much more sustainable manner.
I want to touch a little bit on structured products just generally in crypto. So there have been a number of notable launches. I think BlackRock just announced a new ETF that is effectively a Bitcoin overriding strategy. Neos has had one in the market for at least I think a year, with about $1 billion in assets. There is a big focus on using derivatives and options to generate yield. Can you guys talk a little bit about what you're seeing in the market there?
Sure. I think from a lending perspective, and you know this because we work with you on this, the idea really is that you want to reduce risk and you want to increase the yield on the Bitcoin that's there so that you have a rate that's attractive enough for you to go deploy into something else and be accretive from that use case. So what we offer is callers where you can have a put and a call that's sold at a premium. And as long as Bitcoin stays in that range, you don't have margin call risk or liquidation risk, and the option premiums actually pay down the interest rate, so it's quite attractive from that perspective. Now, the other side of that is just placing one side of that trade where you either have a put or a call, and if you have just a put, it protects you from liquidations. It does come at a slight premium. If you have a call, that enhances the yield and gives you a bit of a benefit. Now, I know there's a number of other structures as well. There's covered call strategies that people apply. I know Bitfires just did something with Nakamoto where they're doing a covered call strategy on their Bitcoin. I think our goal as lenders and people providing services to Bitcoin treasuries should be to give them a menu of options and let them kind of choose based on their risk parameters and their goals. A bigger balance sheet may have a smaller hurdle rate that they're targeting versus a smaller balance sheet that's looking to grow. Like, for example, we have a product called the Bitcoin Accumulator, which is a structured product to help grow the balance sheet for treasuries. So there's different use cases, and I'm sure you have some stuff you want to talk about there too.
Yeah, I mean, I guess the thing I would say is it's exciting to see different products come out, both from ETFs, what Strive and Strategy are doing. But at the end of the day, I think if you own spot, and the more we can do to encourage individuals and companies to own spot, you get additional capabilities that go along with it and how you can leverage it in terms of speed of action. And I think it's important to continue to build the plumbing. We were talking a little bit before we came on about how do we enable that, because then collectively, again, going back to we've all got to build more value to bring more capital into the space and show that you can use it for your advantage, whether it's liquidity, whether it is yield, but really help businesses be more resilient and more stable. Because I think if we think in the age of AI, that we're going to have a lot more smaller and medium-sized businesses that are going to need these financial tools, and they can be less sophisticated and simpler, or they can be more sophisticated depending on the knowledge and the appetite, but it's important to build the menu.
That's great. And switching gears a little bit to the more technological aspect of things, Jay, do you want to talk a little bit about what you're doing at VerifiedX, in particular, avoiding some of the kind of smart contract risk that's kind of inherent in deploying Bitcoin on chain to generate yield?
Yeah, no, thanks for the question. So let's put tech aside for a second. I think that to date, we've been largely faced with the issue of, choosing between utility and security, and we don't have to make that trade-off anymore. right? You know, we've done a really great job as an industry of financializing Bitcoin. What we haven't done as good of a job of is creating utility with it, right? So I think from our standpoint, our thesis is let's bring Bitcoin into the at the protocol level. Let's activate a consensus with features where we can reduce rehypothecation, we can reduce counterparty risk, bridges smart contract vulnerabilities, perfect the underlying rights of ownership, and maintain native redemption liquidity, right? I don't think institutions wake up every day thinking about how do I squeeze an extra 2% out of my Bitcoin. I think what they do is they wake up every day saying, how can I make my Bitcoin more productive while preserving the underlying properties as to why I bought it in the first place? So, for us, it's the first iteration of acquiring Bitcoin. The second iteration was how do I custody Bitcoin? The next iteration, in our opinion, is how do I turn Bitcoin into programmable financial infrastructure?
That's great. And you guys recently launched sort of like a privacy layer around moving your VBTC product. Can you talk a little bit about that? Like, that is obviously an important feature of most institutional markets where there is a customer confidentiality and privacy around transactions. How have you guys been building around that?
Yeah, so it's really interesting. Privacy is a narrative that we're hearing a lot about today in the marketplace. It's a little controversial at times. How do you effectuate a privacy transaction but maintain compliance at the same time, right? I think that confidentiality is a business requirement and compliance is a regulatory requirement. So for us, we embedded in our consensus a Planck-based system with zero-knowledge proofs, with Merkle notes, but all that technical jargon aside, what happens is you have viewing keys and whitelisting that allow you to share that with the appropriate counterparties for a purview of transaction history and real-time auditability, right? So I think that we're living in a world now where privacy is certainly important in order to shield treasury management movements and trading strategies to maintain that competitive edge, but also at the same time to maintain a level of compliance. So, I think confidentiality and privacy, compliance, can coexist at the same time for sure.
Thanks. We live in a world where AI is kind of top of everyone's minds these days. And, obviously institutional grade service providers like yourselves, right, have a lot of sophistication around risk management, compliance, collateral management, and things like that. Can you talk about how some of the tooling around these things has evolved inside your companies when you're dealing with these Bitcoin-backed loans?
Sure. I think we made a conscious decision to build our platform from a technology-first fashion, not an operational-first fashion. So we have thousands of clients that we serve, but it doesn't require a human in the loop at any point in the system. So it's everything from onboarding, KYC, KYB, trust onboarding, whatever, all the way up to margin calls, liquidations. It's fully automated, which lets us, with a very small team, serve a large number of clients, whether you're borrowing $5,000 as retail or $50 million as an institution. And it just goes to say that I think a lot of lenders in the past, and maybe some today as well that are more on the institutional side, do serve a large number of clients, but it's very operationally heavy. So we made that decision. It's helped us grow. We built our own ledgering, which really was a conscious decision that let us do different kinds of loans. I think if you build on top of someone else's ledger, which a lot of companies do, it restricts you to the suite of offerings that they have. We have now 7 different loan offerings, which work because we have our own ledger. And I think that's been a very good decision that we made. Moving forward, we're going to plug into more venues for trading, obviously. We already do that with some, but we'll continue to do it further. And as we offer new products around yield and stuff, we'll have more integrations there. But everything always is technology first, with a human element that adds to the comfort and gives you a client representative that's always there for you. But it's a system that rules it all.
I don't think this industry has a problem being technology first. I think, it's all when nothing existed when we started, and so have built a very sort of customer-centric platform to really enable the technology. I think it's one of the things that the companies are doing well and why the public markets are interested in funding the loans, because of the technology that allows the liquidation and the management of the loans at a very essentially risk-free manner. I think the utility of interoperability is exciting in terms of a little bit what Jay was saying about sort of custody at different partners, where we have a lending as a service offering that we're working with people so custody can stay on different platforms, service the customers there, have the level of privacy, have the level of protection, but help the utility, people get more utility out of the Bitcoin without having to move in. And I think we'll see more of that happening as both the market grows geographically as well as in size.
Any thoughts, Jay?
Yeah, I think I agree completely, and I think that by doing so, we're going to help be additive and even help restore the true scarcity properties of Bitcoin and largely on-chain price discovery.
All right. Maybe more of a quick one for all of you. What is the single biggest kind of operational or structural bottleneck for companies who want to switch from a passive, cold storage strategy to something more active?
Well, I think it's education. The first step, I think, at least I can speak to both of our companies, we require assets in qualified custody. And in the past, you often had cold storage, or you often had a non-custodial setup because you could access DeFi rails with it. You can do that now with a qualified custody offering, whether it's Biggo or Anchorage or some of the other custodians out there. So we can bring the level of safety, the bankruptcy remote treatment, the insurance that you get from qualified custody into your operational flows today, and then you can access platforms like ours. You can access DeFi if you want to, and you can access different structures while keeping your Bitcoin safe in custody. And I think that's a new, it's a new avenue that wasn't quite there in the past. I find that most treasuries starting today do hold qualified custody, so I don't think that's really a bottleneck, at least not one that I've experienced. But really, it's the education. I think most treasuries don't know what they can do. The whole treasury market is very new, right? Outside of the few big ones, most of them are very new. They've launched in the past year. They've just gotten past the first era of buying the Bitcoin that they have, and now they're trying to find the utility. So I think the biggest bottleneck really is education, and I spend all my time educating people on what you can do with it, giving them the options, and once they have the options, they can make an educated guess or an educated decision on what makes sense for their business and for their goals.
Yeah, I mean, I would amplify the education and also helping people understand the benefits of the strategy, right? We're in a world where both as an individuals and businesses, the tactics of being capital efficient, being tax efficient, and operating with speed in terms of the asset is unprecedented in terms of what larger companies and high net worth individuals has been doing for centuries. And I think you just have to get out there and try it. And I would argue that at a depressed price, now's a great time to sort of experiment and learn. But that's the big thing. I do a lot of work with small and medium-sized businesses from a sort of education and teaching perspective. And they are experts on what they're operating in, not experts on the balance sheet. And so there's a simplification in ease of onboarding that will be required to help them understand how to take advantage of it more. And I think that will be a real enabler, especially as all the plumbing and the piping gets put together and there's a better offering out there.
Yeah, I was just going to say that, this comes down to responsible optionality, right? We have to move from a passive store of value on the balance sheet to a productive asset on the balance sheet. And I think that comes with, a variety of different potential features. Again, not changing the underlying properties of what made Bitcoin Bitcoin. So I think it goes a little bit beyond education. I think that we actually have to put features into the market, connect the plumbing, and actually, give allocators options that they can plug into and utilize today.
That's great. All right. Thank you all.
Thanks, Josh.
Thank you.
Thank you.
checking on shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up Strategy's finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Peng Li. Thank you so much for joining us, Peng, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here at the 52-week range than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
Yeah, look, I think Bitcoin is going through a bear cycle right now, and some of that is external macroeconomic. I think there's a major funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty with wars around the world, and there's uncertainty with governmental legislation. We, as a company, went through this in 2022. Right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance, the reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that'll start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need the SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real-world assets, to allow stable coins to be implemented. What will happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really were our Bitcoin purchases accretive to our common shareholders and our Bitcoin per share, and they always have been. We're selling Bitcoin from time to time, and we've shown that our Bitcoin sales are not really a major portion of what occurs in the market, but sometimes it makes sense to sell Bitcoin to add to our U.S. dollar reserves. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns? Now, of course, your shares are down by half. What is the shareholder value you're creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 142,000 or 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done it in the last couple of weeks to pay dividends. We've done it in the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet, but Michael Saylor on X said, when I say never sell your Bitcoin, I speak as no one savor to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it has disclosed it may buy or sell Bitcoin and manage capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that'll ever be mined. We're the largest institutional holder of Bitcoin. Last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me is irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Feng, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Feng, just how much, and I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC, by the CFTC, Treasury Secretary Besant, there are rules ready to go, and they're either going to go with clarity, with the legislature behind them, or they're going to go without clarity, with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Feng, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Feng Li, CEO of Strategy.
Our financial markets and our financial system, which is built on American rails, so to speak, and which has preserved America's role as being the reserve currency, the currency of settlement, we want to protect that from China or other countries trying to dominate that. And China indeed is trying to do so. And we don't want to be under a system where the Chinese Communist Party determines who can access it. They can avoid sanctions. They can avoid supervision. So we're at this moment now where it passed by nearly 300 votes a year ago. It passed in May out of committee with bipartisan support, and we're on the cusp of this. And of course, the ethics piece is part of this. It's just a small piece of a 600-plus page bill. Look, my view is ethics provisions were put in there. Ethics are incredibly important, of course, with all government officials. But this is too important for the leadership of our country, for where we stand going forward. If we're going to dominate and lead in this technology and preserving our financial networks, our economic strength, is we got to get this bill done. And this upcoming week may be the last opportunity to do so before we lose this moment for another year or two.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Bitcoin is different. Like Bitcoin has a fundamentally different value proposition. So I think this idea that it's a leveraged tech play is wrong. Let's start with the price action. That's like the elephant in the room. Let's go one by one. What do you guys think is some theories around Bitcoin's underperformance compared to, say, equities and gold over the last 6 to 12 months? Let's start with you and just go down.
Yeah, hi everybody, I'm Henry. I guess I didn't end up on the panel, but I'm from Silicon Valley Bank. I think the main kind of takeaway for me is it's always the question of liquidity. Where is liquidity going? Where is liquidity coming from? And today, all of liquidity is going to AI, and we're starting to see more and more of these mega IPOs happen, which means that there's an unlock actually of liquidity for people who are tech curious. So for me, we're at this point where we've seen liquidity move from higher risk assets into AI, where people think that their capital might be safe, or it might actually have some kind of underlying value. And now, as some of these unlocks start to happen with IPOs, and some of these AI companies are starting to potentially top out, you'll actually see a movement of liquidity from those to higher risk assets or longer tail assets, including Bitcoin.
All right, so there's a lot of shiny things out there right now, and it's moved liquidity. I mean, I'll give an easy answer, right? Warren Buffett famously said, when people are fearful, be greedy. So this is not investment advice, but that's certainly my my ethos right now.
Hi, Greg Barras here from Kraken. Look, I think from my perspective, anyway, Mike's acting a little weird, but I think that when I look at asset pricing, I think about it kind of relative to both the real and nominal yield curve. So what you've seen over the last 2 to 4 weeks is you've had inflation expectations like completely drop. When you look at 1-year forward inflation swaps, they're down by like 95 basis points. At the same time, nominal 2 years have continued to rise. So you've had this kind of like flattening of the real yield curve. So in the near term, you have this higher real yields, which kind of weighs on the interest differential aspect of any kind of risk asset or currency. But the market is starting to price in potential demand destruction due to kind of this oil supply shock. So, I think when I look at asset prices in general, and maybe Bitcoin more specifically, that lens for me personally is somewhat helpful.
Yeah, the only other thing I'd say is, probably going off you, Gregory, is it's just the macro picture in general, like the uncertainty around the conflict in the Middle East, the whipsawing, is there a peace deal, is there not? There's still a lot of uncertainty, and as you said, inflation expectations are rising. We got a new Fed chair coming in, Kevin Warsh. He had an interesting speech last week, kind of talking about how he's going to change some of the things internally at the Federal Reserve. Do you think that Kevin Warsh, being the new Fed chair, is impacting risk assets, anything of the speech or the potential of a new Fed chair kind of changing monetary policy?
Yeah, I don't know necessarily how much it was Warsh himself. Look, ultimately, his main response to every single question was, we're setting up a task force for that. So he himself, and also he didn't put a dot out there, right? So of the 19 dots, there was only, or the 19 members of the committee, there was only 18 dots because he decided not to put a dot out there. But I think it was the hawkish bias of the dots, right? So essentially you went from having a median of 1.5 rate cuts to essentially flat for the rest of the year. But I think what wound up happening was the market said, okay, if we're going to have more hawkish monetary policy, it's actually going to lead to more demand destruction, coupled with the fact that the oil price shock is more of a tax on the consumer. So you've had the initial, to your point, inflation expectations skyrocketed. But over the last 21 days or so, they've come down by like 100 basis points. So it's been this kind of like massive whipsaw where if you assume that you're going to have like more hawkish monetary policy and ultimately demand destruction in the economy, you have higher real yields, but that's because the rate expectations on the nominal curve have not caught up to the expectations on the inflation side.
I also think you have something to do with uncertainty here, right? Markets, generally speaking, hate uncertainty, and we've kind of lived in this bubble of uncertainty over the last year and a half. So when you look at risk assets outside of the AI bubble, I keep going back to that, you're seeing that reflect in price action. And I think once we start to have more certainty in the market, once we start to have more direction, and if we can actually start pricing what might happen with more certainty, you could see an evolution of the kind of the next wave of risk assets.
One of the trends over the last couple of years was there was the launch of the ETFs, and then the share of circulating supply of Bitcoin held by institutions and funds have ballooned over the last, say, 4 years. It went from basically nothing to now almost 20% of the circulating supply of Bitcoin is held with institutions or funds. Do you think that's influenced Bitcoin's trading behavior at all?
I think it's the same buyer. I think people have just moved money off of chain. So people who are buying IBIT in their brokerage accounts, most of those folks, at least that I speak to on a day-to-day basis, are the same people who used to hold their wealth on chain. And so I think that you're seeing this rotation happen of, yes, more people are buying their brokerage accounts. Yes, there's more access, but I don't think that necessarily changes who the end buyer is outside of large swaths of institution coming in and saying, okay, we're going to allocate 5% of our balance sheet to it.
Yeah, I'd echo, right? The institutions aren't exactly in yet, but we run an exchange, right? And most of our volume is with traditional, boring banks. They're not.
Hey, we're not boring.
But they're almost there, right? And we built a digital business circa 2018 in response to these clients that were asking for it, right? And so they are trading. They're doing hundreds of millions, maybe $1 billion a day, right? Versus a franchise for us that spans 70, 80 billion, so small. But has been meaningfully increasing every year, every quarter, and that's just the trend we see with the clients, with volumes, with the counterparties we're dealing with. So it's clearly one way.
I actually think the more interesting metric will be over the course of the next 2 years when we see more and more commercial banks offer custody assets, what that turns into in terms of who's holding Bitcoin on their balance sheet. Is it the traditional fintech company that's now holding Bitcoin on their balance sheet because they have access to USDC rails in their commercial banking account? I think that could actually be the catalyst of what happens for the next cycle outside of quote unquote institutions buying. It's going to be the individual institutions on the fintech side, not just the asset managers.
Interesting. So you think the trend of, say, stablecoin adoption that's exploded will actually lead to more Bitcoin demand?
Yeah, I mean, think about what a commercial bank is, right? Commercial bank is, okay, great, you give me your fiat today, I'm going to custody that, I'm going to keep that safe, and you can go out and do your operational activity. If all of a sudden those clients have access to stablecoin rails and then therefore have access to swaps into the large assets on chain, then there's this whole other metric of demand that people are not even measuring today.
Got it. Interesting. One of the things I hear a lot from more like traditional finance people when they view Bitcoin, they say, "Oh, it's just a leverage tech play." And do you guys hear that in your conversations? And do you view Bitcoin that way?
I mean, I hate to repeat myself, but I would look more at the steepness of the yield curve, right? I mean, ultimately, you could argue that a steeper yield curve is better for equities, which then leads to a correlation with Bitcoin. But I don't think that's necessarily like correlation being causation. I think to the extent that you have lower real rates in the short end and you have higher long-term rates, which would denote either some level of global growth and or some kind of potential monetary issues, that's probably the best opportunity for Bitcoin to continue to perform well. It does happen that in that environment, tech also does well, but I don't think they're necessarily causing one or the other.
It's more so than that, right? There's also, if you look at the broader industry, there's fundamental use cases. There's real world adoption, right? Stables, the ability to send remittances all over the world, the applications on blockchain. These are real things that are providing real value that you can credit Bitcoin to a large degree as being the catalyst and the support layer for. So there's definitely that aspect that I think is important.
Yeah, I actually started my digital assets journey in 2017 selling structured products to family offices under the thesis that they were not correlated to tech stocks, because back then it wasn't the case. And I think what we're seeing now is it is a leveraged bet. But to your point, Greg, it's a leverage bet based on liquidity, and it's a leverage bet based on risk and how consumers and how institutions are willing to lever up their risk.
And also the other thing I'd say is, like, you could argue ever since the war started in Iran, correlations across assets have gotten to one. I mean, oil is becoming increasingly correlated with equities, some of them being positive one, some of them being negative one. But essentially the market is trading on a couple of like major geopolitical themes. So naturally you're getting increased cross correlations across the board.
Yeah, you can make that same argument for access, right? And the ability and ease of trading, right? Hyperliquid has allowed for ease of trading for oil and for other things that typically a retail investor might not have access to outside of derivative products. And now that you do have access to those and people are trading those on an active basis, you're seeing additional correlation.
I think the increased correlation with equities is actually a sign of Bitcoin winning because it's becoming more integrated into the traditional financial system. And then it's having a shared investor base, more institutional investors owning it, looking at it in a whole portfolio, and then having the same risk management strategies, trading strategies with the same flows. And so you see this with like emerging market stocks. A couple of decades ago, you saw that with the hedge fund industry, where they were initially, it was all about the lack of correlation with other, but as they were adopted, as more investors allocated to those sectors, they actually grew in correlations because it's just shared investors doing the same things, looking at the portfolios. And so as Bitcoin becomes more integrated, it's going to be tied more to traditional asset classes. But it's important to know that Bitcoin is different. Like Bitcoin has a fundamentally different value proposition than an equity. You know, equities of a claim on future cash flows. It's valuation multiples, profit margins, earnings growth. Bitcoin has none of that. Bitcoin's driven by its monetary properties and its network effect. It's like
a function of how much the fiat's being debased, the openness of capital markets, the credibility of the traditional banking and financial system. That's what drives Bitcoin. So I think this idea that it's a leveraged tech play, if the correlation's just tied up over the past year or so, it's wrong. I don't think that's how investors should view it. They should view it as a separate bucket that's hedging against a risk that equity, bonds, cash cannot protect against, which is the credibility of the issuer of the currency, so the fiat currency debasement. So I think that will come more and more as more investors learn about Bitcoin. But right now, it's still viewed broadly as a risk asset. But I think that's changing with some of the narratives around BlackRock and these other, the way that the education is occurring. So that should change over time. But with institutional adoption, I think looking ahead at what's a potential tailwind for Bitcoin to kind of pull us out of this bear market. When the ETFs launched, the institutions are coming. That was the narratives. They're coming. But I think we all agreed on our call when we were prepping for this panel that they're not really here yet. It's extremely, extremely early in terms of the adoption there. You guys all are building in this space, actually providing the infrastructure. So how can we kind of drive that trend more? Where are there gaps in the market that you see? Where does building need to take place? What are you excited about that could really move the needle in terms of getting more capital flowing into this asset?
I'm glad you mentioned infrastructure, right? We are an infrastructure provider. We match buyer and seller at the end of the day. But to tie that into macro, right? Macro, I have macro traders next to me, so they'll be able to speak to this a lot better. But macro is everything: inflation, international relations, politics, everything. So you can imagine trading macro themes is quite difficult. And there's a really interesting study that came out this week where an investment firm, they put out a simulation where they asked a bunch of traders to trade based on forward guidance or forward knowledge. It was you can trade on Monday, but you had access to Wednesday's Wall Street Journal. It turns out, and they can buy whatever they want, they can apply leverage, they can short. Turns out they did not do so well. I think it was 50% lost money, something like a sixth went completely bust, and the rest made very nominal returns. So not only is trading macro difficult, but even if you have a crystal ball, even if you know what's going to happen, you still don't necessarily do that well, right? And I think the lesson from that is that it's not so much direction or which asset specifically. I think it's more about exposure, the leverage component. And in my mind, exposure is a function of risk, and risk is a function of infrastructure, right? How do you manage risk? Prime brokers, that's literally what a prime broker does, right? Custodians, qualified custodians, exchanges, right? This is the infrastructure that, in my mind, needed to grow and scale and has, to a large degree, that is creating that catalyst, right? And that's why you see qualified custodians. You'll be hearing from Mike Belshey later. That's why you have regulated exchanges like LMAX. That's why you have actual prime brokers, traditional prime brokers that are participating in the asset class. We're working with a lot of them, the traditional names, right? I think that's going to be the one of the most important catalysts.
Yeah, look, building off of that, and by the way, it's from a place called Elm Wealth. It's a really fun exercise. Yeah. It's actually much easier to do the interest rate predictions than to do the equity predictions. But look, what we're doing at Kraken, which is maybe a longer term tale, is the idea of at the end of the day, whether you have an asset that's denominated in Bitcoin, Ethereum, fiat, anything, and you want to invest that into any other type of opportunity, whether that's real world opportunities, another crypto opportunity. The example I gave these guys on the prep call was, if you're a Bitcoin holder that wants to hold or invest in a manufacturing plant in some place like Ohio, we're working on figuring out ways to structure those opportunities so that ultimately you really get the convergence of kind of traditional finance and modern finance using our, to your point, infrastructure, our distribution, the clients that we have. And then you really start to look and see that there's no difference between a firm like Kraken and a firm like JP Morgan. It's just that we're doing it in kind of a more modern and sophisticated way.
Yeah, I think my point here is kind of threefold. One is trust. I think trust is completely eroded on chain at the moment, which is part of the reason that these large financial institutions need to come in, commercial banks, prime brokers, exchanges that are trusted so that users can actually feel secure in the assets that they're holding. They don't feel like they're going to get drained. They don't feel like the platform's going to get hacked. They don't feel like their funds are going to get frozen. And I also think it's an access thing, right? So to your point about institutions, yes, institutions were coming when we rolled out the ETF, but really that was access to retail traders or to 401ks or to the individual who's using these brokerage accounts. The access to actual institutions is still actively rolling out. And I think that's where we'll start to see some of the more interesting price fluctuations potentially. And, obviously none of this is financial advice, but when we start thinking about how much capital is sitting stagnant, how much capital is not being used on people's balance sheets, what's the yield that's available for overnight sweeps versus other things that you could potentially allocate to. And then the last point is we're seeing a massive amount of VC funding still coming into the industry. Framework just announced a $400 million fund. Han Ventures announced $1 billion fund. A16Z's $2 billion fund, right? So these are all going to go into additional infrastructure plays that allow for additional access, that allow for more creative ways to put your Bitcoin to use or put your on-chain holdings to use. And I think that will also be a catalyst to allow for just overall sentiment to change in the industry. And part of price action is obviously predicated on sentiment.
Yeah, the only other thing I would say is improving investor access by embedding Bitcoin as collateral with different structured products that fit investors' needs, different cohorts, different investment mandates. I mean, you're seeing that with Strategy, the Treasury companies. But it's not just that, too. I mean, for instance, Battery Finance is another example of a company that are trying to tie real-world credit assets with Bitcoin and dual collateralized loan structures. There's all types of companies building like that, but it's still the early days. And I think Bitcoin as collateral, as pristine collateral being embedded will help drive the adoption of Bitcoin to new heights, to be frank. Now, when I think about looking kind of forward at the macro picture today, there is a lot of uncertainty. What's like one area of the macro picture that you think is important for investors and individuals to pay attention to kind of get a sense of where things might be heading? Like what's a metric or certain policy that you guys think is really important?
You're the macro trader here. I've already talked about yields, so give me a couple of seconds to think about something else. I mean, look, in terms of policy, obviously everyone here is aware, Clarity Act going through Congress, I think is something that everyone should be thinking about, especially given the fact that, I think it'll be increasingly difficult to get anything done as we get closer to midterms. And, if, there's a divided Congress after November, potentially nothing gets done. So as a kind of a cop-out answer, I'll give you guys that.
It's not a cop-out, right? I think regulation comes up on every panel because it is the single most important driver for adoption in the US, hands down, right? That said, I think we already have a lot of regulation and we have a lot of templates, right? We need clarity to pass for a whole host of reasons, but there are already frameworks that exist that, frankly, all clarity will do is just push things a little bit more onshore US, which is important. And if I was a politician, I would be thinking jobs. I'd be thinking about everything that comes with it, which is why it's attractive. But really, right, the train is kind of started, and it's from a US perspective, it's our game to lose, quite frankly.
Yeah, I completely agree with that. You're seeing foundations of protocol companies starting to come onshore again, which I think is great. A great sign of just adoption, generally speaking, and where regulation's heading. My answer is slightly different. I actually think the private credit market is something that's extremely interesting to watch and see how private credit is actually getting rolled out to smaller and smaller consumers or smaller and smaller borrowers. So the folks who are saying, okay, great, you can collateralize $10 million worth of equity instead of it just needing to be $35 million worth of equity or 50 or 100 or whatever it might be for a typical bank to actually underwrite that loan. And that way you have more liquidity flowing through the system at a higher pace and a faster time frame. And I think that's going to be extremely interesting as you're starting to see these companies go from $0 valuations to $60 billion over the course of a 3-year time frame, and you're minting billionaires over the course of a much faster clip than we've ever seen.
Yeah, it's interesting. Mine's pretty simple. I look at the governments and I ask, are they still running massive deficits? Are they still spending recklessly? Because when you look at large, highly indebted governments, historically, when they can't plausibly tax their way out of it or grow their way out of it, they turn to one thing. They inflate the debt away nominally, and then the currencies absorb the damage through lost purchasing power, and then financial repression and capital controls follow suit. That's the macro environment that Bitcoin was designed to thrive in. So with that, I want to thank everybody here. I appreciate all your insights, and thanks for building the infrastructure that helps drive Bitcoin.
Thank you.
Thank you.
Thank you, everyone.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and the work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999 where the world was going to implode. Technology marches forward and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
If you're not at the table, you're on the damn menu. I think we're pretty spoiled right now. We may find out very soon what it's like to be on the other side, and I don't think we're gonna like it very much.
I've got questions lined up for these gentlemen, but first I want to ask them about maybe the bigger question, which is that when we think about Bitcoin, it's decentralized, it's permissionless. The ethos of Bitcoin is very independent. Some would even say libertarian, and they think it's Bitcoin versus the state. So what are we doing up here on a panel, kind of getting into the weeds on what DC is doing? How do you push back on that cynicism and that nihilism about today's politics? So we'll start with Stephen. And feel free to introduce yourself.
Yeah, Stephen Pollock, Signal Ridge Partners. We're a consulting firm, works with Bitcoin businesses. Before that, I was at Bitcoin Pulse Institute for a while. And before that, I ran campaigns, state, local, national, all over the country in issue advocacy. So to tee that up, why should we not be cynical? Great one to start with here, Pierre. So I would say I think I am cynical, first of all, and that's why we should be involved. The reason we should be involved in national politics, or we should worry about what's happening with Bitcoin on Capitol Hill, and this is a conversation I've had with tons of people outside of corporate Bitcoin, hardcore Bitcoiners, everyone across the spectrum there. The reality is that if you're not at the table, you're on the damn menu. And so I think we're pretty spoiled right now. I think we're fortunate. And there's some people here in this room, in the room next to us adjoining that I think we have to thank for that. However, I think and we can get in this later, we may find out very soon what it's like to be on the other side. And I don't think we're gonna like it very much.
Good afternoon, everybody. Steve Baum, Managing Director at CBIZ. I head up the crypto division at CBIZ. We're the 7th largest accounting and audit firm in the country. I focus primarily on helping companies get to the public markets that have digital asset businesses. So the question, I'm not in politics, right? So I'm more on the compliance side. But when you talk about the kind of last 15 years of Bitcoin, we look at revolutions, right? And how do revolutions start? And whether it's this technology, blockchain technology, or how the internet started, it's always people pushing for the next level of innovation. And I think when that began, you had this libertarian view of Bitcoin as this free money and something that would be outside the government's control. But then over the last 15 years, I think that the technology became so strong that people started to realize that this type of tech actually is so innovative to be used in financial institutions that it had to have some sort of oversight by government. And that shift has pushed people out of the industry, but also has brought a lot of new faces in. So I think overall it's a good thing because this technology is going to get broader as we kind of see it evolve over the next, decade or so.
Paul Tarantino with Byte Federal. We are a Bitcoin-centered fintech platform. We have 2 different divisions. One that is our retail on-ramp through our kiosk network, so Cash for Bitcoin. And then our other, which is payment processing. We just launched the very first US regulated casino transaction in Vegas with Circa. So we are funding bets in the casino with Bitcoin. To answer your question, I'm probably the least political person on this panel, but I have also been impacted by it directly with our business. So we definitely have some opinions. But I got into Bitcoin because I believed it was a tool to really fix a lot of the problems that we saw with this combination of the political and financial mechanisms of the world. So Bitcoin, from that libertarian perspective, was for us a way to solve or heal what we long perceived as a lot of deep problems within those 2 systems. So the adoption of Bitcoin at the larger scale, both Wall Street and government, is a double-edged sword because you do come, or we came to this with these sort of idealistic goals in mind, and the political process is obviously a negotiation that will continue for some time. And so I think that we sort of struggle with that internally. We want it to be done right, and that fight to get a proper policy crafted it has been challenging and difficult, I think, for all of us to achieve.
Excellent answers. I'll give my own answer, which was my experience with Bitcoin mining in Texas, where we saw legislators who were opposed to Bitcoin mining, and by a process of engagement and education, they actually changed their views. And so as much of the cynicism there is out there about politics, I actually came away with that almost idealistic. Maybe I was in ideal circumstances to have that experience. But now, Stephen, we saw the Genius Act for stablecoins kind of sail through, seemingly, because they want to finance the deficit. So let's get back to cynicism. But it seems like the Clarity Act is kind of stuck in some mud here. The odds online are saying 50-50. Depends which website you check. What's the sentiment like in DC around the Clarity Act, and why should we care?
Yeah, big question. First of all, legislation, clarity, ARMA, whatever. I don't know. I don't know what's going to happen. I don't think anybody knows. Maybe somebody out there, if you know what's going to happen, love for you to raise your hand. But I love that it's a coin flip on Kalshi right now. And I think that what I'm more interested in, obviously it'd be great to get something done. I think we have 5 weeks is what they're saying, right? And I think the question behind that is really about the House and the 82-18 odds that we're seeing on the House flipping, because I think where we're at is we're on the cusp. Some would say we're almost there. Some would say we may be there soon, and some would say that we're now, which I would probably say we're there now in the midst of crisis as an industry. As far as, Bitcoin's down. I'm not talking about that. I'm talking about the political realities. And I think we also have a massive opportunity. And so, if you don't mind, unpack that a little bit. The crisis is that, well, first of all, we have Senator Lummis, who's been phenomenal. Senators like Senator Blackburn, Tennessee, let's go. They're about to be gone. And I don't know if any other senators really could have pulled off what they have with clarity, with market structure, because they've been there a long time. They have seasoned staff, and they've sort of danced through the hula hoops to still give this a chance. It's still a 50-50, which is unbelievable, because it really doesn't feel like it should be a 50-50. It feels like it, and so they're going to be gone soon. And I don't think there's any heir apparent. There's people who, we have fans in the Senate and in Congress, but I don't know if we'll ever have another Senator Lummis. I mean, maybe. I hope so, but we may not.
She's a one of a kind.
She's one of a kind, and so that's about to be over with. We're going to lose the House, apparently, right? It's 80% odds the Republicans lose the House, and I say we because the Republicans have been the ones who are supporting us and dragging us all of this forward. And so, we've got a massive opportunity that's about to be, the window's about to be closed. And on the other side of that, you're going to have the Maxine Waters on the House Financial Services Committee, dragging everybody in front of the committee and embarrassing them on national television. So yeah, it's a little bit of a crisis, but I think the opportunity here is that there's still a 20% odds that the Republicans keep the House. And I think that there's a lot that we can do. There's a lot that has been done. Are you guys familiar with there's this thing we used to have. I'm from Southwest Missouri, like 30 minutes away at this small high school. This guy grew up, went to school there. His name was Brad Pitt. And we had this thing we called the Brad Pitt rule, which is basically if you ask someone out on a date and she makes up some reason or says some reason she can't do it, and you're like, I don't know. You're like, well, if you were Brad Pitt, would she say the same thing? And if the answer is no, then she's just not that into you anymore, or not into you at all, right? And I think what we need to realize is, as an industry, we're no longer Brad Pitt. If we ever were, we're not now. And AI is Brad Pitt. And our mining companies are going to AI, and our Bitcoin Policy Institute, which I was at for 4 years, their new summit's about AI, and I think it's fantastic. I think it's smart. It makes sense. But I think we need to realize we're no longer Brad Pitt. And so if you're not Brad Pitt, what do you need to do? You need to figure out how to impress this girl. And so I think at the midterms, we have an opportunity to impress her. And I don't think we're doing enough yet, but we can talk about it more. I don't want to dominate the time, but I think there's some, Nick Begich, for instance, is fantastic advocate for us in the House, and I think we need to do more to support him. Everyone in this room, anyone out there who hasn't maxed out, them, their wife, their dog, probably needs to do so. And I doubt that we're doing those sorts of things. And anyway. Yeah.
He's representing Alaska, is that right?
Yeah, he's in Alaska. Yeah, but he's essentially solely responsible for ARMA.
Yeah. Tell us what ARMA is and kind of what the impact of that legislation would be for the reserve.
Well, yeah, I mean, U.S. government buying a lot of Bitcoin and holding on to it for 20 years is, that'd be phenomenal. I think it's the top of my list. I think it should be the top of most of our list. I think it's a stretch, but I think it's great. So, I think Lund, we have advocates in the House side that we need to take care of, and I'm not sure that we're doing it.
Yeah. Now, Paul, let's shift gears to Bitcoin ATMs, not the at the market offerings, but the automated teller machines, the hardware. This administration has been pushing back on issues around fraud. Our vice president himself is in charge of this anti-fraud task force. I've seen headlines of fraud busts abroad, like in Thailand or Cambodia, where these call centers are defrauding people, sometimes using Bitcoin ATMs. And so can you kind of get into kind of what the landscape is there and what the legislative and regulatory pitfalls are and what is kind of legitimate in terms of making sure that we go after the bad guys?
Yeah, sure. Thank you. The Bitcoin ATM space, a lot of people may not be aware of this, is been under a misinformation attack that I think is pretty akin to what you went through with mining. I'm not going to sit here and fool anybody that we do have some bad operators in the space, but there are a number of us which we consider best-in-class operators that go way above and beyond what's required by law to legally operate, because we want to stop fraud before it takes place at our ATMs. But the state legislators specifically have been led down a path that the Bitcoin ATM companies themselves are the fraudsters. It's simply not the case. As you mentioned, the vast majority of this high dollar fraud starts in the telecom and voice over IP industry, where you could get a phone number for $100 and very light due diligence. They have a protocol in place called the Stir-Shaken protocol, where they're ranking these calls on legitimacy. But the fact of the matter is that the highest rated calls make up 48% of the fraud. So they just don't do enough. And the FCC's filed about $208 million in fines and collected $7,000. So way to go. That being said, that architecture of fraud does not just affect ATMs. There was well over 200 and something billion dollars of fraud last year just in the banking system, all starting from those calls. The ATM industry is about 247 million last year. So we're a very small drop in the bucket of total online fraud. And if you look at this fraud, it's not just hitting the banks, it's also Zelle, PayPal, gift cards, credit card fraud, ACH, wires, you name it. It's across the system, and it's growing at about a pace of about 25% a year because of AI. So the attack on the Bitcoin ATM industry in specific is really misguided because they don't take the time to understand that not all operators are created equal. We have a number of protocols in place inside our terminal that are sorting out and confusing people that are being coached, so we can find out if they're not reading our terms of service, if they're not properly addressing the fraud questionnaires that we have built into our terminal. And everybody over 60 is getting a live phone call from a trained US customer support staff to specifically verify that they're doing this transaction for their own investment purposes and that they're not being coached or being sent to the ATM in order to make a payment to somebody. That's all on top of full KYC, BSA compliance, AML, SARS, CTRs, on-chain analytics, verifying your wallet, tracking your money after you've bought it. All of this is to say that the ATM bans that are taking place across the United States right now, we have Minnesota's banned, Tennessee is banned, and Tennessee actually made it illegal to actually even own a machine if it's off, right? You can't even have it on your premise even if it's turned off. You can go to jail for that now. And then, we have a bunch of pseudo bans where they've restricted the operational profitability to the point that it just was not profitable to operate. So we have been, like you, through the mining debacle, have been trying to educate lawmakers. We've combined with 2 other operators in the space. We just had a great call with Durbin's staff. We're trying to make sure that they understand there's a right way to do this business so they can preserve access for the 26 million and underbanked Americans that need it. This is the group that's underserved, that suffers most from inflation. That's the primary customer for the ATM industry, and we want to preserve access. So that's crucial that we get in front of these people and we have time to educate them. They're passing laws without understanding the way the network works. They're passing laws without understanding all the protocols that are in place voluntarily in order to prevent fraud. And frankly, we have a much lower rate of fraud taking place on the ATMs because of our protocols than any other part of the financial ecosystem.
All right. So I will continue not answering my phone calls because it's fraud.
52.8 billion calls, robocalls last year in the US.
That's crazy. I feel like half of them went to my phone. Steve, all right, let's kind of go on to a rosier topic. Although with the Bitcoin price doing what it is, it's not that rosier. I put on my red tie today because we're down. Fair value accounting. So it used to be the case that you could only write Bitcoin down on your balance sheet. Now you can write it up, hypothetically, in the future. So that was removing a major obstacle for corporate Bitcoin adoption. What now do you see as kind of the obstacles you're encountering with your practice, or is everything kind of streamlined compared to other assets?
Look, I mean, we'll talk a little bit about accounting, and I could talk about the ATMs, or I could talk about the Clarity Act as well. Obviously, the ASU that got passed a few years ago allows you to now mark-to-market digital assets, all digital assets, including Bitcoin. That was a big change because the financial reporting that you saw of public companies, specifically 10Ks, 10Qs, didn't represent the true value of those assets because you would have to drive them down to cost and you wouldn't be able to remark them if the price recovered. It doesn't have that big of an impact overall because most investment vehicles require fair value accounting regardless. So it really didn't have a huge impact except if you were really just a public company that wanted to report digital asset holdings. So we see that change now, simplifies the accounting, but does it really change much? I don't necessarily think so. It just gives a little bit of a better picture of the fair value of those coins. Now, some of the bigger topics probably are around revenue recognition. If you're, taking Bitcoin, doing different strategies, whether it's covered call strategies or if you're mining Bitcoin, they're still dealing with how do we report this properly from a rev rec perspective. And I think there's a lot of diversity in practice that continues to be there with digital asset transactions that generate revenue or income streams. It's an area we see typically that the SEC is pretty involved in, as well as the PCAOB, which is the oversight committee for public accounting firms.
All right. Now we're running short on time, so I'm going to try to kind of provide a wrap-up question. Stephen, how should people really get engaged? We've got these midterms coming up. The primaries were very interesting in their results. We could lose the House. What do you think the Bitcoin community should be doing more of and less of as they engage with politics?
Sure. I think simple. Double down, triple down on your winners. So Nick Begich, like I said before, Zach Nunn, max out to these guys. Call up the NRCC. Say, hey, put me in, coach. As an industry, or you individually, we should call the NRCC and say, what can we do to help? And then, engage, grassroots, ground and pound. Top down's not going to work. We're going to have to, really roll up our sleeves and do what many have done before us and learn what it's like to really engage, like at a local, state level, congressional district level in the upcoming midterms.
Yeah, and that's something I've seen in Texas is that we've got the Texas Blockchain Council, which has been really effective in engaging at the state level. So I'd also encourage people to find their tribe, find the people around them that are working on these issues. And Paul, do you think the Bitcoin ATM kind of outlook is that going to be an opportunity to orange pill more politicians, or at this point is it really just damage control?
It's a little bit of both. The educational process through the meetings that we're having with the state lawmakers has really lit the light bulb for a lot of people, right? It's sort of split. It's those that are not taking the time to understand, and then the others that really dig into our fraud protocols that instantly a light goes off and we commonly hear, how come I haven't heard of this before? and then they want to share it. So we are having traction in regards to that educational process, both stopping further damage, and also they're now starting to think like, I can re-implement new legislation in the future that addresses this in a way that's pro-consumer and pro-business and eliminates fraud. So I do think we're having a good impact. I'll just leave you all with this. If you're interested, you can go to bitefederal.com/fraud-prevention. You can see the architecture of scams that affects the entire financial industry and exactly what we're doing to prevent it. You can also find a petition there that you can sign to preserve access to Bitcoin ATMs for people that so desire it. So yeah, I guess I'll leave it there.
Great. Well, thank you to our panelists, and thank you to the Bitcoin for Corporations team for organizing this symposium. So yeah, well, also, I want to make a shout out for the Bitcoin for Corporations show. We've got a podcast and YouTube that everyone should go check out and subscribe, including some conversation with Paul on this topic. So thank you all and have a great afternoon.
Thanks, Pierre.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. You know, these are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so, okay, I'm a Morgan Stanley advisor. We just launched our own Bitcoin ETF. There's going to be a wave of slow adoption. But I think you're going to really have to that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated. And it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
All right, welcome back. Checking on shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up strategies' finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Peng Li. Thank you so much for joining us, Peng, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here, the 52-week range, than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
Yeah, look, I think Bitcoin is going through a bear cycle right now, and some of that is external macroeconomic. I think there's a major funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty with wars around the world, and there's uncertainty with governmental legislation. We, as a company, went through this in 2022. Right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance, the reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that'll start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need the SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real-world assets, to allow stable coins to be implemented. What will happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Following our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really were our Bitcoin purchases accretive to our common shareholders and our Bitcoin per share, and they always have been. We're selling Bitcoin from time to time, and we've shown that our Bitcoin sales are not really a major portion of what occurs in the market, but sometimes it makes sense to sell Bitcoin to add to our U.S. dollar reserves. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns. Now, of course, your shares are down by half. What is the shareholder value you're creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 142,000 or 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done in the last couple of weeks to pay dividends. We've done in the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet. But Michael Saylor on X said, when I say never sell your Bitcoin, I speak as no one's favor to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it has disclosed it may buy or sell Bitcoin and managed capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that will ever be mined. We're the largest institutional holder of Bitcoin. Last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me, it's irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Feng, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Fong, just how much? And I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC, by the CFTC, Treasury Secretary Besant. There are rules ready to go, and they're either going to go with clarity, with the legislature behind them, decision on clarity one way or the other, and the rules will get made.
All right, Fong, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Fong Li, CEO of Strategy.
Our financial markets and our financial system, which is built on American rails, so to speak, and which has preserved America's role as being the reserve currency, the currency of settlement, we want to protect that from China or other countries trying to dominate that. And China indeed is trying to do so. And we don't want to be under a system where the Chinese Communist Party determines who can access it. They can avoid sanctions. They can avoid supervision. So we're at this moment now where it passed by nearly 300 votes a year ago. It passed in May out of committee with bipartisan support, and we're on the cusp of this. And of course, the ethics piece is part of this. It's just a small piece of a 600-plus page bill. Look, my view is ethics provisions were put in there. Ethics are incredibly important, of course, with all government officials. But this is too important for the leadership of our country, for where we stand going forward. If we're going to dominate and lead in this technology and preserving our financial networks, our economic strength, is we got to get this bill done. And this upcoming week may be the last opportunity to do so before we lose this moment for another year or two.
It does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential. The largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it coming to today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing.
I have heard some cool stories about Larry Fink and his journey into Bitcoin.
I think we all know that he used to call it pirate money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income, it's very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network, a true extension of the internet? AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold, a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
I think
commitments to not sell Bitcoin is actually not valuable, it has negative value. You had this option, now you've, by your own actions, decided, okay, I no longer have this option. You're kind of cutting off some of your own moves, cutting off your own resources.
Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Rochard, and today we're joined by Allard Peng, research analyst at Bitcoin for Corporations. Welcome to the show, Allard. Good to have you back on. All right, so you put out a research report recently. We want to get into that and kind of get your observations on what is currently going on in the capital markets and kind of the macro environment in which we find ourselves and of course, Bitcoin's price action. So yeah, you want to kick it off by kind of diving into the research report you put out and kind of what your motivation was for putting that together and what your findings were.
Yeah, sure. So the report went out like end of June. It's called Quant Framework for Digital Credit Risk. The main thing I was trying to do was kind of educate the space on how to think about digital credit risk from a quantitative perspective. I think there's a lot of frameworks out there for looking at these assets, and they're obviously a very new asset class as well. So just being able to like quantify that risk using objective metrics, I think is an important contribution to the discourse. So just to kind of get into it, like the main thing I'm starting off from is the concept of BTC rating, right? So this is something that I think has been introduced for should be about a year now, since like Strike came around and Strife, and then Strategy came out with the BTC rating and a bunch of other frameworks, right? They have their credit dashboard that kind of goes from BTC rating into BTC risk and BTC credit. So starting off from that, and I think the unique approach that I'm taking towards this is I'm saying that like the BTC rating could be thought of as a starting point for measuring the Bitcoin risk. And then from there, you can actually use the Bitcoin, or rather specifically for this paper, the Bitcoin ETF option markets to quantify that risk. So this is largely what the paper goes through, the methodology behind doing that, and behind like chopping up the risk premium that these digital credit instruments pay you into the different risks that you're exposed to. So like that would be what you're compensated for, right? Like the type of risk that you're compensated for, and that becomes your return. So that's kind of what the paper does. And yeah, it's just meant for, it could be allocators, it could be investors, it could be just anyone who's interested in digital credit and Bitcoin-backed credit markets, to just give a quantitative framework for looking at it objectively.
Yeah, it's really interesting. We've seen in the discourse a lot of, among the critics of Bitcoin treasury companies, suggesting that the equity should trade at a discount because of all the risks associated with that equity position in the common stock. Do you agree kind of on a, not on a day-to-day basis, but from a valuation kind of theoretical perspective, should the common stock be trading at a discount or a premium for a company that's amplified Bitcoin?
Yeah, I think in general, like if we were to look at it from just raw valuation, if it got to a discount, I would say like you have a bit of a margin of safety there. And if it got to a premium, then I would say like this is probably, like I think some premium is more likely to be fair value. That being said, like the way I view the common equity of, I'll just call them pure play Bitcoin treasury companies that like don't really have a meaningful operating business, but they actively engage with the capital markets to grow Bitcoin per share. Let's call that like the core goal. So I think if you were to look at the common equity of this type of enterprise, you should think of the common equity as a call option on the underlying Bitcoin stack, right? And I think So it's kind of like a Bitcoin call option that is perpetual in its duration. And if we were to think a step further about how one would value such a call option, or how one would think through abstractly what the features of this call option is, well, a call gives you convexity, right, towards the upside. And you actually pay a cost. You might have heard of the term like theta, which is the time decay. But in reality, theta is not exactly time decay. It's actually the cost for gaining convex exposure to the underlying asset. So theta is actually the cost of gamma, vana, and volga. So those are three sets of higher order Greeks. So they're like second order derivatives of the first derivatives. And these are all convex exposures to volatility, to price, and to the volatility and price like cross, the cross derivative of those, that would be vana, right? So basically, theta is paid for you to gain exposure to those three higher order Greeks. And in the case of this common equity, your theta is your perpetual preferred stock dividends. That's what's being paid, right? So like the common equity is constantly bleeding in order to pay that theta off to maintain that convex exposure. And so I think that's really the right way to value this. If we were to go from like Graham and Dodd style, like securities analysis, from the core classics of investment valuation, like you could probably use a framework like SEEB, common equity Bitcoin exposure, right? You take the Bitcoin stack, you subtract out the notional value of your prefs and your debt and all of the credit instruments, everything that's not common equity, and then you say, like, oh, wait, this would be the common equities Bitcoin exposure, right? Now, I think that's a fair way to do it. If we were to tie it back to options, that would be kind of like the intrinsic value of that option, right? That would be like if the option was in the money and you're saying like, okay, this is how much is in the money, and everything above it, your quote unquote premium, that would be your extrinsic value of that option. So I think that would be like the framework that I would use. And frankly, for this digital credit report, it kind of lays the foundation for starting to think along those lines. And I will have a part 2 and probably part 3 that kind of elaborates on these like quantitative valuation methods.
So in Bitcoin bull markets, we've seen, for example, Strategy's MNAV expanded, I think, to like 3.5x. So within that framework, is that just reflecting the amount of volatility, the forward expectations on upside convexity, or was that like really a bubble that was overvaluing Strategy?
Yeah, I mean, I think both of those things can certainly be true. The way I think I would interpret it in hindsight is probably it was more bubbly than it was the other things that you mentioned. But, like both of those things can absolutely be true, just because in a bull market and in these events where price is ripping to the upside, obviously the price of convexity goes higher, right? And obviously the implied volatility of these of all underlying instruments within this stack, right? If we're claiming that the common equity is a call option on the underlying Bitcoin, then there's necessarily an implied volatility attached to that asset base. And the common equity's premium to its net asset value reflects that implied volatility. So like the market has a view on that implied volatility and the convexity that the common equity can give you, and it can place a pretty high bid under that, right? And I think I would say, like, speaking along this line is like, this will not be within my decision making anyway, but like for a treasury company to take advantage of these situations, like when their management team views that the securities that they have are let's say priced above fair value, then they absolutely should issue into the market, and that would be an accretive transaction.
And you know, wouldn't that reflect kind of the supply and demand for amplified returns on Bitcoin, that these vehicles will grow their balance sheets when there's a lot of demand? Do you think that the balance sheets will shrink in bear markets, or is it really just about paying the dividends, as we saw most recently? Strategy sold a fairly small percentage of their stack just to prove out kind of their business model. Is that do you think that's going to continue, or is that kind of a one-off just to prove that they can?
Yeah, I think in the future, like, this is absolutely something that we could see more of, just because if you're looking at it from the perspective of I want to maximize the value generated to the common shareholder, right? Then the name of the game is to sell stuff that is overvalued or relatively overvalued, and then buy stuff that is undervalued or relatively undervalued. That's it. Like, if you can consistently do that, everything else will kind of like work itself out, and then value will accrue to the common stock. Okay, like that's it. Now, obviously, all of this is somewhat contingent. All of this is contingent on Bitcoin like actually outperforming, right? Like, it's all contingent on that. Everything's downstream from that. But assuming that is the long-term case, then yeah, everything else from then on really is just about selling stuff when it is relatively overvalued and buying it when it is relatively undervalued. So from the perspective of Bitcoin versus the common stock versus all the other preferred stocks versus the cash reserve, amongst that set of assets, amongst that like Rolodex of assets, there's always going to be something that's relatively overvalued, and then there's always going to be something else that's relatively undervalued. As long as you can make the trades properly, then the value will eventually accrue towards a common equity.
And you know, to that point, I think that as strategy kind of discovered this menu of options over time, because they didn't start with all the options on the table, even though obviously in theory they were there. They were kind of going through the idea maze, and now that I think that they have made clear that they can buy or sell any of these different assets or equity instruments, it seems to have caused like a perception that they are not holding to promises that they would have made in the past, right? Of, say, not selling your Bitcoin. But obviously it seems rational for them to say that all options are on the table. And that's kind of how maybe you keep the short sellers away. It's how you keep demand for the preferreds coming in, that you have that full optionality. Is that the same way you see it? Or do you think that commitments to, for example, not sell Bitcoin are valuable?
Yeah, I mean, I would say I would actually take the opposite stance of what you said last. Like, I think commitments to not sell Bitcoin is actually not valuable. It has negative value because it is a short option, right? Like, you are now short an option, and now, like, if you had this option, now you've like by your own actions decided, okay, I no longer have this option. Like, you're kind of cutting off some of your own limbs, right? Cutting off your own resources. So that's how I see it. Like, I think ultimately it just comes down to what is in the best interest of the common stock, right? Like, that is what every company exists to do, is to accrue value to the common shareholder. And yeah, like that's the bottom line. So it doesn't matter about anything else really. I mean, obviously we'd like to see more companies buying more Bitcoin, and we'd like to see we'd probably rather not see more companies selling Bitcoin. But at the end of the day, like, the companies, like, they're beholden to their shareholders and beholden to value creation, not beholden to, some random idea saying like, oh, we cannot sell ever. Like, that's just not good and not how you do business.
And if we look outside of kind of the Bitcoin Treasury space and we look at other companies, it's pretty common for them to be buying and selling assets depending on what the valuations are of those assets, whether they're doing stock buybacks or issuing more stock, and doing M&A and spin-offs, et cetera. So this is kind of the new phase of active capital management that we're entering into. Do you think that another possibility for, let's call it, ideological flexibility would be on the question of using derivatives? We have not so far seen Saylor or Strategy implement derivative strategies like we might have seen with Metaplanet, for example. Do you think that's going to enter into their menu, or is that just would that create too much noise for them?
Yeah, I mean, I think right now the company has a lot of like an identity crisis of sorts. Like maybe it's not that way to management, like maybe they have an idea of what they want to do. But I think in public perception, there is that identity crisis. You know, I think anything can really be on the table. To the point about derivatives, right? Like, obviously, Saylor has made it clear, like, he probably wouldn't want to put more structures on top of it that, you know, potentially generate, like, income on the Bitcoin via derivative strategies or staking or whatnot, right? And that's very reasonable. He doesn't want to make the investment case more complicated. But that being said, like, here's one easy example for where derivatives could be a value add, right? Imagine if they have, so obviously they have a bunch of prefs, right? But imagine if they set aside some Bitcoin, they hedged that Bitcoin that was set aside for the prefs. I think that would probably like instill more confidence in the backing behind the prefs. Like if they set aside, so right now there's about $10 billion notion of stretch, right? And so they're like, okay, we know there's $10 billion notional for stretch. We're going to set aside $10 billion of Bitcoin, and we're going to hedge that with puts, right? So they pay money for these puts, and if that Bitcoin that is set aside for stretch, again, it's not like encumbered necessarily, but it is set aside like at least nominally. Like the company does say like this much Bitcoin has been set aside, and we're going to put a hedge on it to make sure that its USD value doesn't fall below a certain point. Like, would that be positive or negative for the digital credit? I think it would be fairly positive. It probably would be viewed like something akin to a cash reserve. Functionally, it's kind of like a cash reserve if you're saying that, you know, it's not going to go below this point. So the flip side of that is if you buy a protective put on some Bitcoin, that is logically equivalent to just buying a call option at that same strike, right? It's the same return profile. So if you've justified, okay, we're going to set aside this money for this Bitcoin and protect it with puts, now you've obviously also justified, like, we'll set aside this cash reserve, but then we'll use call options to have Bitcoin upside exposure. And so now you can clearly see, like, simple derivative strategies certainly can make total sense, right? What I probably would not see happening is something where they're like, okay, we're going to do a sophisticated options market making kind of deal and then use our Bitcoin as marginable collateral to open these trades. Like, I don't think we're going to see that. But, you know, again, I think anything could be on the table.
Yeah, that makes sense. You know, you mentioned on kind of the protective put side, they already have these cash reserves for future dividends. That is credit positive for the preferreds, but it's also introducing cash drag for the common. How do you think about that trade-off in terms of maybe their cost of capital on the preferreds versus the drag?
Yeah, so I would say mathematically, and I've written about this like on Twitter and whatnot, but mathematically, they are not going to maintain a N-year constant amount of dividend coverage. It's impossible because, like, just think about this. If you're going to keep issuing more digital credit, and let's say you issue at, let's just keep numbers simple, at a 10% cost of capital, right? So every year you issue this share, and the share is worth $100. Every year you got to pay $10, right? If you wanted to maintain 3 years coverage on that, like, you know, like now you have, that's 30% of your value. Is 10% times 3 years, now that's 30%. So every $100 you raised selling this thing, you have to set aside $30, which is kind of like a, you know, it's not exactly this, but it's kind of like a loan origination fee of 30%. So this is like, you know, like there's an extent where this is like, okay, this is unacceptable. I will say, to the point of the discourse around the USD reserve, the true origin of like where this all came from was the S&P credit rating. They did the S&P credit rating like October of 2025, and in the credit rating, the agency specifically said, hey, it would be nice if you guys had a cash reserve. That's where the origin of all of this comes from. Okay? It wasn't like an idea that they just like thought up of. It was something that, you know, was specifically prescribed, and then they decided to act on that prescription, and now they have that reserve. And so the point of this reserve was always to just get your foot into the credit rating agency's door so that you can get a good rating on your prefs, and then this way you can sell more prefs, hopefully at a lower cost of capital. That was always the plan. It could have been, you know, now it might have, like, because of a lot of market fears and whatnot, things could have shifted towards like, hey, we need to make sure this cash reserve is always up and at all times. But I'm just saying, like, just trying to sound the bell here is just like, it's not going to happen in the long run. Like, if you are of the position that more and more digital credit will be issued, then you cannot simultaneously be of the position that this N years of dividend coverage will be maintained, where N is a constant number. Like, N has to start going down over time as more credit get issued, right? So I think that would be how I view that. I think a lot of fear is in the market right now, and the company unfortunately has to also respond to that. So that's kind of how I see like what's going on with that.
And do you think the cash reserve should be set aside for situations where companies simply don't have access to capital markets, and so it's their last resort, or to use it more strategically, like Strategy did earlier this year with paying off part of their convertible debt?
Yeah, like so this one I kind of want to take it away from just Strategy, right? Because, you know, there's companies in general that like have Bitcoin, and they can also have some cash. If a company just had Bitcoin and cash, the cash should obviously be deployed, however it is that would be most value accretive at that moment, right? And given the facts and the long-term time horizon as well, right? So incorporating all of those facts, what is the best course of action right now? So, you know, in general, that's how you should always like use cash, period. And then also, if a company had an operating business that was throwing off a lot of cash flow, and they also had liabilities that they needed to pay because they were financing their Bitcoin purchases, well, now they don't really need that cash, right? They don't need that cash to keep it to pay coupons or dividends or whatever, because they have cash flow from their operating business that they can use to pay that. So that question and the results of that question kind of change when the parameters change. With Strategy, like, unfortunately, they don't have that operating business that is able to throw off that much cash flow to pay all those dividends. So to the credit markets, it's like having that USD reserve is an insurance policy of some form. And because of that, like that's why they're stuck in this kind of situation. If they were to take that cash and deploy it, the deployment logic still is the same with any operating company. It's just whatever is most value accretive at that moment. given all the facts.
Yeah, that makes sense. And then there's also kind of the sequence of returns problem, right? Where even if we're long-term bullish on Bitcoin, outperforming the preferreds, in the meantime, we could have a very long sideways bear market and cause kind of issues. How do you think about the sequence of returns issue for Bitcoin Treasury companies? Is the 4-year cycle over? Is kind of the other big underlying question there. But
yeah,
yeah.
I mean, sequence of returns is ultimately the main variable and question mark whenever you're dealing with any kind of leverage, right, or amplification. I know there's people make that distinction, but for our purposes, I'll just say leverage, right? So anytime you're dealing with leverage, you have the sequence of returns. When it's margin leverage, your sequence of returns is just super time sensitive, right? It's like within a day or two. And if you're doing these kinds of like perpetual preferred equity given leverage, then you now have more time to be correct about something, and you've given yourself more time. But over this time, right, like given a poor sequence of returns, you will see the common equity get absolutely crushed. And this just comes back to what I was saying earlier, like the common equity should accurately be thought of as a call option, and that call option throws off decay of some form, like some kind of cost needs to be paid for access to that convexity. And so if you got access to that convexity for, let's say, 3 years, and 3 years, no big event happened that allowed you to profit from that convexity, well, then you would have been paying a lot. You would have been bleeding a lot, right? So, of course, your call option would be severely degraded in value. And that would be a common equity that got crushed by a poor sequence of returns. In terms of the second part of your question, the 4-year cycle, like for me, it's like I mean, I think we cannot deny that the 4-year cycle came on time, at least for the top. Like as far as like this time it was concerned, like it came exactly on time. Going forward, I do think like it's eventually going to fade because I don't see any like economic reason for why it needs to continue. But I cannot deny that empirically it has held up so far. If I were to guess, I would have to guess like, hey, most of the market's probably thinking that October of this year will be around where the bottom is. I don't think the bottom is going to be as extreme as in prior bottoms, right? Just like the top this time wasn't as extreme as prior tops. So that's kind of my view. It's like kind of, we'll more or less follow in lockstep this time around. And yeah, but things will be fine in the long run because I think the fundamental properties of Bitcoin really haven't changed at all. And if anything, the surrounding like political, institutional, and other kinds of backing behind it have only gotten stronger. So I think the long-term future is very, very sound. It's really these like, intermittently you have these kinds of issues. So that's my view on the 4-year. Yeah.
So on the point of cycles, there's kind of the diminishing returns thesis that every Bitcoin cycle has underperformed the previous one. And then we saw gold have a massive generational run over the past few years. And it's obviously much bigger than Bitcoin's market cap. I think it's 20 times bigger than Bitcoin's market cap. So in my mind, at least, it kind of invalidates this rule of thumb of saying, hey, the bigger the asset is, the harder it is for it to move. On the other hand, gold has been driven by central banks buying, and we don't really have that on Bitcoin's horizon just yet. We'll see how the strategic Bitcoin reserve develops. But what do you think have been kind of the catalysts for this bear market? Is it just the OG selling, or are there other macro factors that we should be looking at?
Yeah, I think it's I think it really does not have to be more complicated than OG selling. If you look at other macro factors, I think the last time we talked, we were talking about AI. Like AI can draw attention away from Bitcoin. Like, and I said, look, even Polymarket can draw attention away from Bitcoin. And all of these things kind of pool together insofar as factors that can influence how a cycle plays out. We have 3 very big IPOs, like the biggest of all time this year, right? That's going to pull a lot of capital out of assets. Whether we like it or not, like Bitcoin is still roped in broadly, largely, as a speculative asset, right? And so that is going to, new and hot and like really fashionable IPOs is by definition going to compete with that same theme for Bitcoin. So I think that's just what's been going on. But it doesn't really have to be more complex than OGs have sold, and them selling doesn't really have to be more complex than, hey, look, they've done the 4-year cycle like 3 times now, and they're just like playing in lockstep with how things have happened as they've seen it. So I don't think we need to ascribe more complex theories to that than just things are just following the prior lockstep.
And so this will come off as 2020 hindsight, but you'll hear people say, strategy, these other Bitcoin treasury companies, they were buying a lot at the top when they could raise a lot of capital, and they were immediately putting it into Bitcoin. They should have raised the capital and then DCA'd in or waited to time the market. Do you think that there's some truth to that they should be market timers, or should they be pretty agnostic as to when they're buying?
I mean, so I think there could be some truth to it, but I think the real mistake people make is that they're kind of taking on the perspective of what they should do as natural persons and then extrapolating it to how a corporation should be. Like if you were a natural person, and let's say you were just borrowing money or whatever, like you might want to like DCA it, right? And that would probably like smooth out your returns. With a company, it's not real. I don't think it's that big of a deal with a company, because at the end of the day, like the less moving parts, the better. And you want to keep things simple. If your policy is to buy Bitcoin, or if your policy is to increase your cash reserve, then whatever money you have coming in would just go towards whatever standing policy you have. And then you can kind of leave a lot of like variables out of it. And I'd also propose that the flip side of this is, people are basically just talking a lot of trash during a bear market. And so, of course, every week, you bought in the prior week and this week it's a little lower. It looks like you had a terrible entry price. But on the flip side is, if this was a bull market and every week it was lower than, the current week, now it looks like he's buying below spot, right? So it's like if you just look at the perception and like did not really think too much about it, you'll always get the wrong and more biased view, and that'll always be your conclusion. But if you just think about it a little bit more, it's not really that bad. If you get the money, just use the money towards whatever policy makes the most sense for the company right now. The bigger question is like, is the money being deployed correctly between cash, and then should we even be issuing prefs at this time, or should we even be issuing common at this time? Like that's really the bigger question. I think like I would probably have liked to see the discourse more focused around that.
It seemed like the prefs, STRC, when it hit $100, they were issuing more. It seems like there, as a practical matter, wasn't really a ceiling on how much they were willing to issue. And then they started trading at a discount. I've seen rumors that it was because people were leveraging up on top of the prefs to capture some spread with margin loans on their stock portfolio or something like that, and then they get liquidated and are forced sellers. Do you think that the trading band and the communication about the $100 par value that needs to evolve, or that there's some kind of game theoretic changes that need to be made to the instruments themselves?
Yeah, yeah. This is a great question, and it's a very, very deep topic. I don't know if I'll be able to fully cover it like here. So, I think the bottom line up front is, they were ultimately contending with something called the impossible trinity, right? And this is a topic that is very, very, it predates Bitcoin by like decades, right? It basically states that within any economic block, you can only have two of the following three things, right? You can only have either, you can peg I know it's not like a true peg, but I'm just going to use that word because that's what the textbooks use. But you can have a pegged or a fixed exchange rate. So in STRC's case, this would be the promise that it will trade at around $100. And again, I know it's not a promise, but this is like the implied. Okay, so so you have the fixed $100 price. You can have free capital flows, which means people can freely buy or sell, exit the system, which is always going to be true because it is a security that trades on the NASDAQ, right? You cannot impose capital controls there. And then, of course, you have the third thing, which is sovereign monetary policy, which in this case is just the ability to control the dividend rate. So that's the impossible trinity. Of those three things, you have to pick two. You cannot have all three. You've already said you're going to keep it at $100, so you've picked the fixed exchange rate. And you've already listed it on the NASDAQ, so you've picked the free capital flows. This means you no longer control the dividend. Now, if that's the case, then you're completely up to the whims of the market. And yeah, so if the market's going to push the price down, you will now have to raise the dividend. And there's no choice. And the only choice you have would be to compromise on the first thing, which is the $100 stated amount, like having it trade there always. So what has ended up happening? Well, I think the market, quite frankly, has pushed it down. And, like you remember, I think back in, back when Stretch had first started, it was trading at around 92-ish, and they suddenly raised it like 100 basis points. Remember that? Like they raised 100 basis points to like force it back towards 100. And now we have Stretch at like, at the time they made this decision, it was like below 87, right? So below 87, they only raised it 50 basis points, right? So you can kind of see how there's already starting to become a compromise on the dividend side of things. Or the statement that was issued, might have been 2 weeks ago or 3 weeks ago, but basically it was the one where they had that new policies, like new everything, right? And part of that statement said, we will no longer raise the dividend on Stretch just because it is trading below 100. So when I looked at that, I'm like, well, this is clearly the company saying that, like, hey, look, we're not going to guarantee that this $100 fixed rate is going to hold. So this is them reclaiming control over the dividend, right? So in the impossible trinity, this is them saying, okay, I'm not going to do number one anymore. I still have to do number two, which is because it's listed on the NASDAQ. And then I am going to reclaim control over number three, which is the dividend. And that's perfectly okay. That's perfectly okay. They have every right to do that. It's their pref. It's within the rights of like the prospectives for the security. So that's fine. But I think in many ways it was needed. Like this was going to happen sooner or later. Now, the other thing is like, should we materially change the security? And I think this is probably even more interesting than everything we had just discussed because, like personally, I do think that there is room to make some changes. First of all, this is a floating rate instrument, or rather, it's a variable dividend instrument. If you look at the market for floating rate notes, for example, they tend to have about like 2-year maturity. So in 2 years, something has to be paid back. The principal has to be paid back. And then the way the coupon is adjusted is every day you snapshot the SOFR, and then you put a fixed spread over it. Okay? So the spread itself is fixed to the value of the principal, the face value of the note. And then SOFR, of course, is what floats. SOFR is the only thing that floats, okay? So to all of these other instruments that are floating rate, SOFR is really what makes them floating rate instruments. It's by virtue of the fact that SOFR floats. That fixed spread isn't floating, okay? If you look at digital credit, it's completely different. Digital credit, it floats by virtue of the fact that the price, we are trying to keep the price stable. The price is not at $100, then we change the dividend. That's why it floats, right? So that's potentially a problem because like it makes this thing a little too different from the others. So that's potentially a problem. Another thing is, and this part, it almost pains me to say this because I do view perpetual duration as a good thing. But I think to a credit investor, right, the fact that something has to be repaid at some point is an anchor point on objective value. Like if I know for a fact, like 2 years down the line, I am going to be paid the principal, and like this is their obligation to do so, then I have that objective anchor point. If all I have is this promise that this dividend will be paid, but then the dividend can also be suspended if something happens. Like now you can see where, you know, to me as a credit investor, I would either have to attach a huge spread onto it, like a huge credit spread, or I would really not treat it as credit at all and treat it as something that should trade with more volatility. And if everyone else in the market kind of thinks that, you will have the volatility that we just had, right? So I think like this is a natural outcome of the economic incentives, and if we want to change this outcome, we have to change those incentives. So one thing I would like to see them at least consider is perhaps put some kind of investor put into these instruments. Okay, like if the stated amount is at $100, they could put the put at like 85, and then every 5 years, every 5 years, like let's say, the investors are allowed to put the security back to the company, force the company to buy at 85. What that's going to do is, first of all, it now creates the objective anchor point. So it kind of mimics what the floating rate note does, right? But also, you know, it keeps the perpetual duration. It's just no longer like a Macaulay duration anymore, right? It's more of a it's duration by virtue of the fact that, you know, this thing doesn't expire. But then again, if it gets putted, then it's done. So that's kind of the new game theory. And if we then look at this new game theory, as we approach that 5-year put date, what's going to happen is the price, if it's below 85, will go towards 85. And once it goes towards 85, you also have the perception that, hey, if I don't put it to the company, then I earn the dividend, and so maybe it goes to premium to 85. And if it goes to a premium to 85, they wouldn't put it anymore. They would just sell it if they wanted to get their money. You see? So I think something like that could create more stable dynamics to digital credit. But that being said, like, is it even possible to amend stretch to that extent at this time? Like, I don't know. But I'm just saying for other like companies that might be looking to issue these credit instruments, these are things to consider, right?
So first on your point about the put, couldn't the investors overlay the derivative on top of the instrument? I think that now there are options chains on the perpetuals. Do you think that's a reasonable approach, or it really has to be the issuer to put in this protection?
I think the issuer would have to do it because the options market right now, I mean, it definitely got a lot more liquid after the sell-off, but you know, it's just not enough to accommodate the size, right? Stretch is a $10 billion notional value asset. There is not that much options trading on it, so it would be nice, it's true. Someone else could buy the put, but when you're talking like a really large scale, money manager managing a bunch of money, like this is not an option for them, right? And ultimately, those are the pools of capital that we were looking for in the first place. So I think creating that accommodation of the investor put would it would probably fit that bill a lot better. It'll make them feel a lot more comfortable, right? Because then it feels just like one of those floating rate notes that they would otherwise buy. So yeah, those would be like my two addendums, right? Like, forget the variable rate that's based on the price. Just like make it SOFR plus spread. You make it SOFR plus 700 bips. That's more attractive than any floating rate note. Okay, like SOFR plus 700 bips, and then we can go from there. And by the way, if it's really SOFR plus 500 plus 700 bips, like you will eventually get it to trade above 100. Because these things, it's not going to stay like that forever. Like once the market like wakes up to it and they're like, yo, this is actually a good instrument and the risk isn't really that bad, it will like break the peg, but it'll go to the upside now, right? And so of course implied within this is also just remove your 101 investor call, right? Remove that $101 strike price to call everything back at 101. Allow it to trade above par if needed. I think like SATA did something like that. They were like, yeah, we can suggest that. But what they were doing was more so like saying, hey, like this would deter the shorts from putting on short positions at 100, which of course, right, that's a reasonable deterrence. I just think long term, it's probably better to not target a stable price and better to just act more like traditional floating rate notes.
Yeah, and so that's a really interesting proposal with the SOFR plus. I think that makes a ton of sense. The protective put just it sounds expensive for the common stock to underwrite that.
I think it's like this. Like, I think ultimately, with something like that, the company will not issue as much digital credit as they did right now, right? Like imagine if they knew 5 years later, like we might be on the hook for 85 cents on the dollar, right? Then they'll be more careful about it. But, and so what that would lead to is A, they buy less Bitcoin in the meantime. But B, like they probably have higher quality buyers. And this is the part where I think no one's really talking about, is that like right now, I believe most of the buyers, first off, we know most of the buyers is retail. Okay, like Strategy has their own deck. It says like for Stretch, about 80% retail ownership. But here's the other thing, okay? And this is the part that like people don't really think about that much. The 20% that's not retail, at least 6% of the 100%, about like 600, like $600 million of Stretch was owned by these DeFi protocols. Now that's probably I'm gonna assume, right, that's gonna come across as institutional. So, but like, that's institution ownership, but what's really behind it is just retail. It's like no institutions really use DeFi, okay? So like, what you really have is probably about 90% is all retail ownership, and they're all trying to do these like leveraged looping kind of things, right? And so that's the quality of the investor that you have under this current model, right? Because they think like, oh, you actually are going to make sure the price goes back to par, and you're just going to keep raising the dividend. So as long as I can like maintain this margin position, I can keep pocketing a spread. Those are the incentives at play. Whereas if you had other buyers who see that there's the investor put, they will come in and, they're not going to be the type that does those kinds of those games where they leverage loop something. And now the behavior of your investors is necessarily going to be different, right? So when you have a first wick down or something, everyone isn't getting margin called. They're just looking at their investor put and they're like, yo, like we're going to be okay. Like worst case, we hold to when this put expires and then we just exercise it. and that becomes the new dominant mentality for that market, right? For the market on that instrument. So I think there's something there. Like there's something to consider about that. You won't sell as much, but your buyers will be probably quality buyers that's not trying to play these kinds of games that'll ultimately just make everyone look bad, right? Because look, if you promised that this, I know they didn't promise it, but if you're marketing it as like, hey, this will more or less stay at this trading range, then it doesn't for an extended period of time. That looks terrible. That looks awful, right? So these kinds of faux pas just won't happen as much because the investor base will be different, and I think the credit looks more like traditional credit and less like something too new and too like out there. And I think there are benefits to doing it that way. But to your point, it is going to be expensive, right? And it's expensive on the one sense because, you know, we cannot issue as much. But it's expensive on a different sense because, look, if we have to accommodate like huge lump sums of exercise, then, you know, we'll have to be much more disciplined with how we manage cash. But again, I will say, right, assuming the asset coverage is there, the exercises should never happen. Does that make sense? Like assuming the asset coverage is actually there, it will always go above 85. Once it goes above 85 or whatever the strike is, right, it'll always go above there, and it'll peak a little bit over that because there's a dividend yield in the future if you don't exercise. Because it peaks a little over that, they will never exercise because they're going to just sell on the spot market. The other thing is, if they end up having to, if investors exercise anyway, and the shares are trading above spot, you can ATM to just like raise the money and just give the money back. You know, like you could do that. So, I think I know the put is kind of, it could be more controversial, but I think if you think it through, it's like there's actually some optionality there, and the upside to it and what you gain from it could make it worth considering. So that's kind of my idea.
Yeah. Okay, just to pressure test it a little bit more, because I think it's a really interesting idea. If in 5 years you see this kind of flash crash, right, where there's stress in the market, not for any underlying credit reasons, not due to a lack of coverage, but purely because there's more sellers than buyers. Does that kind of force the company's hand when really they should have been able to ride through it?
Yeah, it does. In that case, it definitely does. But if that happens, right, like there's literally no problem in just selling the Bitcoin and then like meeting those exercise needs. Like there's literally no problem with that. They can also preemptively, like if it goes below the strike, like let's say we are 3 months out, right? 3 months later is going to come the exercise date. And then it falls way below. It falls to like 75, or how it fell like this time, right? At this time, the company is like, all right, so 3 months later, we're going to have to pay back 85 cents on the dollar. Right now, it's at 75. Let's just scoop up as much as we can at 75, right? Like this becomes a, at that point, you're accretive. You're 100% accretive because you're buying something below the point where like you know you're going to be obligated to pay that money. So that would be an action to do, and this would be exactly what the cash reserve would be for, right? Like for stuff like this. Frankly, the cash reserve isn't for paying dividends because they sell Bitcoin or common to pay the dividends anyway, and the cash doesn't get depleted. So it's like this is the type of thing where you can deploy cash in like larger quantities.
Yeah, that makes a lot of sense. It's a really interesting idea. The other question I would have along those lines is, you know, the effective yield increases as the price of the preferred goes down, and doesn't that just naturally attract more investors or even just short-term traders who kind of see that it's mispriced, and so the issuer doesn't need to do anything, or do they have, again, promises made to keep it close to 100, and so they have to do something?
Yeah, so I think it's valid to assert that as the effective yield goes up, it draws in more buyers. But then I also think like that mental model only works within like your plus or minus 1.5 standard deviation type of event, right? Like once you go outside towards the tails, you have no idea what's going to happen. So this is something that we have to be very careful and precise about, because like ultimately the way normal credit assigns the value is because there is that repayment date. That's what anchors the value. If you just have an instrument that throws off dividends, but then it never has to like pay the principal, you have a situation where everybody in the market now knows that the next time I can get out and get my principal back is completely up to the whims of all these other people that are playing around in this market, like I am. Like which one do you think gives more confidence? Like the first one where like, hey, I'm definitely gonna have to be repaid at some point, like 2 years from now, or like 6 months from now, or some specific date from now. Or the second thing, which is like, oh yeah, I can do this right now and it would be a high yield play, but when I have to exit, I am completely subject to whenever that future spot price is, and I have no idea what it's going to be, right? So that is clearly, yes, that could attract traders. That could attract people who are like long-term, short-term, right? Who are more short-term than long-term. But now think about it. Like if your entire premise was we were trying to sell to the credit markets, but now you're saying, hey, now we just want to attract traders who would leverage up and who would like try to go in for the high yield. Are you really targeting credit anymore? Or are you targeting people that are more short-term traders, right? Not that it's wrong to like sell instruments to short-term traders, but you know, if the stated goal was to like sell to traditional credit investors, and then in fact you are not doing it because of the way you've structured the instrument, then I think something is wrong there, right? Like maybe it's not legally wrong, maybe it's not like even wrong for the company to do that, but something is wrong in terms of like how you're presenting it, and then like what's actually going on, and there's a disconnect about that.
Like a product market fit issue, really. So this raises an interesting question, which is that rather than positioning the preferreds as better than a money market fund, for example, or kind of like a savings account where you do have kind of par, create, redeem, right? You don't have to worry about the principal. Positioning it as more akin to buying a piece of real estate, home, let's say, to rent it out, and that you'll earn the income stream of rent, which will be stable, but your ability to sell it at par is not guaranteed, right? So really the decision-making process should be about, do you want this stream of income, and how confident are you about the future dividend rate, rather than trying to worry about can you get in and out of the principal at par. Does that make sense?
So are you asking me like
the marketing, the product market fit is of a longer duration than what kind of has been floating out there of, oh, this is like cash?
Yeah, I mean, I think if you're talking about it and like you're marketing your security as the issuer, yeah, you shouldn't use the kind of like cash thing. I think that's not the best like legally sound way to characterize it. But then also like it is hard to do marketing, and it is hard to like grab people's attention. And so I understand like there are incentives at play that just because of how attention starved that everything is, right? It's just like you have to try to grab people's attention, and then you have to make outstanding statements in order to do so. This is just, I think, how things are in the social media age, right? So, it's one of those things where we could wish it were different, but I don't think things would change that much. But that being said, like, the larger point is absolutely correct. Like, I think something like Strife, for instance, right? The most senior pref that just, like, it's basically a perpetuity. With, of course, a risk, with a credit spread that needs to be attached to it. But, like, that's a very good security, like, all things considered. If you are truly a retiree, then you've like did your math and you're like, all right, from today until when I retire till the day I die, like, I'm only going to need this much money per year. This is how much Strife I'm going to need to, fill that part of my investment portfolio. Perfect. Like, then you don't have to worry about the price. So, like, if you're truly a retiree, like, yeah, there is a point to be made. Like, why bother if the price like collapses below your entry price? Because as long as you're still getting paid the dividend, that's what you bought it for, right? Sure, like, what's the problem? But again, like, I think the pain that is felt in the market, like, at least over the last month, is just frankly because those were not the buyers. The buyers were people that were leveraged long. They were probably trying to earn some, like, carry spread, and they're probably trying to, like, be the first ones out as soon as anything went wrong. And then a lot of them just got caught flat-footed, and that is how we saw the cascade that we saw. So I think that's really how it is. And part of it is also, like, the super conservative investor that's just buying this for retirement, they're probably not looking at something like this that isn't rated, right? Like, you just have to think that, like, there's just all these other variables at play, and strategy is in a very hard position to have to balance all of this, right? It's a difficult thing to need to balance everything and make as much people as possible happy. So I think that just also needs to be something that's considered, right? Like, it's hard. It's genuinely hard. Not that it's an excuse for anything, but it's just difficult.
And on that point, as people kind of get more educated and see the track record for these over multiple years, is that how you change kind of the investor base for these instruments from short-term to more long-term income, or do you stick by your thesis that there needs to be product changes?
Yeah, I mean, I want to clarify. Like, I'm not saying there necessarily needs to be. I think what I'm suggesting would be very helpful. Like, very helpful certainly in the next, like, 2 years. Long term, I don't think like these instruments are dead unless the Bitcoin thesis that we all have is wrong. Okay.
Right.
Like, that's where this is all downstream from. So as long as like I think ultimately what happens is once the bear market ends and the bull market returns, like, all of this stuff will be bailed out at the end of the day by the rising Bitcoin price. Okay. That's just what I think would ultimately happen here. Like, we can suggest all of these things, like Saylor can and his team can put out these, like, new frameworks and whatnot, but this is all to just try to outlast the bear market.
And on that point, do you think there will be instability introduced in the bull market by people selling the preferreds to buy the common because now they think that's going to outperform, and then vice versa in the bear market, them at the beginning kind of just dumping their common stock to pick up the preferreds, and we'll constantly see this back and forth rotation? Is that destabilizing?
I think it'll happen. I don't think it'll be destabilizing. And the main thing is during the bull market, you'll just have so much more demand anyway. So, and remember the flexible load here, right? To use a Bitcoin term, right? The flexible load here is really just the ATMs. Like, if a lot of people want to buy this thing, but then also a lot of people want to sell it, then the ATMs just won't run as hard. But if a lot of people just want to buy it and the demand is like gushing and overwhelming, then the ATM will run however high it needs to run, right? So that is how I think it is. Like the flexible load here is the ATM. And so I don't view that as a destabilizing factor.
Yeah, that makes a lot of sense. Allard, I've really enjoyed our conversation today. Is there anything that we missed? I want to encourage people to go check out your research report and to dig into it. But before we sign off, are there any major points that we didn't address?
No, I think we've covered a lot. We probably need like another hour or so to talk through like all the stuff happening on the protocol side. Like it's also lots of stuff going on. But yeah, on the corporate side and digital credit, I think this has been comprehensive.
Awesome. Well, thanks for coming on the show, and thank you to our listeners for joining us for another episode of the Bitcoin for Corporations show. As we travel through this bear market, I think now's a great time to be learning more and absorbing kind of what's going on. So we hope you'll join us on the next episode, and don't forget to like, subscribe, leave a review, and share it with your friends and family.
All right, welcome back. Checking on shares of Strategy higher after the company sold more than 1,600 Bitcoins last week, raising roughly $105 million. Now, it's part of a major overhaul aimed at shoring up Strategy's finances and rebuilding some investor confidence, including buying back preferred stock. So will Strategy's strategy work? Joining us now for a first on CNBC interview is Strategy CEO Peng Li. Thank you so much for joining us, Peng, for this. As I'm looking right now, the prices for Bitcoin just a little below 64,000, so call it roughly half of what it was at the highs just in the last 12 months alone. We're closer to the bottoms here, the 52-week range, than the top. What exactly is your outlook for it, and how exactly are you navigating this kind of price action given your corporate balance sheet needs?
Yeah, look, I think Bitcoin is going through a bear cycle right now, and some of that is external macroeconomic. I think there's a major funding that's happening with AI. I think there's uncertainty with interest rates. There's uncertainty with wars around the world, and there's uncertainty with governmental legislation. We, as a company, went through this in 2022. Right? We actively manage our capital structure. We rotate into Bitcoin. We sell Bitcoin when we need to, and we'll continue to do so. And we'll get through this bear market. And what strategy is designed to do is to outperform Bitcoin in a bull cycle, which I expect to happen next year.
You mentioned those factors that were driving some of the downside action and sentiment. It wasn't that long ago that many of those factors were reasons to be in cryptocurrencies and specifically in Bitcoin. The fact that they were decentralized from traditional finance. The reasons because you didn't have some of the exposure to fiat currencies and some of the geopolitical aspects, cross-border transactions. Why that sentiment shift, and how do you get back to a zone where Bitcoin becomes one of those positive plays on those uncertainties yet again?
Yeah, I think that'll still be the case. The biggest catalyst that will start to cause Bitcoin to move forward is legislative clarity. And what I mean is we need SEC and the Treasury and the CFTC to move forward with a set of excellent rules that they have planned to allow tokenization of real world assets, to allow stable coins to be implemented. What'll happen then is large banks, and we've seen them, will start to move into this space, and that'll be a major catalyst for Bitcoin. And I think that'll also allow Bitcoin to be the inflation hedge that we expect it to be.
Following our graphic just showed that your average cost was $75,000 per Bitcoin, and we're at 63 today. So are you a forced seller of Bitcoin?
No, we're not a forced seller of Bitcoin. The average cost is not that important to us. It's really was where our Bitcoin purchases accretive to our common shareholders and our Bitcoin per share, and they always have been. We're selling Bitcoin from time to time, and you know, we've shown that our Bitcoin sales are not really a major portion of what occurs in the market, but sometimes it makes sense to sell Bitcoin to add to our US dollar reserves. Sometimes it makes sense to pay dividends, and that's what we've been doing.
When we spoke about this last time, the first time you had sold, you said it was to test the market. What is the rationale to shareholders for why selling Bitcoin gives them more value per share, when the original idea was that buying Bitcoin as it continues to move higher would give them kind of leveraged returns? Now, of course, your shares are down by half. What is the shareholder value you're creating by selling your Bitcoin here?
Well, I'll start with the big picture, right? The big picture is we have net 170,000 Bitcoin we've added this year. We've added over 35x the number of Bitcoin that we sold. So I think focusing on the sales of Bitcoin is really focusing on a very small amount. We've done it in the last couple of weeks to pay dividends. We've done it the last few weeks to buy back Stretch, which is trading below par, and that's accretive to Bitcoin per share when we do that.
Michael Saylor, the chairman of your firm, has basically put on social media that, you know, while strategy has been a seller, to your point about some of the corporate machinations around your balance sheet, but Michael Saylor on X said, when I say never sell your Bitcoin, I speak as no one savor to another. I have never sold mine, not one Satoshi. Strategy is a public company, not my wallet. Since 2020, it has disclosed it may buy or sell Bitcoin and managed capital. Our shared conviction of Bitcoin remains unchanged. Michael Saylor says he's never personally done it. You have to do it for corporate purposes because of what you just mentioned. How exactly then do you view that future of it, given the fact that you may not have to operate with the same kinds of parameters that Chairman Saylor does?
Yeah, look, we have 842,000 Bitcoin. That's over 4% of the world's Bitcoin that will ever be mined. We're the largest institutional holder of Bitcoin. Last quarter, we passed BlackRock. We're the JP Morgan of the crypto economy. So whether we sell 1,000 Bitcoin out of 840,000, to me, is irrelevant to the conversation. The conversation is, what is our role in Bitcoin? And are we adding Bitcoin per share overall to our shareholders? And are we creating value? I think that's an unequivocal yes.
Feng, you said that one of the reasons you sold the Bitcoin was to pay your dividend. Would you have been able to pay the dividend without selling the Bitcoin?
Yeah, we have over $4 billion of cash now on our balance sheet as a U.S. dollar reserve. We could use that to pay. We could use that to sell the Bitcoin to pay the dividend also.
And Fong, just how much, and I want to get this because this is not just about your firm. There is legislation tied up in Washington, D.C. right now, namely the Clarity Act. How important is the Clarity Act to not just yourselves, but the entire crypto industry for its path forward? And we're just showing some stats right now from Kalshi. Will the Senate vote on the Clarity Act before August recess? And the majority, 72% of respondents there at Kalshi, say no.
There is rulemaking behind the Clarity Act that has been put forth by Commissioner Atkins at the SEC, by the CFTC, Treasury Secretary Besant. There are rules ready to go, and they're either going to go with clarity, with the legislature behind them, or they're going to go without clarity with the power of the executive branch. So I think the most important thing is decision on clarity one way or the other, and the rules will get made.
All right, Fong, thanks. Really appreciate it. Good to check in with you again.
All right, thank you.
Fong Li, CEO of Strategy.
I'd say what we're experiencing right now is kind of like a financial earthquake, and this capital structure is designed to withstand and be standing after the earthquake is over.
So I'll start off with a question for Jeff and then open it to the panel. So obviously Strive was really the first issuer to have a cash reserve backing the preferred equity dividends, right? Plus the Bitcoin on the balance sheet and the good faith of the issuer. What were those conversations like? And kind of what intel can you give us from institutions as to what they're looking for in these digital credit products?
Good question. Yeah, we were the first issuer to have a cash reserve. When we were going to market, because we were a small Bitcoin treasury company and we didn't have a 800,000 Bitcoin like Strategy did, we had to have a few more investor protections in place in order to instill confidence in going out to market with the product. So we had the cash reserve, and the idea was the cash reserve is effectively first line of defense for paying the dividend in the future if we're unable to, raise equity capital or generate yield on top of the Bitcoin. So, and that thought process has evolved a little bit as we're managing our balance sheet to understanding that there's volatility in the underlying Bitcoin. We want to generate and create a good credit to the market that there's confidence that we're going to have the ability to pay that dividend into perpetuity. That's the entire concept. So as many have seen, as we have evolved and issued more SATA into the market, we have been growing that cash reserve in lockstep with the growth of the underlying instrument, as we're trying to emphasize to the market that we are here to withstand market shocks and market volatility. I would say what we're experiencing right now is kind of like a financial earthquake. And this capital structure is designed to withstand and be standing after the earthquake is over. So that's kind of how we view it, that cash buffer is the first line of defense. We also hold STRC on our balance sheet as a moderate duration instrument, understanding that we are holding this for a long duration.
Okay, amazing. I really like that perspective, and I think it's really unique that you guys pioneered this sort of duration matched liabilities curve on your own balance sheet. So Tyler, when you're making investment decisions and talking to institutional allocators, what are they saying to you? Do they value the cash? Do they value the Bitcoin? Do they value the liquidity and the equity? What are they saying they need from a preferred equity issuer to be comfortable in that instrument? And then furthermore, I know recently Strategy made some management decisions around the way they're managing their cash reserve. It was cut in half to pay a convertible dividend or a convertible obligation. And this was credit positive, but it seemed that the market was a little bit wary of that decision, and there's been massive volatility and stretch. What are the things you're hearing about this sort of decision making, and what would you advise a company to do with regards to the cash management?
Well, I got to give hats off to Strive for kind of pioneering this concept. And you know, when we're talking to traditional fixed income investors, they're used to underwriting credit risk based on cash flows. And so I think, you know, in a model where you have these digital credit issuers that have a strong cash flow engine, where they're you know, able to pay the dividends from operating income every single month. I think that model is easy to underwrite and understand. When it's purely asset backed or a balance sheet type calculus, you know, what the cash reserve really does is it gives optionality to the issuer and you know, prevents that volatility. And I think that's honestly what we're seeing in the market this week is kind of a liquidity crunch and a crisis of confidence around these products, due in part to the perceived you know, weakness of the cash reserve behind Stretch today. Having used that to buy back the convertibles, which should be a you know, in the abstract, without feeling the day-to-day volatility of the market, that should be a very positive thing for Stretch holders. You're retiring a senior liability ahead of the Stretch holders at a discount. That should be a credit positive event, as you mentioned, Dan. But that's a trade-off for less liquidity in the meantime, and that kind of a liquidity crunch is what has spooked the market so much today.
I just want to add on top of that. I think what we've seen is there was some loss of confidence in the underlying instrument, and that resulted in what we saw, a leverage liquidation. And you know, we've been running around New York here the last week, getting an understanding of what's happening in the market, and there was a significant amount of leverage on top of the instrument. Why was there leverage on top of the instrument? Because the creation of these credit instruments established a high yield, high liquidity, stable security, and that bred a landscape for interest in leverage. So as there was weakness in the security and the leverage effectively got liquidated, and there was pressure, additional sell pressure from the leverage that was in the market.
Okay, those are great answers. So Alexander, now to you. I know you've had the benefit now of watching both Strategy and Strive IPO their own digital credit preferred equity instruments. And you've been a large issuer of private credit, right? Private credit in your market. What are your thoughts now seeing?
Has been the non-listed Bitcoin-backed credit products, and our conviction is that the current market is separating the market operators with conviction, with discipline, from market operators that can have doubt or do not understand the structural aspect of the market. The context today is that the screens are red, that the market has been hammered, minus 50%. From a traditional perspective, this is big. From a Bitcoin perspective, this is just volatility one. Bitcoin historically has been going through those minus 70, 80, 60% drawdowns, and Strategy, Strive, Capital B, we are all being built, and Nakamoto, we are all being built for those structures of markets. And when I think it's a good moment to remember why we are here. We are here because Bitcoin has 21 million units. There is an infinite monetary supply, and it's not stopping anytime soon. In fact, when you look in the past, any periods of oil supply shocks or internet bubbles or great financial crisis have all been followed by 250 to 500% monetary increases in the next 10 to 15 years. And the result of this is that Bitcoin is growing at 30 to 60% CAGR over periods of 5 to 10 years. And the ability to be financed at 11, 13% is a major arbitrage. And before, when we were in the 2022 bear market, there was no digital credit industry. There was not perpetual digital credit instrument. The ability to align the maturity of the financing instrument with the objective of holding of the asset, the perpetual objective. This is something we have now. Back in 2022 strategy, we're in a point where there was more debt than assets, but now it's 50% overall leverage, even a bit less. And I think we are in a much more robust situation than where we were 2022, and that we will be in a much better position 4 years from now. But it's just the ability to zoom out and to see what the companies are building. And for Capital B, today we've been sometimes called very conservative. We have no fiat debt on the balance sheet with our Bitcoin strategy. And digital credit for us is the biggest opportunity we see. All I see is opportunity in the market, and the Bitcoin convicted investors also see of big opportunities. The first time for a long time that I've seen even traditional finance people interested in Bitcoin come to me and say, oh, I bought Stretch for the first time. Oh, I bought SATA for the first time. Because it's just mispricing of the Bitcoin future.
Okay. Yeah, that's a great perspective. Thank you, Alexander. So my next question for, I think, Jeff, and then opening it up is, obviously last month Strategy inoculated the market, those are Saylor's words, with a 32 Bitcoin sale. This represented about $2 million of value. Obviously, this was not enough to move the market in any material way, but there was clearly some animal spirits in the price of Bitcoin as they were selling these coins. So what are your thoughts, specifically Tyler and Jeff, around selling Bitcoin to pay dividends at a discount to NAV when it comes to your common equity versus selling common equity at a discount or at a premium? Obviously, there's all sorts of permutations here, but generally, what's your broad sort of principle at Strive, and then for how you value these companies when it comes to selling the assets on the balance sheet to either pay dividends or potentially buy back securities trading at a discount, and versus selling common equity?
Sure. Well, I think that's what the market is waiting to see this week is how the issuers are going to respond to this liquidity crunch and what measures they can take to intervene in the market, or if they'll just let the market freely price these things. Our team has kind of debated this endlessly in terms of what are the best paths forward for the large issuers, especially. And I think inoculating the market further by selling a couple years worth of dividends and having a really strong cash liquidity position, that's a one-time event where you can say we're in a strong financial position and we don't expect to sell any Bitcoin in the near term. I think that would be an effective thing to help restore confidence. But on the other hand, and I think this is an unpopular opinion, as I've shared it a little bit, but if you look at the reason why Strategy and now Strive chose to finance themselves with preferred equity rather than a typical credit fixed income product, is it gives them the ability as an issuer to have that flexibility in terms of no repayment cliff, and the ability to pause the dividends without triggering a default. And the reason they built those into those products is exactly for this type of scenario, to prevent an issuer from having to become a forced seller of Bitcoin at a point of weakness in the market. And so in my mind, that would actually be kind of the strongest message. I think it would be a very painful one in the short term for the market to digest. But if Saylor came to us on Monday morning and said, we're going to pause the Stretch dividend, but everything's going to be fine and the price of it will float freely, and 3 months later or 2 months later, he turns back on the dividend, he's inoculated the market once again that the design of the product worked as intended and prevented him from becoming a forced seller of Bitcoin at the lows of the year. So I'm really interested to see what path issuers choose here.
think it would be a bad idea to pause the dividend. I think operating in the credit markets is incredibly important. Trust is what you're selling, and trust that you're going to continue to pay the dividend is the primary thing that I think the market is hanging on here. I mean, there's a significant amount of liquidity behind the balance sheet. It's cash, it's Bitcoin. I think the reality here is that Bitcoin is incredibly liquid. It trades 20 million to sometimes 20 billion to sometimes $60 billion of liquidity a day. And there's significant optionality when looking at the balance sheet as a whole. To answer your question specifically, this is a multivariate calculus that is constantly being monitored behind the scenes by both Issuer Strategy and Strive. And we're looking at not just the Bitcoin and the common, but the Bitcoin and the common and the credit instrument and the relativity of all three of them and a combined transaction of looking at a quarter by quarter basis or a long-term basis. Again, with the goal here being that we are long-term net accumulators of the underlying Bitcoin. We want to express a very long and amplified position on the underlying Bitcoin. And I think that's what investors both on the common stock expect, and it's what investors on the credit instrument also expect. Obviously, we have the ability to sell the Bitcoin if we needed to pay the dividend obligation. For us at Strive, our daily dividend obligation is around $400,000. Our common stock trades over the last 30 days, it's averaged about $60 million a day, and for a company like Strategy, their daily obligation is around $7 million. Just yesterday, the common stock traded $4 billion. So that relativity is very small, and I think that capital making decision is a complex one, and it needs to be thought about on a long-term basis, quarterly, and an annual basis.
The other thing I'd really like to see the issuers maybe reconsider here, and I made this point on a podcast this week, but with the design of these products, with the peg that issuers are trying to enforce at $100, with the constant ATM sell pressure, you're creating this convexity that only exists to the downside with this implicit backstop at $100. And so, in between dividend periods, which Strive has thankfully solved, there's almost like a risk-free short trade that you could put on in the market where the price isn't going to run away from you. And so if the issuers chose to broaden those trading bands or those trading ranges or be less aggressive on the issuance schedule via the ATM, and you let these products trade up in times of high demand, and I think we would have, without an ATM program active, we would have seen Stretch and SATA both trading significantly above the $100 par value over the last couple months. If you have that natural market force where you enforce a wider band or you let there be some volatility both to the upside and the downside rather than only to the downside, I think that would change the perception of these products and remove some of the attack surface, if you will, for people who want to bet against them.
Well said. I think that's an important consideration. We have just 5 minutes left, so I want to get into kind of what I believe to be the next chapter in digital credit, and I'll like to first hear from Alexander, and then we'll do kind of a speed round across the panel. But Jeff, you used to work in reinsurance, and we talk a lot on True North about structuring these digital credit products, right? How do you structure these into packages, into funds that are attractive to institutional allocators, to fixed income allocators, even just as simple as preferred equity is not credit. And so we're unable to make Stretch and SATA fit into the credit bucket for an allocator, right? That's a very baseline problem the industry has right now. So what are your thoughts moving forward about structure, and how can we bring that to these types of products? First, you, Alexander, maybe give us a quick, brief insight into the private version which you've created.
Yeah, I think at the end of the day, a Bitcoin treasury company is in the business of consistency. And I think the turbulence we are seeing in the market is just because of the discovery of what the market values the most and what the market expects from the companies. One key thing is definitely the consistency. Another thing is it seems like a 2-year cash reserve is very appreciated by the market. And this is just because typical bear markets last about 1.5 years to 2 years. That's quite simple. The risk is very simple. It's Bitcoin going to zero, or Bitcoin going minus 80% for 10 years. And this is the risk. And if you are not able to see and price and appreciate that risk, then this will be definitely too risky. But this is the risk. You can allocate the percentage, but then it comes to the structuration. And the structuration from a private market lens, what we've done is Bitcoin-denominated convertible notes over 5 years, 0% coupon, no liquidation risk. And so if Bitcoin goes to zero, we give back Bitcoin at zero. And if Bitcoin goes up, there is a conversion, and it's a major call option. On the digital credit side, I think the key aspects is that the market is realizing that, yes, it's about the ability to raise rates, but it's also about the ability to have a structure overall. And I think Strive has been extremely good at that, with the preferred being at the top of the balance sheet structure and effectively be the highest senior claim on the company. And these characteristics in terms of the structure, I think, will be more and more key for the appreciation of the credit risk.
Absolutely. Tyler?
Yeah, in terms of structure, this is something our team at UTXO Management has been working a lot on over the past couple months. And we see, these digital credit instruments as being really a versatile building blocks in a portfolio to be able to build new securities around. And one of those things that you mentioned, Dan, is being able to transform these from perpetual preferred equities into a true credit allocators box, which means having a duration on them, which means having a covered loss ratio. And one of the things we announced at Bitcoin Vegas a couple months ago is a new fund that we are soon launching that takes like a CLO or CDO structure for these digital credit instruments, where we can borrow some of Wall Street's playbook in terms of tranching out the risk return into different levels, where there's senior, junior, mezzanine, where we can build different risk return profiles and be able to remove some of the volatility from these products in a way that maybe an issuer doesn't have the tools to today, to make them more suitable for new types of investors. And so I think we'll see a lot of experimentation on that front going forward, and a lot of lessons learned from the volatility the space is going through this week. And I'm optimistic for the solutions we can come out of this with.
Get it done. So there's a ton of opportunity here. Strive, we're a structured finance company. You take Bitcoin at perpetual. We've created a perpetual preferred equity and our common equity. Both are perpetuals. You could take that perpetual preferred equity and you could tranche it again into a term instrument, a senior term instrument, and put that into a special purpose vehicle that has, as Tyler mentioned, different risk return metrics. Now, this solves a couple problems. The main things it solves is creating a senior term instrument that could potentially get rated because it's less Bitcoin risk and it's now become balance sheet risk. A rating agency can get more comfortable with that. And that gives you access to insurance companies, pension funds, and anybody that needs a rating on an instrument. But that also solves a leverage element, because right now there's a leverage duration mismatch on digital credit, and we've seen it this week. When you have short-term leverage on a margin on a digital credit instrument, if there's volatility, you have to liquidate. Now, if we can create a structural leverage equity style component, that actually solves the structural leverage duration match of the instruments too.
Awesome. Well, our time's up, guys. This has been an awesome conversation. Thank you, everyone, for listening, and talk soon.
Our financial markets and our financial system, which is built on American rails, so to speak, and which has preserved America's role as being the reserve currency, the currency of settlement, we want to protect that from China or other countries trying to dominate that. And China indeed is trying to do so. And we don't want to We don't want to be under a system where the Chinese Communist Party determines who can access it. They can avoid sanctions. They can avoid supervision. So we're at this moment now where it passed by nearly 300 votes a year ago. It passed in May out of committee with bipartisan support, and we're on the cusp of this. And of course, the ethics piece is part of this. It's just a small piece of a 600-plus page bill. Look, my view is ethics provisions were put in there. Ethics are incredibly important, of course, with all government officials. But this is too important for the leadership of our country, for where we stand going forward. If we're going to dominate and lead in this technology and preserving our financial networks, our economic strength, is we got to get this bill done. And this upcoming week may be the last opportunity to do so before we lose this moment for another year or two.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Okay, all right, cool. Well, let's start with just some brief introductions. Amanda, tell us a little bit about yourself.
Hi, everyone. My name is Amanda Fabiano. I'm the COO of Nakamoto.
Hey, everyone. Oh, wow. You got some cheers already.
Yeah.
Thank you.
Hey,
I like that.
Hey, everyone. I'm Jeremy Allman. I'm the CEO of Paystand. We are the largest business payment network built on the Bitcoin blockchain. 1 million customers, 20 billion in volume, 2% of all the US economy built on the Bitcoin blockchain.
Woo!
Hi, everybody. I'm Johnny. I am the co-founder of OnNexus. We build on-chain solutions to allow treasury companies, institutions, Bitcoin holders to earn a yield on their Bitcoin self-custodially on-chain.
All right. Thank you. Johnny also has the coolest name in the world, Johnny Himalaya. It's amazing.
Cheers.
We're going to get to know him a little bit more. All right, we were talking about Bitcoin treasuries over the next decade. So I want to start just by having our panelists paint a picture or cast a vision of what the next 10 years look like. So let's fast forward. We're at 2036. What does our industry look like? What are some things that people maybe aren't anticipating that you're seeing as an operator behind the scenes?
That's a really interesting question because I feel like every 4 years in Bitcoin seems like 35 years. So hard to think about a 10-year time frame. We've just seen the market continue to evolve over the years, and I think we'll still continue to see that. I think we're going to see more of a convergence of traditional finance and Bitcoin worlds. I think from a treasury perspective, you'll see more companies going towards an operational model or focusing on the capital market optimization. Yeah, I think when people think about Bitcoin in the future, they always think about a price target, but I always think about what are the businesses that are going to exist in the future. And I would hope that a lot of the companies that are being built in this era will continue on into the next decade.
Yeah, I think it's true. You're going to have more and more increasing Bitcoin business adoption. It's crazy to me that this Treasury conversation has actually like crossed the chasm. A few years ago, the idea that corporations were using as Treasury would be a crazy notion. Now I'd say we already have momentum there. So I want to talk about what's past that, which is Bitcoin being used in the real world for businesses to fuel their operations. Because Bitcoin, and one way to look at Treasury is it's digital capital, but capital in general is just fuel for your business. If you simply have great capital in your business and your business doesn't do anything, it's not a very good business. So what I really want to plant in your guys' minds is actually Bitcoin as digital capital becomes the fuel for a more efficient business. Businesses that actually can run cheaper because they have lower cost of capital, businesses that can move their money faster and quicker, so that makes them more competitive, and businesses that don't need to use the traditional financial system, which means that they're going to lower their cost, that they can put that back into more jobs, more business creation, and more GDP growth, which is good for our economy, and it's ultimately good for the world, and that all starts with businesses using Bitcoin.
Johnny?
Yeah, I'd like to piggyback a little bit off of what Jeremy said as well. I think if we go 10 years down the road, I think the dreamer's point of view would be that if hyper-Bitcoinization truly happens, I think the concept of a treasury company will probably be over, because every company will just have Bitcoin, as you were saying, operationally. So this whole strategy of, being a treasury company to put Bitcoin on your balance sheet purely for treasury will be a moot point, because people will have Bitcoin, companies will have Bitcoin because they use it in their day-to-day operations. They're getting yield from it, etc.
Yeah, I think that's a great point. I think about this with Bitcoin meetups too. Like Bitcoin meetups are a thing right now because we're trying to propel adoption forward. But in 10 years, there's no dollar meetups, right? So I think it's kind of along similar lines. We're just going to see that Bitcoin is just embedded in everything. So it becomes a little bit redundant. So what sort of headwinds do we anticipate over the next 10 years? So Bitcoin's experience and pushback from whether it's regulators, or even like what we're seeing with topics or MSCI. There's probably some cultural headwinds, some narrative work, some marketing work that we need to do. But what do you see as potentially problematic that maybe people in this room aren't anticipating over the next 10 years?
I think that regulatory will always be an up and down. I think that there will be different things that are built that we might see traditional industries push back on because it might affect their portion of how they make money. So I think that will consistently be something that will be coming around the corner at every market cycle. I think growth and adoption and just the storyline of Bitcoin, just explaining that, we probably, to your point, could do a better job. Bitcoin is a lot of different things to different people, and so you can explain Bitcoin differently to whatever crowd you're talking to. I think that's one of the most incredible things about it. It can be whatever you want. It could be your savings account. It could be your spendings account. It could be something that businesses uses. It could be something that businesses hoard. So I think how we explain Bitcoin, and there is no Bitcoin marketing department. So how we explain it, I think, is really interesting, because depending on who the clientele is, how they adopt it can be very different. So I used to work at Fidelity, and how you explain Bitcoin to Fidelity was very different than how I explained Bitcoin to my mom. And so I think, us all doing our part there would be super helpful. But yeah, I think regulation is something that we're always going to have to think about around the corner, and that just goes with the wind of where things are going.
Yeah. Jeremy, what kind of headwinds do you anticipate?
Yeah, I think one that's less obvious right now is the stablecoin adoption around the world is growing faster than any financial infrastructure in the world. Stablecoins in general have more volume in certain places in the world than Visa and MasterCard combined. And so when you talk to the clientele that we do, which is generally large corporations, we service the largest Fortune 500, we service the largest banks, we service the largest portions of the economy. And what you find is, unfortunately, their conversation is not starting off with, how do I Bitcoin? Their conversation is starting off with, how do I stablecoin? Now, here's the problem with that. The vast majority of stablecoin volume is not sitting on the Bitcoin blockchain. And so what it's really doing is making more more TradFi, traditional financial infrastructure, more efficient, but is doing nothing beyond that. And so the question for us is, how do you actually marry the two, where stablecoin maybe is the bridge to Bitcoin, but on its current path, stablecoin volume is actually sitting outside of Bitcoin, and we don't think that's a good thing, because Bitcoin is freedom money, it's digital access for people around the world, it's infrastructure that lowers the cost for global remittance around the world, and Bitcoin is the single most important invention in our lifetime. And so it's incumbent for us to be able to create really good use cases. And so what we want to do is say, take all of that energy and infrastructure that's going on stablecoins, but is really just perpetuating the traditional dollar, and put that on Bitcoin that has no owner, no individual that can hold you back, and that can be used anywhere in the world, instantaneously, automatically, and globally. And so we want to marry those two things, because if we don't, we're going to be in a world where stablecoin eats Bitcoin, and it's not the reason most of us got involved in Bitcoin in the first place.
Very interesting. Yeah.
I would say in terms of headwinds, that we have a small bit of like non-identity crisis, but different Bitcoin communities view what hyper-Bitcoinization looks like in different ways. So, if you go way back to the old school, it was all about like, no counterparties. You don't need to trust the bank to be able to send value from one person to another. And, that philosophy still exists in certain communities. But then, in the new age of hyper-Bitcoinization, you obviously have institutional involvement. So, where the banks are actually getting involved in the Bitcoin economy. So you can look at it like two different ways. Do we look at the banks getting involved as friction, or do we welcome it? And Bitcoin is a disruptive technology, and like any disruptive technology, there's always incumbents who end up, being faded out. Like the internet music streaming got rid of the record industry in a large way. And does hyper-Bitcoinization get rid of an industry, or does the industry take it on board and try to gel with it? So I would say it really depends on what your view of hyper-Bitcoinization is. Is it a completely sovereign, self-custodial financial system that doesn't need any banks or institutions? Or is it a new hard asset that the whole financial system can benefit from? And I think once you answer that question, you can kind of decide on what the headwinds are.
Well, Amanda, I feel like
I think that one thing that's kind of interesting, we were just on a panel with Kraken, and we were asking Kraken about how, they're working with traditional banks, and Gurpreet, who is the head of institutional there, said something that really stuck with me. He said, it's easier for us to learn traditional finance than it is for traditional finance to learn Bitcoin. And so right now, I think you have this really interesting time where we can see some of these companies that have built over, the last decade really come out on the other side and maybe take a little bit more ownership of the where finance is going compared to the traditional banks. I don't know. I guess it's a race that we'll watch over the next decade.
Definitely. And Kraken is coming up next also. So just a quick commercial. And also, I just want to reset the room a little bit. See a lot of people standing in the back. Sorry, putting my MC hat on real quick. If there's an empty seat next to you, will you do me a favor and scoot in so some of these people can get seated? It is a little bit chaotic in here. We love to see it. Welcome. We're glad you're here. And we're going to keep going here with this conversation. Okay, so over the next 10 years, what is it going to take for some of these legacy companies who are sitting on millions or billions of dollars in cash to wake up to what's happening? I mean, it feels like we're almost at a point where it's like a fiduciary obligation almost to be paying attention to what's happening in the Bitcoin space, and ignoring it is going to potentially have some consequences. But what do you think is going to happen in order for some of these large companies to capitulate?
I mean, we do see some large companies with Bitcoin on balance sheet that have them for a while. So Fidelity has been mining Bitcoin since 2013. They hold a large Bitcoin stack long before Bitcoin Treasuries was a thing. You have Tesla that has a lot of Bitcoin on balance sheet. I think you're right. It is, at some point an obligation to say, hey, what is this thing and does it make sense for us? But every company has their own risk framework and what makes sense for them. This goes back to the educational piece and just where and how we think about how Bitcoin exists in the world. I think there's more Bitcoin on balance sheet than I would have expected at this point, which is kind of surprising and nice. But I do think that over time, as people learn more about it, that's great. But we love Bitcoin, obviously, but when you think about it as an asset, it is extremely volatile. So as a CFO or a public company, you do have to think about the risk of holding that. The volatility of Bitcoin is difficult to explain versus holding cash. So I think as we see these volatile waves kind of get compressed, maybe there will be more and more adoption in the future.
Yeah, I think one of the hard parts, though, in my journey is oftentimes you start off with Bitcoin, and the farther you get, you want to like orange pill people, and you want to tell them all about the economic model and the financial model, and people kind of just like their eyes glaze back. And what I found over time is the best way is actually just to have people use it and touch it in different experiences. And so one of the things, Saylor's done such an incredible job at educating the market around Treasury. We went a different route. We actually, we've been in business. We're probably the first Bitcoin or second Bitcoin payment processor in the world. But over time, what we learned is we talk less and less about Bitcoin. We service most of the largest Fortune 500 companies. The way we talk about it is actually just like, hey, don't you think your money and your capital should move at the speed of light at zero cost and completely automatically and agentically? And then let's figure out ways for your business to actually engage so you can get Bitcoin Treasury, but you don't need to go get the board approval, because Bitcoin Treasury on one dimension might need the board approval, especially if you're a public company. So for example, what we have is a corporate card. The corporate card, you just spend in dollars in fiat like you do in your normal corporate expense when you bought your airplane ticket here or whatever, but then the rewards points go back into the corporate balance sheet instead of just some Amex points that I have no fucking clue what it does. So that all of a sudden gets it on the balance sheet, but in a completely Trojan horse way. The CFO has now got it, has to determine what do I do with it. Turns out most of the time, because they effectively got it for free, they keep it on the balance sheet, and then that becomes the entry point for them to be able to start increasing their treasury position. So the point is, Bitcoin's actually being adopted more and more in both the real world and in the business landscape, but maybe not straight head on.
All right.
Yeah, in terms of like what we need to achieve like greater adoption, etc. I think as the products become more mature, whether that's a software product or a financial product, like we have a lot of innovation obviously now with like with Stretch and the different things that Strategy are doing. And as this marketplace matures and as the volatility, as Amanda mentioned, that right now Bitcoin is still seen as a very volatile asset, but over time the consensus is that it will become less and less volatile. So then it's seen as less risky in order to put Bitcoin on your balance sheet. And once that volatility is dampened a little bit, you'll start to see more and more innovative products. And this is how you can use your Bitcoin now. If there's that demand that, all right, it's not as volatile anymore, I'm willing to hold it. Now what can I do with it? Can I make payments? Can I earn a yield? Can I market make? Can I borrow? Can I lend? And once all of these products come on board, I think there will be like a snowball effect that everyone's like, oh, you can do all of this with Bitcoin?
Yep.
Let's go for it.
Definitely. I love that. Okay, well, we can't talk about the next 10 years without talking about AI. I know it's very buzzwordy. We had a panel earlier about AI, but I do want to talk about, what you're seeing that's already emerging. I mean, we already live in a different world today than even 6 months ago, right? I don't know about you, but I'm at a point where if like Claude is down, I'm like a little bit panicked. I'm like, well, what do I do now? I forget how to work in the old sense. But so far, it doesn't seem like AI is, coming for jobs or some of the scary narratives that have been out there. But how, as operators, as visionaries, how do you see AI continuing to be integrated into the Bitcoin corporate space, if at all?
Yeah, I think whenever there is something new like AI that comes out, the real scary thing that the narrative happens is every job is going away. The same thing happened with Bitcoin mining, right? When Bitcoin mining became more and more institutionalized, jobs are going away, mining is eating all the grid. But what ends up happening is that there's different industries that get created and how people work end up being different. So I think that's what we'll see for us, like maybe there would be agentic AI with Bitcoin being like the currency. That could potentially be something that I think we'll see. I think we'll see more people using AI for being more efficient at their job, not necessarily taking over the job. When you still have to edit anything that exists today, and maybe that will adjust over time, but we still need people's brains to make sense of things. AI, I think, just makes you a little bit more efficient at this point.
Definitely.
Man, I feel like I'm being like the spicy one right now with the opposite takes. So our headquarters is in Silicon Valley, and I would say most Silicon Valley CEOs I know, they radically think it's going to transform jobs. I think the two most important changes in our lifetime, at least in the last 100 years, if not longer, is the transformation of Bitcoin, transformation of money, that's Bitcoin, and the transformation of labor, that's AI. Those two things are changing how society operates. In Silicon Valley, every CEO I know is saying that like 50% of staff is going to change how they do their own business. In our own company, we're not huge, we're 400 employees-ish. I'm thinking about the next stage of our growth. I would normally think about going from, let's say, 400 employees to 4,000 employees. I think we'll go from 400 employees to 500 employees and 5,000 agentic digital employees. Now, that's already happening in our organization. Probably within the next quarter, we will be 1 digital employee per actual human. That's exponentially growing every single quarter, and we're not the only company that's doing that. That's how fast we're growing and how much leverage we're happening. It's happening in the financial stack with products and services, and it's happening in every part of our operation. Now, here's the key point. How do those digital employees and those agents actually do commerce? Commerce is the fundamental piece of human society. They need a way to be able to do it through digital money. We believe it's extremely important that they do it through digital money that's done through Bitcoin and freedom and open access money. Bitcoin will be the thing that the agents will prefer. And the reality is labor is transforming, and digital money is the perfect transformation around digital labor.
Well said.
Yeah, perfect. Yeah, us being a software company, we've been like on AI since the get-go. So we actually have all of our coders are using Claude Code to help them with their code, and we've got different agents running different workflows in our company, and you know, so we're very much in tune, and we have a blueprint for what the future of Bitcoin looks like with AI agents, and I think everybody would agree. You know, an AI agent can't own a bank account, an AI agent can't KYC to an exchange. So like, how are AI agents going to transact? You know, so I think it almost becomes common sense that they're going to use some form of cryptocurrency. And then obviously the most trusted and battle-tested cryptocurrency is Bitcoin. So I see a future where absolutely all AI agents are communicating with each other, transacting with each other on the Bitcoin blockchain. And what's interesting to note is that while some people think Bitcoin is a slow network compared to other networks, you know, block times are 10 minutes. In terms of communication, the Bitcoin blockchain is one of the fastest communication layers in the world. If you think about how Bitcoin miners propagate transactions amongst each other, this happens at the speed of light. And if you're into networks, any message can be passed from one miner to another in less than 2 hops. So you can represent agents as nodes on the Bitcoin network and have them communicate and transact with each other using Bitcoin, not only for payments, but also for high-speed communication. And that's what I see as the future of Bitcoin and AI.
Amazing. Well, as we wrap up, I want to invite you all to give some final thoughts, 30 seconds, next decade, whatever you want to talk about, go.
Oh, man. I think obviously Nakamoto owns Bitcoin Inc., owns this event, and we put it on, and we also own UTXO, which is a financial services and asset management group. What I think is really interesting with AI too, which kind of dovetails into this, is like the human connection starts to become even more important. So like meeting someone versus understanding if they're an AI, I think that the event world is really cool. So for me, like that's one thing that I've been thinking about when it comes to that. I think that like in-person events will become more interesting as the world goes to AI agents, and you don't know if you're talking to agent or someone over email. So that's something that like I'm looking forward into what we're building. Yeah, I think that Bitcoin is going to continue to gain adoption. I think we'll see different trends pop up like that we can't even really imagine. I think that it's going to be really cool when like in 10 years we look back and we say, wow, none of the things that we said on stage actually happened. We're totally different, right? And I think that that continues to happen. Obviously, everyone here has been in Bitcoin for a while, and I don't think that any of us had a crystal ball. So I can't say I have a crystal ball on what comes next, but I'm really excited to watch it play out.
Amazing. Jeremy.
All right, so like I'm excited because we've spent so much time in my world just trying to make Bitcoin usable to businesses around the world, and this is an example of how much the world has changed. And so, you know, I guess I'd show if you're interested in business products from everything from cross-border payments, payroll, et cetera, paystand.com is a great place. What we're excited about to announce, we've been announcing this with a bunch of launch partners this week, is something called USDB, which is the first stable coin that's built on Bitcoin natively, built for businesses, built for bots, and enabled for the agentic infrastructure because we believe that connecting the two worlds, traditional companies, traditional commerce, to global commerce on Bitcoin is the most important thing we can do to transform our economy.
Johnny Himalaya, bring us home.
Yeah, I'm just super excited for the innovation that we're going to see over the next 10 years as companies have Bitcoin on their balance sheet. The last year was all about like treasury companies just accumulate Bitcoin, but I think it's obvious with the way these treasury companies have been priced that you got to do something with that Bitcoin. You got to put that Bitcoin to work. So I'm super excited to see the mix of financial products that are made plus software products that are invented and the actual combination of the two, where you can have Bitcoin wrapped in a financial product, but also using some software product that puts it to use, earns it yield, makes it productive. I'm just really looking forward to seeing how the next few years of those combinations work out.
Awesome. Well, thank you guys so much. I really enjoyed this conversation. That's all the time we have for this panel. Please help me thank our panelists.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Thank you, George. Appreciate that. I'm Stephen Pollack. I'm excited for this panel today. Thank you all for being the first ones up and at 'em this morning here. We're really excited for the conference this week. Excited to introduce the panel here. We're going to get it kicked off. We have a lot to talk about. I have to my left, John Regan, CEO of Moon Inc. I have King Wei, CEO and founder of Treasury. And I have Gary Kruglikov, head of Bitcoin strategy at Affinio AG. Thank you, gentlemen, for joining us this morning. We have a lot to talk about, and it's really interesting. We have a cross-section of Bitcoin companies from all the corners of the globe here, from Netherlands and Germany to Hong Kong, and so I think we can really dive in and get a cross-section of sort of the regulatory environment and where we are today, where we've come, and where we're headed in the future. So, guys, let's start off here. I think we have like 5 or 6 questions. We have Bitcoin companies here, like we said, from all over the globe. In 60 seconds, can you just give us a quick update of what's been going on in your business, sort of any kind of innovation, anything new that's been going on, what you've been working on, and then an update on the regulatory environment that you operate in? Let's start here with John, and we'll just work down the line.
Sure. So John Regan, CEO of Moon Inc., listed on the Hong Kong Stock Exchange. And so you can kind of think of Moon as the Bitcoin treasury company for Greater China. Really, Hong Kong exchange listed company, we see as the best way for mainland China eventually to get access to a Bitcoin proxy. So we're building a Bitcoin balance sheet and then building a Bitcoin business tied to our existing legacy business of telecom, so SIM cards, data, and we're adding Bitcoin card products into the mix there. So adding Bitcoin on our balance sheet as a treasury asset, and then also as inventory for our products. And giving China, first Hong Kong, and then China exposure to Bitcoin via that HKEX company.
Hey, thanks, Stephen. Good to be here. So King Wei from Treasury in the Netherlands, Amsterdam. We're preparing a listing on Euronext Amsterdam, which would make it the first on a main exchange in Europe. We raised capital last year, about $150 million, backed by the Winklevoss twins, Nakamoto, and a couple of other institutional investors. And we're preparing our listing in Amsterdam. If you think about the regulatory environment, it is all fairly new for the Netherlands, anything Bitcoin crypto related. So there's a lot of education that needs to be going on as well.
Yeah, Gary Krakow, my name. I've done the first Bitcoin treasury in Germany, a market that you would think should have one way back, because we, for instance, host the longest standing Bitcoin meetup, I think outside the US. But funny enough, no one was crazy enough to go down that path. And in terms of regulatory concerns or updates, I think Mika is doing a good job. One thing I think for Germany, but also probably Netherlands and other jurisdictions, would be harmonizing that, maybe finding better ways where it's clear what are the pros and cons being in Europe versus outside, and in general more capital market understanding, I think, of the treasury model is yeah, something I'm personally very passionate about.
Excellent. And Gary, we're going to stay there with you. You just touched on this a little bit, but the next question we want to hit. So how have you seen banking relationships sort of evolve with your corporate Bitcoin accumulation strategy, you know, across Europe specifically, and then Europe and then Asia? We'll come on down the line back to John. And then how does sort of openness from banking partners connect to broader adoption?
Yeah, the good thing is Affinio had and has certain banking licenses, for instance, a payment institute license. So, for example, talking to the regulator was never really of a concern. And I thought always this is a big advantage over, you know, just going with some shell company, etc. On the other side, even then, you know, talking with investors, talking to shareholders, they still cannot really grasp the idea of Bitcoin sometimes. So you really have to start with first principles, which is crazy with especially financial professionals or people that should be knowing this better. So this is the one thing that was extremely surprising. On the other hand, being in Europe, I think, and Germany, it's one of the largest markets, capital markets in the world. I think the fourth, fifth, and there's way more potential there if you start then, you know, offering capital market products that could be high yielding, for example, so something like Stretch. In Europe, we do have something similar by a strategy called Stream, but it was only available for institutional investors. That's something that I think would make a lot of sense to now propagate and start thinking how can you place certain private credit or then public fixed income yielding products backed by Bitcoin. So this is something I think that we'll see happening very soon.
Yeah, King, what are you seeing? I know you guys are both in Europe, right? We have Germany and Netherlands. Compare, contrast.
No, I think the interesting thing about a treasury company is you need to deal with all the institutions around you, the regulator, the exchange, banks, right? You need to bring it all, Bitcoin basically institutionalize it. And I think what we're seeing is that certainly Mika, as Gary mentioned, has been a very positive development. At least there's a regulatory framework and all these institutions know that it is there, it's coming, and you need to deal with it. We're certainly seeing in the Netherlands a lot more pro-digital assets behavior by especially the banks. So that's certainly developing, driven by also this regulatory environment. And to be clear, as a treasury company, you don't actually have customers, so you don't fall under Mika, but still the fact that it's there is very positive. Certainly from our side, what we're doing also is for instance, working on a lobby group to make sure that all these people sit around the table, compare notes, compare risks, compare issues, concerns. It's very important because, again, we keep saying it, a lot of it's about education.
Exact same in Hong Kong, right? No differences.
Yeah, you know, Asia's totally different, and it's kind of interesting to be sitting at Moon because we've also seeded some of the first and largest treasury companies around Asia, and Korea with BitPlanet, and Thailand with DB8, and so we've kind of seen, you know, from the front row, the different dynamics of working in other markets outside of Hong Kong also. I'd say the main thing about operating in Hong Kong is that the Hong Kong exchange, not necessarily the SFC or other regulators, it's mostly dealing with exchange listing rules. when it comes to doing something that's a little bit innovative, like building a treasury strategy. And we're seeing similar things in Korea and in Thailand. We sell products into those companies, into those countries, and the main thing that you deal with there is just capital controls, which isn't as much of an issue in Europe with how everything is so much more meshed together and built together. And so, we feel like each of these companies has kind of developed a moat based on being a first mover there. We feel like that's kind of the position we're in at Hong Kong, and then we can all sort of work together to play to the strengths of each country when it comes to the products that we offer, when it comes to the services that we can help each other with. That's kind of the plan for Asia, is to have a network of these companies leading treasury business in each market and play to each other's strengths.
Fantastic. Appreciate this, gentlemen. So I guess the next question then would be regarding Bitcoin exposure through public equities. In your region, are regulations and legislators, I guess, making it easier or more difficult for traditional investors to sort of gain exposure here? What are you seeing, and how is that changing? Is it getting any easier, or is it getting more difficult?
I can kick it off.
Yeah, please, King.
I mean, the interesting thing is in Europe, most people don't know, but as a European resident, you can actually not buy the IBIT ETF. You cannot buy Bitcoin ETFs. So that's already in itself a huge constraint to get easy Bitcoin exposure in your brokerage account, right? You can clearly open an account in exchange, but it's different. And that's why a Bitcoin treasury company itself is a real sort of product market fit. It's easy access in your brokerage account, easy for taxes, it's regulated to access that. So that in itself is a big positive. Away from that, we don't necessarily see a huge amount of, let's say, encouragement for people to buy digital assets. I think switching a second to the institutional side, we're certainly seeing a slow but steady increase in institutional interest in the space. And that's very similar. It's actually not that easy to get access. So an equity is a solution there as well.
Yeah, Germany is, funny enough, in love with fixed income products, just due to pension funds, insurance funds, and you have one of the biggest in the world placed there. So there's already natural interest there on a capital market side of things. And regulatory-wise, funny enough, it's actually not as bad as one would think. Germany has some fairly broad rules about listing requirements. There's been basically Bitcoin-focused listed company in Germany around for almost 10 years. It's an exchange that happened to have a balance sheet of, I think, €500 million worth of crypto assets, and they're publicly listed. So the regulator already knows this model. It wasn't called a Bitcoin treasury or a DAS, but the model is not new. So that was the easier part. The harder part is then structuring the right financial products, issuing anything but common equity, raising the threshold, how many shares you can raise in a certain given amount of time just because of corporate governance or corporate law. So those are more the trickier things, and the regulator doesn't understand why should they, and probably shouldn't understand even, or maybe should, but they definitely don't really care that much, because if we on the one side say we're similar to any other publicly listed company, but at the same time, can you change the rules for us because we have Bitcoin on our balance sheet? That's unfortunately not gonna work with them. So we kind of have to adhere to the old traditional rules that are fairly good in Germany, at least. It's not hard to get listed, especially if you have an operating company and if you kind of know the process. But yeah, understanding corporate law and then making it easier for non-European investors, that's really actually the tricky part. So for example, it's extremely hard for a US investor to buy European shares in general. But that's has something more to do that the American regulator doesn't want people take their money or take the business somewhere outside the States.
Perfect. John, easier or more difficult?
I think generally it's easy for investors in Asia to access. Hong Kong exchange-listed companies are, I think close to 5% of our investors now are actually on Futu, which is kind of the Robinhood E-Trade super app in Asia. And so we've seen investor growth from a lot of different countries. it's nice to be in kind of Metaplanet's neck of the woods also. So we hear from a lot of Metaplanet investors saying, hey, let's get some exposure to what's kind of the Metaplanet in Greater China. And then really the story for investor access for Hong Kong is the Stock Connect listing, which gives exposure to Hong Kong exchange-listed companies for mainland investors. And so that's kind of the end game for us is reach kind of the thresholds that allow institutions in China and retail in China to access Moon with RMB. So that's the next piece of exposure that hasn't really been tapped into yet. That is I think the biggest demand that still exists that's untapped, and that's the end game in Hong Kong.
Perfect. We have about just less than 10 minutes left. We have a couple questions, and so plenty of time here for these. This is not meant to be a trick question, but I think it would be interesting if you guys could name a piece of legislation or sort of regulatory change in any country that would most help your business in the next 12 months, and please explain, why that would be important as well. And John, let's just go right back to you, and then King, and then Gary.
Sure. For Moon, we're hitting that Stock Connect long-term trajectory. So that'd be the biggest thing that we could, for us, that could happen in 12 months. And then sort of to Gary's point on just kind of listing rules and how you operate with raising funds and issuing equity. Some easing up of that for treasury companies around the world, including in Germany and Hong Kong, I think would be on that list too.
I think for me it's interesting looking at the European landscape. The first country in Europe to actually buy Bitcoin on its balance sheet with a sovereign wealth fund is Luxembourg. And that itself creates a huge amount of positive momentum around the space, right? Because from there on, you see the regulator, you see the different ministries acting sort of in concert. So I think, if anything, is, as always, putting your money where your mouth is will be a big positive for us as well in the Netherlands.
Yeah, and I think to my point earlier, access to the U.S. capital market for non-U.S. domiciled companies, I think that would be the single biggest driver of growth and access to capital that also wants to, be invested in those type of businesses and industries, but due to local U.S. regulatory constraints, that's not gonna be easy. Like also exchange and rules, like you cannot hold a certain ISIN in the U.S. brokerage account. You have to open local brokerage accounts in Europe, and especially if you're American, that's extremely difficult. So yeah, that will be a massive difference.
Gentlemen, you guys are doing great work. You're really pioneers. I hope you realize that, pioneers in the industry and within the countries and regions that you're operating in. And I know it's very difficult at times, and so I just want to say that as you sort of reflect here for our last question, we've got 5 minutes left here. Last question. As you look at your time and what you've been working on and all these sorts of things we've been talking about, and a number of things that we haven't had an opportunity to yet, what's one thing that you know now about running your business that you wish someone had leaned over and whispered in your ear and told you before you began? Like, what's something that you've learned that you wish you would have known, before you began all this? And King, if you don't mind, would you kick us off, and then we'll go Gary, and then we'll come over to John to finish.
Sure, and just going with my own background, I've been in traditional finance for a long time, and I had a few startups and obviously this, and I think some of the things, on the one hand, you're in a traditional finance business, because you need to work as regulators, everything is super important, right? It's got to be pristine. But secondly, you're running a startup, right? You're starting with a lean team. You got to make decisions quickly. You got to move very fast. And I think with all of that, those two can conflict sometimes a little bit, right? Because the regulator has its own timeline, right? There's like 20 business days before you get an answer. In the meantime, you're running 100 miles an hour with your team. So I think that sort of conflict between startup and super sort of institutional, that's something that I hadn't fully grasped beforehand.
Yeah, I guess really the level of knowledge about Bitcoin. It comes to a surprise, how there are some people you would never imagine to be Bitcoiners end up telling you, oh, I've been a Bitcoiner for years, but I never talked about this with anyone, etc. And then at the same time, board member, like on a board level, for example, and then the extreme opposite, a board member that thinks, oh, this is amazing, but then ends up saying, actually, I thought it's a hype, and because the price went down 15, 20, 30, 40%, I think it's gone, it's like dead. So, you know, this spectrum of people, that's still surprising that you still have to encounter and engage with on a shareholder level and on any type of level. But it comes naturally, you know, like you need to have diamond hands when you're in this business as well, and patience. And I think patience will reward a lot of companies that are still going strong.
I would echo both of you, and then maybe one thing that surprised me a little bit was how much education we would be doing with exchange, with regulators in Hong Kong, including with some of your previous colleagues at BPI, at Hong Kong LegCo, talking about kind of how this development and others have been positive in other markets. So kind of the education aspect, we came out of the gates a little bit hot, announcing our first Bitcoin purchases and strategy, and had to slow down a little bit, but also allowed us to develop more of a strategy around our actual business and adding Bitcoin products into that traditional business line, which is something that regulators wanted to see and was something that we were able to do successfully, and also kind of develop a moat around our business as Greater China's Treasury company because of that. So it turned out to be okay, but the education factor is important. These sorts of conferences help a lot. The Bitcoin conference coming to Hong Kong every year is a benefit. So the education piece.
Fantastic. Gentlemen, great being with you this morning. Let's give a hand for these gentlemen who came in from all over the country, and for Bitcoin for Corporations.
Bitcoin for Corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Now, full disclosure for our audience, I'm on the board of directors for Strive, so this is very much a Strive-centric panel.
Pierre's my boss.
And a very happy boss. I mean, when I look at kind of what Strive has accomplished over the past 6 months, it's just phenomenal. So, but I want to rewind and kind of hear from you, Matt, kind of the journey for Strive and becoming a Bitcoin Treasury company.
Yeah, so as you know, Pierre, I'm a longtime Bitcoiner on a personal basis. Basically, I've had my entire net worth in Bitcoin for getting close to 10 years. Getting old very quickly, it feels like. But was loving capital markets, capitalism when I was at CalPERS, and seeing a disconnect of fiduciary duty there that led me to Strive to fight back against some of the overreach of the ESG movement, to restore in American capital markets unapologetic capitalism. I saw it as an existential risk. We have a retirement crisis in this country. And so version 1.0 was attacking it with fighting back against ESG. And I think broadly speaking, our view on that is that that went from a contrarian position to a consensus position. Not to say that it's completely won, but it's largely been won. That house of cards that I think most people in corporate America didn't even agree with has collapsed, and we're embracing capitalism, and now we're moving more towards a conversation as a nation around AI, around the debasement risk, around scarcity versus abundance. But still at Strive, as we've moved to a Bitcoin Treasury company, and we can talk about all the different layers of success we've had there, when it comes to the retirement crisis, digital credit, I think, is the best answer that you actually can have. You think about, as an example, a pension fund. Well, what does a pension fund look for returns? Most pensions look for around 7% returns. They construct a portfolio of safety through income and then capital returns through equity. And typically the income is less than 7%. And then they hope to earn more than 7% on the public equity and the private equity and blend it together to earn 7%. Well, enter digital credit, paying 11 to 13%, whether you're looking at stretch or stated on an effective yield basis. Well, now income potentially can move from a defensive trade to an offensive trade, right? Like that actually earns greater than your hoped return on the public equity or even private equity side, which I think is a completely different game changer for this equation. We can talk through kind of where we are in that evolution, track record building, and how building track records, 3-year track records, opens the door for institutional adoption. But I think, to quote Saylor, this is the iPhone moment. I actually truly believe that. But I also, he's talked about, even on stage, the iPhone 1 didn't really take off. It actually took a little bit of time, and I think you'll see a similar thing where, it's funny, I was on a panel with Peng, and I had a fireside chat, and we both agreed that digital credit was quickly headed to $30 billion. He called that exponential growth, and I called that linear growth. I said, that's because my expectation for where I think this is going is so high. Like, this is a $300 billion, multi-trillion dollar opportunity because of the yield opportunity where we're going, and we're really in like inning 1 of this.
Now, fundamentally, what enables a Bitcoin treasury company like Strategy, like Strive, to pay those dividend rates? How do the economics math out?
Want to start?
Yeah, so I think this has been one of the anomalies that people really have been wrapping their heads around, is going, what is the trade that you're putting on, and how do we model that internally, which I also think is very important. And so when you have a thesis around an asset like Bitcoin, and we look at it as probably the best expression of the debasement trade out there, you can effectively think of what's happening out there as a perpetual carry trade, right? We're going perpetually short the dollar, perpetually long Bitcoin. And the thesis is that debasement isn't going to be able to stop. We're seeing an acceleration of the debt crisis in the United States, which we don't really see a solution for. I've heard Matt say over and over again, the biggest risk that we have to Bitcoin is the US government solving the debt crisis. And we don't believe that to be a high probability. And so when you look at that, you're taking an assumption, and for us, it's a 30-year or a 30% CAGR, year over year, effectively in perpetuity. And we're able to carve off a portion of that overall return. So in our instance right now, we're at 12.5%. And so the excess on top of that accrues down to the common shareholders. And you're really looking at it in that lens. So we look at what would a worst case scenario be for a Bitcoin treasury company. And the worst case scenario would be that you have to sell the Bitcoin to pay the dividends. And so when you're building out the risk models, and I'm sure Jeff will talk about this a lot, we always work with that as the base assumption. Assume that that's what you have to do, that the market doesn't allow you to go in and issue equity, to issue any more preferred equity, and you have to rely on the assets on your balance sheet. Does that trade still play out over the long term? And the answer, when you model it, and we've run it through a million Monte Carlo simulations and a bunch of different ways of looking at this and stress testing it against past drawdowns and what we expect for future drawdowns, because we still believe Bitcoin's going to be a volatile asset. But no matter how we've modeled it, the number of times that that does not work out is incredibly small. And so we're very comfortable with that trade, and we believe that the market is as well. And we're starting to see that when you see the liquidity building around these products. People don't always understand exactly what the products are that are out there. Volatility as a product is kind of a new concept. And I don't think people understood how valuable that is when you think about how it enables the returns that some of these institutional investors and these portfolio managers have to obtain. A lot of times they're not focused on the price of things. They're focused on the movement of things. It was what we saw with Strategy when they started launching the convertible bond models, and they found out that there was this pocket of capital that was completely attracted to that because the underlying equity behind that debt paper moved so much that they could do their trading activities on a hugely accelerated basis from what they used to be able to do. And so when people look at, well, where is the demand coming when a company like Strategy is issuing this equity out to the market? Well, they're selling a volatility product into the market. And there's huge demand for volatility because volatility is what enables those returns for all those institutions, as well as for retail investors as well that have a long-term outlook, or they're traders, right? If you have a long-term outlook that spans a decade, while you can absorb a lot of volatility, if that's within your risk profile, you expect those returns to be far greater over time. So when you're building an amplified version of Bitcoin, that's what you're focusing on. But there was a massive cohort on the other side. And you go, what's the other killer app product that a treasury company, or we view ourselves actually as a structured finance company, what could a structured finance company offer out into the market that brings the value of Bitcoin and takes it to people who don't want to stomach that volatility? And when Matt mentioned the retirement debt crisis, that product is a credit product. Fixed income is becoming more in focus every day as we get to this aging population that's all transitioning into the retirement phase of their life. That 60-40 portfolio that everybody used to talk about, that fixed income component, becomes so critical because that's the difference in your quality of life through retirement. If you're a retiree and what you really want to do is go spend time with your grandkids and you want to be able to take that extra trip to Disney, if you can average up the fixed income portion of your portfolio by 1%, that's a very material difference in your quality of life all throughout your retirement. And because of that, we think we found the combination of products to bring to the market as a structured finance company that meets the needs of both. You've got the people that really want the volatility to enable everything they do, and you've got the credit product that's going to provide that security in a lower volatility instrument that a large portion of the population is searching for right now.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors, this is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Bitcoin's price dropped 50%, and when it looked like it was recovering, it started dropping again. Now, right now, everybody's asking the same question, like, where's the bottom? But that's the wrong question. And that question is going to cost you, because while you may be asking the wrong question, there's a different question that's not based on guessing, chart analysis, but actual data behind it. And that shows us the repeating pattern over the past 15 years, and it's telling us what comes next. Now, understanding this is the difference. So in this video, I want to break down what signs we're looking at to find the market tops and the bottoms. We're going to look at the charts and the on-chain data in 3 signals and the one line that's been proven to be the best entry and what type of returns it's produced. So let's go. All right, it's time to look into that fuzzy crystal ball and see where Bitcoin's price is going, because everybody's asking me, Mark, should I buy now? Is it going to keep crashing? Is it going to go lower? All these things. Well, I don't like to run my business off of my gut or my guesses, and I don't want to run my money or my investments off my gut. Let's look at the data behind that. Okay, now, what everyone's asking is, when will the bottom be? They want to catch the very bottom. They want to catch the floor, if you will. And so, is this the bottom? Has the bottom come in? Will it go lower? Well, as you've probably heard before, hindsight is 2020. What that means is, like, obviously looking backwards, it seems so obvious, but it's never obvious moving forward. And so what does that mean? What that means is that we don't know tops or bottoms until we look backwards on them. We can make all types of guesses, but we don't know until it goes up and until we look backwards. And part of the reason why is, as we're making new all-time highs, it goes like this, or even if we're crashing, it goes like this. And so we never really know, is there going to be another bounce? Now, there's a lot of data we can look at. I'm going to break it down for you right now, but we don't know for certain until we look backwards. So since we don't know the exact top or bottom, we have to look at the data around it, and more specifically what we're looking for is understanding what actually drives tops and bottoms. Okay, so it's super simple. I'm going to break this down for you, just like price is super simple. Supply and demand, imbalances there. Okay, so what drives tops and what drives bottoms? Pretty simple. What drives the top, and what you'll notice is markets, especially like Bitcoin, typically gets like this run up, and then it gets like this parabolic run, and then what we call a blow off top. And the reason why is because it starts attracting more and more buyers, because humans are real simple. We rush to pleasure, we run from pain. So as the price is going up, we hear about everybody getting rich, more people buy, more people buy, more people buy, and it starts sucking in more and more and more and more and more, and eventually the market runs out of buyers. There's no more buyers to buy. And so the price stalls out, and it can't maintain that pace anymore. Then it starts to roll over, and because humans also run from pain, the ones that don't believe in it were the last ones to buy, they start selling, and it pushes the price back down. So markets stop going up when it runs out of buyers, and markets also stop going down when it runs out of sellers. Pretty simple, right? So if we can understand the buyers and sellers, that's a really big key, really big piece. We're going to look at that specifically. So that's what we can use to measure it. Okay. Now I'm going to show you a bunch of data. There's a lot more data than what I'm going to show you, but what I'm also going to show you is there's one line that we've looked at that's pretty consistent over time. Now, don't run your life or your business or your investments off of one chart or one indicator, but this one indicator is super reliable. It boils it down so you can follow along pretty simply. Okay, let's take a look at this. So the first thing is markets stop going up when there's no more buyers, markets stop going down when there's no more sellers. So when will the sellers be exhausted? That's what we're looking at right now, because obviously the markets are going down. So we want to know, when do we run out of sellers? Well, there's 3 signals that we're looking for to find the exhaustion in the base. Okay, so number 1, when we see that half of the market, so we can understand, so just if you're new to Bitcoin, because it's an open blockchain, it's an open ledger, we can see the data. So we have what we call on-chain data. So we can see wallets, we can see what wallets are doing, moving, how long those wallets have been dormant, all types of things. And that gives us a lot more data than we typically get in normal investments. Okay, so when we can see that half the market is underwater, that typically tells us that sellers are starting to get exhausted. So we have this chart, by the way, these charts right here from Blockware. Shout out to my friends over at Blockware, self-hosted mining. I do a lot of work with them. But what we see is that percent supply in profit. So what we can see is that when the bottom part of the bottom part of the holders are below 50%. So this white line is the Bitcoin price, and this green line is the percent of the Bitcoin holders that are in profit. And as you can see right here, anytime we get down to this 0 line, we're below that level. And so you can see back here in 2022, that was the last Bitcoin low, the last bottom cycle that we had. You can see where it got here. Same thing here back in 2018 at the bottom of the market. Same thing back here in like around 2015. So you can see we're sitting on that line right here again today. So we can see that sellers are starting to get exhausted, as we can see it in this chart. Okay, there's another way we can do this, and we want to look at the Bitcoin miners. So the Bitcoin miners, of course, they process transactions on the network. They earn Bitcoin rewards for doing that. And so they stockpile, they hoard, they hodl a lot of Bitcoin. But when they start capitulating, meaning they're just out, they're selling their Bitcoin, that's usually a sign that the sellers are being exhausted. Why? Well, one of the reasons is because they're one of the biggest holders of Bitcoin. This is the hash ribbon. So the hash is the hash power. So the computers, it measures how much power, how much mining power is on the network. And what we can see again here, if we go back to 2022, we can see this capitulation right here in this market low right here. If we go back here, in this market cycle, we can see it right here as well. And we go back in 2015 and we can see it all right here. And as you can see, just like this area, here we are below the line. We have a lot of minor capitulation. Again, some of the biggest sellers that we have are now capitulating. They're selling their Bitcoin into the market. Then we have strong hands flip. What does that mean? We call strong hands the ones that don't hold. The weak hands are the ones that buy and sell very quickly. So when we see the strong hands flipping, that also gives us an idea. So we can take a look at it like this. This is the long-term holder position change. And what we can see is obviously the long-term holders are selling, and then the long-term holders start buying again. They sell it, they buy back out. Maybe they know something we don't know, but we can see how this has played out in 2022 as the price came down right here. We can see they were selling, and they started buying. Here we can see that they were selling, and now we can see they're buying up again right here. So they're flipping. They went from selling, and now they're stopping selling, and they're starting to buy. So what does that tell us? No more sellers. So the big, long-term, strong hands aren't selling, the miners are sold out, they're capitulating, and the market's underwater. So that's 3 signals that typically show us when the market is being exhausted, when we're running out of sellers. Okay, so next we'll look at the line. Again, there's a lot of data points, but this one line has been very reliable over a long period of time. So if there's one line I'm going to watch, it's going to be this one. Again, watch it in conjunction with others. Now, what am I talking about? I'm talking about the 200-week moving average, okay? So this is basically averaging out the last 200 weeks. And we can see this line right here represents that average, and this is the Bitcoin price. And what we can see is back here in 2018, it touched the line. 2020, it came below the line. In 2022, it sat below the line quite a bit, and we can see we're just below the line and just on it right here. So what does this represent? Well, it tells us, if we go back to the beginning of Bitcoin's time, we can see that anytime it's reached this line or gone below it, it's been historically cheap. Because we don't know a top or a bottom until we look backwards, what we're trying to find out is when things are cheap or when things are expensive, when things are overbought or when they're oversold. And that's what this is showing us. Anytime it comes down here, it's been a historic buying opportunity. You had the chance to buy here and ride that all the way back up. Buy here and ride that all the way back up. buy here, ride that all the way back up. And here we are sitting again here, and we have this opportunity to ride it back up. Now, these are what we call historic buying opportunities. As a matter of fact, I'm going to show you here at the end what some of the opportunities could present if history holds true. Of course, past performance is no guarantee of future performance. But as you can see, if there's one line I'm going to watch, it's going to be this one because it shows me what's going on. The 200-week moving average also sort of helps us understand where people were buying. And so this is the cost basis of coins acquired in the last 2 years. And so there was a heavy accumulation right here. As you can see, heavy accumulation anytime it gets below that line. What this is basically telling us is that the 2-year cost basis, again, people are buying in this area right here, is $88,000. So they're underwater. Goes back to one of those charts I just showed you. So right now the price is in the 63, 65,000 range at the time of recording this, and the 2-year cost basis is $88,000. So they're underwater. So check this out, follow this. If there's one chart, that's the one I don't want to be watching. Okay, now we also want to understand the fundamentals that push Bitcoin's price. So we're sort of looking at like a lagging indicator, sort of telling us what's happened or what's happened so far. We want to understand what's going to happen. We want to understand the leading indicators, what's actually driving this, what's under the fundamentals here. And so from that, we can see that the tide is starting to turn. What am I talking about? So Bitcoin is like a liquidity sponge. When there's a lot of liquidity, when there's a lot of money supply, debt, etc., when the bond index is down, when things like that, then Bitcoin soaks up, it's more sensitive to that global liquidity, and it pushes assets up. So when liquidity goes up, it's like the rising tide lifts all boats, and Bitcoin's the fastest boat. Okay, so a couple things that we want to look at. First of all, global liquidity. Now, there's a bunch of ways we can measure it. Most of them are proprietary indexes. A couple good ones I like are the Bitcoin Layer, Nick Badia and group over there. Raoul Paul does a good one in Real Vision. Michael Howell, he's the GOAT of global liquidity. There's a bunch of ways we can do that. This is just a chart of the major central banks and what their money supply is showing. It's a little bit more of a simple version. But as you can see, this is showing the global liquidity is going up right here, and this is the NASDAQ, and look at how fast that's going up based off of that liquidity. And so again, this is the underlying driver that will lift Bitcoin back up, and we can see that it's turning up. That's one way to look at it. Here's another chart. This is from Bitcoin Magazine Pro. If you want to get the on-chain data, on-chain indicators, check out Bitcoin Magazine Pro. And this is the Bitcoin price right here, and this is the global liquidity. And you can see right here in this section that global liquidity has turned up and the Bitcoin price is still down. That's presented a gap right here that needs to be filled. And so we expect Bitcoin to turn back up pretty heavy and then overcome that gap and then start rising again off of that liquidity. So these are the underlying drivers. Another one we want to look at is the bond index. All right, so this is represented by the MOVE index. And what we can see is that when the bond volatility drops, as we can see it down here, it's come down quite a bit. This represents a very favorable tailwind to start lifting Bitcoin price back up. So we can see the sellers are being exhausted. We can see the price is at all-time historic buying opportunity lows. And we can see the liquidity is presenting a positive fundamental environment to start pushing the price back up. Okay, now, cheap in what though? Cheap in what? Well, we have to understand that value is more important to understand. It's more realistic to understand than the bottoms. Nobody knows the bottom of the market, and maybe some people get lucky once in a while, but what we can understand is the range. So people can sell in the bottom range. They can sell in the cheap range when it's a good value. Or they could buy in that range, right? So we don't know the bottom, but we do know the value, the cheap, the pricing, things like that. What we can tell off of the data, and there's a bunch more indicators I look at, we can tell that right now, currently, we are in deep value territory. Now, I do want to say that just because it's cheap doesn't mean, number one, doesn't mean it can't get cheaper. It also doesn't mean that it can't stay cheap for a long time. So we don't know these things. We don't know the bottom, but what we do know is that it's cheap. We also know that past performance is no guarantee of the future. But let me show you a couple more charts here. So when we get these factors to line up all together, so for example, the supply and profit is 50%, the hash ribbon is falling, the price is below the 2-year cost basis, and the long-term holders are accumulating. Anytime it's done that, that's represented by these these colored brown bars right here, you can see that anytime it's done this, it's represented these amazing buying opportunities, right? Here we are, and you can see all those factors have combined again right here. Now, again, past performance is no guarantee of the future, but if this holds, this looks like another historic buying opportunity lined up in front of us. Now, what has happened if you have bought during those periods? Let's take a look at this. So if we go back to 2011, what we can see is if you bought, you could have bought Bitcoin for only $4 back then. Imagine buying it for $4. You would have, in a year, you would have made 162%. Within 2 years, 2,551% return on your money. In 2015, it's about the time I started buying Bitcoin. It crashed, it hit about $1,000 in 2013. That's when I first started paying attention to it. And I was watching it run up to 1,000, then it crashed spectacularly. I'm like, whew, good thing I didn't buy that. I bought it around 2015. It bottomed, well, I guess it bottomed around $227. I bought it in the 300 range. But you can see within 2 years, it was up 469%. November 2018, that was the first big drawdown I had to suffer in. It went from, well, I guess it went from 300 when I started getting in 2015. At the end of 2017, it was about $20,000. Then it spectacularly crashed to 5,700, but it went on to return 185% in 2 years. We can see in December 2022, another time it was below that 200 weekly moving average for quite a while. Hit a bottom of 16,000 and had a 529% return. And here we are right here. We're at about 63,000 at the time of this recording. And of course, we don't know what the return will be. But there's a couple of things I want to draw your attention to. Number one, you'll see that it went from 4 to 227 to 57 to 16,000 to 63. You'll notice that each of the lows are higher. So when you're looking at financial markets, what you want to see is higher highs and higher lows. And as you can see, this continues to make higher lows over and over and over. The other thing that you can see is that the median returns is 499%, 500% returns. The worst case returns were 185%. Not too bad. Now, the one thing I'll tell you about my own experience is that each one of these times to see the price crash back down here, it's really difficult. I mean, like I said, I started buying around $300. I saw it go up to 20,000 and crash all the way down to about 5,000. And I had enough money for me at the time was like, man, this is like life-changing money. Why didn't I sell? I can't believe it. I missed my opportunity. I'll never get another chance. Now, I didn't sell, but what I also didn't do was I didn't buy. I didn't back the truck up and buy heavily here because I'm like, man, it may never come back. I don't know. I'm listening to all the FUD. I kind of already have some. Let me just see what happens. And then it came back up. Same thing happened here. It crashed back down to 16,000. And it's a whole nother set of stories as to why it's dead this time. It's not coming back. And again, I didn't sell, but like I didn't back up the truck because it's like, man, I don't know. I don't know if I want to get any more. I kind of already had enough. Maybe I'll just wait. And I would say the same thing is sitting here. Now it's a whole new set of reasons why Bitcoin's not going to come back. AI took all the liquidity, or quantum's going to break it, or whatever you want to put it in. MicroStrategy owns too much of it, whatever you want to put in there. But now is the time, if history is our guide, now is the time to start adding back to your positions when it's cheap, when things go on sale. The same reasons why people stand in line all night at Walmart on Black Friday to get things on sale. It's much harder. It's much harder with financial assets than it is big screen TVs for some reason. But anyway, again, if history is our guide, now is the time to be buying. Doesn't mean it can't be cheap for longer. Doesn't mean it can't get more cheap than now. But we do know is that every time we've had a chance to buy in this deep value range, it's been a historic buying opportunity. Let me know what you think down below. Is it cheap now, or will it get cheaper, meaningful cheaper enough to wait? Let me know in the comments down below. As I always say, to your success, I'm out.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretched dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
You know, I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. we'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity, or only to credit, or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions, and we do it in a very thoughtful, programmatic fashion, where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Every single company, I think, is going to hold Bitcoin on their balance sheet, where they think about, how do I preserve capital, not just for the next quarter, but for the next year, 2 years, 3 years, 5 years.
All right, welcome back to BFC Live. My name is Jake Fenton. I work here on the Bitcoin for Corporations team. I am joined by Sam Callahan, head of BTC strategy at OranjeBTC, and Himanshu Sahay, the CTO and co-founder of Arch Lending. Gentlemen, thanks for joining me today.
Thanks for having us.
Thanks for having me.
Of course. Well, I want to start with some of the Bitcoin operating company news and just some macro stuff. In macro, I want to start with the Clarity Act. It seems like based on, reports that we're getting out of Capitol Hill that it may be close to the finish line. Whether the Clarity Act does or doesn't pass, Sam, I'm curious to hear if the Clarity Act passes, what are the consequences for not just Bitcoin treasuries, Bitcoin operating companies, and just the average Bitcoiner and pleb out there? From your perspective, what does this mean for the space?
Well, I think the Clarity Act, it's a potential tailwind for Bitcoin. It's a catalyst. Bitcoin's the most established, most liquid, largest, most secure digital asset. And even though the Clarity Act is more, I'd say, prevalent about for broader the crypto space, other cryptocurrencies, stable coins, who can regulate them, who has oversight over them, how do you categorize them? That's kind of really what the Clarity Act is about, just clear rules and regulations for the entire digital asset space. Bitcoin's had regulatory clarity for going on a decade now. It is a commodity, but it will benefit because a lot of institutional investors still, unfortunately, conflate Bitcoin with the rest of the digital asset space. And so they might be hesitant to allocate to the entire space, including Bitcoin, until there's more regulatory clarity, until there's a framework for the market structure around this new asset class. They might be hesitant to allocate to Bitcoin. So if we do get this passed, I think Bitcoin would generally benefit. Now, there is some language that is good for Bitcoin itself. There's language around protecting open source developers. There's some language around self-custody. I'd like to see that language strengthened a little bit, but it's good that there is some protections in place for self-custody. And so it's not completely irrelevant to Bitcoin. There is some language that's good. I'm just for no regulation over bad regulation. So it'll be interesting to see what the language is after the recent markups and kind of debates and whether it'll actually go through or not. But if it doesn't, I don't think Bitcoin necessarily needs it. Bitcoin thrives with or without the Clarity Act. But I think in the short term, if it passes, then the market would see that as a tailwind, and we could potentially see the price respond to that.
Yeah, Himanshu, I'm curious. You come from a totally different angle or perspective in the sector. I'm curious, what does this mean for lending? What does this mean for Arch in particular, and the way you guys operate?
It doesn't change too much for our business as it operates, but it does help regulate a lot of people around us. So, for example, it makes someone like Coinbase, or when you like Coinbase, a commodities exchange, right? It also, I think, gives our customers and customers in general clear frameworks on segregation and how their property is protected. So it creates clear frameworks around bankruptcy protection. It's a question we get a lot from our clients, and we've made steps along the way to make sure that in any negative scenario, our clients are always protected. Now, this makes everybody in the market have to operate along those parameters. So I think that is quite helpful as well. And then as it relates to intermediaries versus people who sit at the front, like DeFi developers, it treats them a little bit differently now. So intermediaries or centralized businesses that do provide access to DeFi, which a lot of other lenders do, and there have been a lot of conversations on wrapping DeFi into C5 models. They may now actually have to face proper regulatory clarity and face sanctions, risk management, etc., compliance obligations like they normally would with their centralized business along with the DeFi wrapper as well. So I think it does change a few things there. I think outside of Bitcoin, I would also prefer some stronger drafting around what is the security versus commodity conversation, because it does provide certain pathways for SEC to CFTC's like regulation from labeling something as secure, which would be a security as a commodity. So it's interesting to see how it operates on other assets. I think for Bitcoin, absolutely a tailwind. We are seeing some price action improvement as a result as well. Still nowhere close to, I think, a bull market or anything. But yeah, I think it's gone through so many changes in the past several months, and it's still unclear what version actually is is going to go through if it ever goes through. So it's unclear what happens still. I'm cautiously optimistic.
Yeah, I'll just add, like, I think kind of what he was getting at there is that it is going to make it easier for these institutions to start to build in the space too. It just gives clearer rules for them. Like he mentioned, the segregation, it obviously goes beyond that. When you think about the institutional adoption that's happening in some of the large banks, for instance, getting into the space, launching Bitcoin products and services and digital asset products and services, tokenization, having a clear framework would allow them the confidence to build, really make investment into the space, which is good for the broader, ecosystem as well in terms of improving investor access, lowering the cost for end users. For instance, like Bitcoin lending would be an example of how this could benefit Bitcoin in the long term to have clear rules. Now, there's some other important parts for Bitcoin, like for instance, I would like to see the strategic Bitcoin reserve get codified into law. I would like to see Bitcoin tax treatment improve for de minimis transactions. Those things aren't in the Clarity Act. They're in different pieces of legislation that are a little younger in the process. And so there's important legislative efforts beyond the Clarity Act that I think actually move the needle more for Bitcoin adoption. But make no mistake that if it passes, I think broadly speaking, it's a good thing for Bitcoin.
Both of you mentioned Clarity Act being a potential tailwind. Let's play devil's advocate here, and let's assume the Clarity Act doesn't pass and it's dead on arrival. Outside of the Clarity Act, what are some of those other tailwinds that you see in the space right now that might be positive for Bitcoin?
So in the past week, we've seen the first actual week of inflows in ETFs. I think we've seen close to 700 million in inflows. It's still a tiny fraction compared to the actual outflows that we had of, I think, 13 billion at its peak in the past few weeks. So that's, I think, a bit of a tailwind there. We are seeing some ETF demand. I think it's just a rotation out of crowded AI AI and semiconductor stocks. We also saw a huge inflow into the IPO for SpaceX. We'll probably see another one for the Anthropic IPO if and when that happens. So it's more of like a correction. Like it's less mania. It's just like the market attempting to rebuild a little bit. I don't think it's euphoric in any way. But if it does hold this breakout and it's not just short covering any event-driven stuff, and if you don't see another big blowout in the war in the Middle East, we could see a steady climb. I don't think it's going to be a massive jump where we see a 30% month, but I think we will see a bit of a steady climb.
Sam, curious to hear your thoughts.
Look, in the short term, I think Bitcoin's going to continue to come under pressure because there's more competition for marginal capital. We think about the IPOs, highly anticipated IPOs, and how large they are that are still anticipated towards the end of the year. That's going to compete for capital. You obviously have the AI craze, tech stocks running. Now that's starting to correct, right? Anybody who bought into the SpaceX IPO is now underwater. And that's the kind of what you'd kind of expect to see. So I do think you're going to see a rotation back. But right now, there's more competition for marginal capital for Bitcoin. So it might still struggle. Now, when I think of Bitcoin, I think of it as a long duration asset, and it's very volatile in the short term. I always go back to the fundamentals during corrections like this. Has my thesis changed? Has the reason for holding Bitcoin changed? And what I usually focus on is the fiscal outlook, the amount of government spending, things like that. Recently, the fiscal numbers came out. We're actually on set to have a larger deficit than last year, right? So spending actually increasing. You have yields rising. You have inflationary pressures rising. You have more geopolitical fragmentation, more capital controls. These are the real tailwinds for Bitcoin long term, and they're only getting more clear. And the traditional financial system is continuing to deteriorate in many ways when you look at its long-term health. And so those are the real tailwinds that I think people should focus on and during these price corrections that really go back to the fundamentals of why you would want to hold a decentralized asset that can't be debased, that can't be censored, that provides some diversification against fiat debasement risk, which is what stocks, bonds, other assets that might be in your portfolio, they might not be able to hedge that fiat debasement risk as well as Bitcoin or other hard assets. So, it's probably not the answer you want to hear of like what's the short-term catalyst for how do we get out of this bottom. Really, it's just time. It's just a period of accumulation of where Bitcoin moves from weak hands to strong hands with conviction. You're seeing that in the on-chain data with long-term accumulations. There's a lot of bottom signals, sentiments poor, but really the reason to hold Bitcoin has never been stronger or more clear. So those are the things that I look for. If I saw governments starting to act responsibly and stop spending, maybe I'd be a little bit worried about Bitcoin not making a bottom here.
Yeah, I tend to agree. I don't really look at the Bitcoin price. It's more about the long-term monetary scarcity thesis. I do believe that in the short term, it is still trading at the moment as an event-driven liquidity asset, but absolutely in the long term, it's very much still if you believe in the thesis. I mean, there's no better time to get in than now, if you aren't already. But I think it's still very much a long-term reserve asset, in my opinion. I think it's Sam's opinion as well.
You mentioned Sam. You mentioned institutions, capital allocators, IPOs coming up, and then you kind of explained your general thesis on why Bitcoin makes sense to you. I think after working in the space, I've seen that there's a lot of skepticism toward these institutions that hold Bitcoin or some of the infrastructure partners like Arch Lending. I'm curious to hear your thoughts on for the average Bitcoiner that agrees with you on this like large debasement trade. What I'm curious, why wouldn't an institution that's made up of people that also can see the writing on the wall with fiat debasement, why wouldn't they also buy Bitcoin, hold and move their company onto a Bitcoin standard?
Well, I mean, it's a big lift for a lot of companies, especially it seems like the older they are, the larger they are. It takes a lot of convincing to change your treasury strategy and allocate to a new treasury reserve asset that's only been around for 17, 18 years.
Yeah.
And there's a lot of bureaucracy involved. There's a lot of internal controls that need to get placed. How do you secure the Bitcoin? Operations to set up to allow yourself to even hold it or allocate to it in the first place, let alone convincing your board or committees on the investment thesis of why you'd want to hold it, especially at a time like this when it's down 50%. There's real reputation risks. So there's a lot of like bottlenecks. Now, the actual reasons when you actually dig down to the fundamentals and the, run the numbers, every single company I think is going to hold Bitcoin on their balance sheet eventually as inflation and debasement become increasingly worrisome and severe, where they think about how do I preserve capital, not just for the next quarter, but for the next year, 2 years, 3 years, 5 years. When you look at the options available to them as a public company, I mean, you have cash and cash equivalents, but obviously they underperform the rate of monetary inflation, which is around 6.5, 7%. So you're losing in real terms, but you want that liquidity. And so you think about what are the alternatives, and this is what Saylor did in 2020, right? And there's regulations in place where they can't necessarily hold like securities. And at the same time, if you buy like the S&P 500 for protection as a company, it's interesting because you're kind of like, if you have competitors in the S&P 500, you're kind of giving them capital. So there's a little bit of incentives there. But you want to hold a commodity then, right? Because it doesn't infringe on any of the 1940 Act, and you won't get reclassified if you hold more than 40% of your balance sheet in securities. Like you want to hold commodities, and then you think, well, I could hold gold, I could hold real estate, but that comes with other headaches and other problems due to their physicality. And then you land on Bitcoin, right? And so I think it would be really reasonable for really every CFO and corporate treasurer to eventually come to the Saylor's conclusion. But I think it's going to take time. I think it's going to take, there's still a lot of education that needs to happen. There is still work to be done on the regulatory front. Like we've seen like a whipsaw over the last couple of years where they used to fight against it. Now there's clear accounting rules. But there is still barriers there that need to get brought down before a lot of these companies can feel comfortable allocating to it. So time is the biggest teacher, and debasement will continue to wither away the value of all these other Treasury reserve assets. And then education on Bitcoin, and Bitcoin just building a stronger track record will do more than anything to get people to finally allocate to it.
Himanshu, curious to hear your thoughts on again, because you offer such a unique perspective. You're really helping these companies expand their operations or bring liquidity to maybe some of the assets that they hold on the balance sheet. Curious to hear your thoughts on next steps for institutions in Bitcoin.
Yeah, I think it's important to differentiate public and private institutions. I think if you're public, you typically operate on a quarter by quarter basis, and you have real risks in having a negative quarter, right? Especially if you have that like two negative quarters in a row, you may have a strong operating business, but if the Bitcoin is going down, which it has in the past 2 quarters, you're going to have a lot of questions, and your management like credibility will be put into question. There's a lot of risk for a business that is public with a significant number of public shareholders to go on the Bitcoin standard. So I think we'll see a larger number of companies over the next few years maybe allocate a small percentage to Bitcoin. But I think it takes a lot of time before we see a lot of companies operate significantly on the Bitcoin standard. However, on the private side, companies are a lot more nimble and often founder-led, where they can actually make that decision. And we actually have a much larger number of private companies that borrow from us than public. Obviously, there are a much larger number of private companies that hold Bitcoin. It's easier